Good morning and welcome to the Conference on European Economic Integration 2024. We are so happy to have you here with us today, but we would also like to extend a special welcome to our online participants. And we hope to hear from you during the Q&A sessions as well. My name is Ingrid and I'm going to assist the chairs and you, the online participants, during the Q&A sessions. We need to be running a tight ship today, time-wise, so I'm very glad to hand over to our captain and host of the CEEI 24, OeNB Governor Robert Holzmann.
Jolly good morning to everybody. Very happy, how to say, I could convince you to come in early. As we all know, like in monetary policy, credibility needs to be established early on, otherwise you don't get it. So once again, happy to have you here, distinguished guests, dear colleagues from the region and far beyond. It is really a great pleasure to welcome you here at the Conference of European Economic Integration. And I'm pleased to see so many experts interested in this topic here in this room, and in order to discuss with us the euro in Central, Eastern and Southern European countries. We picked this topic for two reasons. First, in 2024 marks, as we all know, the 25th anniversary of introduction of the euro as common currency, which crowned more than 7 decades of preparation. And second, the string of recent crises, including the energy crisis, high inflation, has sparked an intensive debate in the region about the advantages and disadvantages of joining the euro and participating in it compared to staying with its own currencies. At this conference, we also commemorating Ola Ratziner. Some of you may still remember her well, who used to head the OeNB's Foreign Research Division. She was a trailblazer for our bank's research, our means OeNB research on the topic 25 years ago. As we know, she died in a tragic accident, the family, and she will be with us not only now, but also in the future. To set the stage for the conference topic, let me draw a historical parallel which offers valuable content for our discussion today. Roughly 100 years ago, there was a breakup of a transnational currency as part of the Austro-Hungarian currency union, and the breakup itself went hand in hand with the disintegration of the Habsburg Empire, one of the most influential entities in European history. For over a quarter century, this Austro-Hungarian crown circulated as a unified currency. It fostered economic ties and cross-trade over vast territories, which, as we know nowadays, are divided into national states. But with it also fell apart its currencies. And the successor state of the empire established national currencies. Central banks emerged across the region as guardians of the new currencies. And central banks presented not only monetary sovereignty, but also newfound national identities. As you know, the notion crown is not, as a legal tender, is not fully lost. It continues to live in the notion of koruna, and it is the currency of nowadays Czechia, the former Bohemia and Moravia. So it is fitting then that we take this opportunity in 2024 to commemorate the centennial of two important central banks, which are also celebrated this year. The one is by the Magyar Nemzeti Bank of Hungary, and then also the Bank Polski SR, the predecessor of the Narodny Bank Polski, the Central Bank of Poland. And the establishment a century ago marked the beginning of a new chapter for their countries and was characterized by an interplay between national sovereignty and monetary stabilities. So in many ways, today's conversation about the role of the euro and the CESEE echoes the challenges and opportunities of these newly established central banks faced 100 years ago. Back then, Europe was grappling with questions of monetary, soon not only monetary independence, integration and cross-border cooperation. Today, we are revisiting the same questions, albeit in a different context, in the context of transnational currency, the euro, a currency that has, over the past 2 decades, transformed the euro in a powerful way. So let me walk you through some of the topics here in my introduction, thoughts that definitely will be taken up later in the great panels we have prepared, but also in the keynote speeches and in our evening discussion. Let me talk first about the historical milestones for Europe, the euro and Eastern enlargement. There are 2 key milestones that shaped Europe in recent past. The first one was definitely the introduction of the euro, and secondly, also the eastward enlargement. Separated by only a few years, these 2 events have been a enduring impact on European integration and have had profound influence on the countries of Central, Eastern, and Southern Europe. Launching the euro as an accounting unit in 1999 and as a physical cash in 2002 was an unprecedented step towards deeper economic and monetary union in Europe. For the first time, millions of citizens and business across the continent shared one currency, which facilitated cross-border trade, travel, investment in ways which was difficult to imagine before. Despite not only a number of pessimistic predictions 25 years ago, very often from across the Atlantic, the euro has reached young adulthood, and it has not only fulfilled its primary purpose, maintaining price stability, but it has also demonstrated sufficient resilience to withstand several shocks, crises, and challenges. During turbulent episodes of prior, Europe has served also as a key anchor not only for countries within, but also outside the European area, especially in the CESEE countries. In addition to being a global currency, the euro has also become a symbol of European unity and European integration. And it is a testament to Europe's commitment to its shared values. The second historic moment, what we had over 20 years ago, just a few years later after the introduction of the euro, has been introduced to the Big Bang of Eastern enlargement in 2004, when 8 countries from Southeastern Europe joined the European Union. This marked the most significant expansion in the history of the EU, bringing in nations that had long been at the periphery of the EU. And a few years later, 3 more CESEE countries came on board to become members of the European Union. And several others, many of them are here in the room, are preparing to join the club in the foreseeable future. For many of these countries, European memberships presented the culmination of years of reform, democratization, and economic restructuring. But it also raised important questions about the future monetary path, specifically whether and when they would join the euro in principle. All European countries are bound to join the euro once they fulfill the criteria. As we know, the only exception is Denmark, which has an opt-out clause as part of the referendum that was held in this country. Of the 8 countries that joined the EU in 2004, 5 in the meantime have adopted the euro. Slovenia, to recall, was the first in 2007, followed by Slovakia, 2009, Estonia, 2011, Latvia, and Lithuania, 2004 and 2015, respectively. More recently, we have seen further progress. Croatia became member of the euro area. Hello, Boris. Happy to have you here. But also, Bulgaria is preparing for membership and started to participate in the exchange rate mechanism as of July 2020. The path towards a euro area membership remains open and attainable for those willing to meet the necessary criteria. Each of these countries underwent rigorous process of economic convergence, meeting the Maastricht criteria and aligning their monetary policy with those of the euro system. Their experiences offers valuable insights to the benefits and challenges and the function of the euro area. Insights that are particularly relevant for the countries that have yet to become members. Let me move to the next part, which deals with the influence that euro exerts in divisive manners, influence that goes beyond the euro area. As we know, the euro is not only used in these countries, but it also impacts many other countries that are close by in a very specific way. And therefore, these countries are well interconnected with the euro. They experience spillover from the European monetary system, and they maintain significant financial, trade, and real economy ties with the euro area. The euro is often used for trade, invoicing, financial transaction, store of values in these countries, and also as a bookkeeping device in national enterprises. And I learned that, it was planned or is already introduced in Czechia, where enterprises are allowed to provide their bookkeeping or make the bookkeeping in the euro. In short, albeit not being part, the euro plays a major role in their life. And this is specifically true for countries in which we have a high level of unofficial euroization, even more so countries that have unilaterally adopted the euro as legal tender. This creates then a complex dynamic while these euro countries benefit from stability on the one hand. On the other hand, they have to endure the decision taken outside in Frankfurt, but not participating. This raises the important question, how should non-euro area countries, especially the highly euroized ones, balance benefits and risks? And what role should the euro area institutions play in supporting these countries as they navigate through the challenges of financial and other stability issues? In this context, I would like to stress that the ECB and Eurosystem are fully aware of their responsibilities as the guardians of the global currency and of financial stability. In particular, euro area institutions provide liquidity lines to non-euro area central banks under certain conditions to address the possibility of liquidity needs in the event of market dysfunctionalities. More specifically, the Eurosystem's swap and repo lines are monetary policy instruments that have helped prevent tensions in international funding markets that would otherwise could have hampered the effectiveness of the money transmission within the euro area. And I can proudly say that the Austrian National Bank has strongly supported the creation of Eurosystem's current repo facility lines. It were established as a swift reactions to the disruption caused by the pandemic shock. And based on these recent experiences and ongoing geopolitical tensions, I think it's more needed than ever. So the framework offers the light liquidity when it is needed. Let me move on then to the lessons from recent crises. I touched upon it a little bit before, but let me add a few more thoughts to that. The past 2 decades have been marked by series of profound crises that have tested the resilience of the economies across Europe, both within but also outside the euro area. The global financial crisis of 2008, the subsequent debt crisis, COVID-19 pandemic, all have had significant economic and social impacts in the economy in general and on the euro area and the countries of the CESEE region in particular. More recently, energy crisis due to the invasion of Russia added one more topic, and the inflation, which was the consequence, had further intensified the challenges. For the euro area countries, these crises have driven home the value of belonging to a larger, more integrated bloc. The ECB's monetary policy response to the global financial crisis and subsequent sovereign debt crisis, for example, played a crucial role in stabilizing the euro area's financial system and restored the confidence in the euro. On a broader scale, the coordinated monetary and fiscal responses by COVID pandemic, including the Next Generation Credit Recovery Fund, provided support to all EU countries. This has helped them to manage economic fallout from the pandemic. Yet it is also more important to mention and reflect on the side effects of these extraordinary fiscal and monetary measures that were implemented during the pandemic and which need to be unwound, but more importantly, I would say, substantially investigated, explored with high-level economics in order to understand what we should avoid next time. Non-euro areas experienced the crisis episode rather in a varied way. Some CESEE countries have faced significant challenges, including currency volatility, fierce recession, rising inflation and employment. Others have faced much better and navigated the crisis in an extraordinary way. In certain cases, the advantages provided by the flexible exchange rates and the independent monetary policy may have played a non-unimportant role for that. In many countries outside the euro area, the recent crises have invited the debate on the risks and benefits of joining the euro. Deliberating such a move involves comparing it with the advantages of maintaining an autonomous and potentially more flexible monetary policy and exchange rate arrangement. The issues are, of course, primarily debated among economic experts and policymakers. However, it is equally revealing to contrast the expected discussions with the perception of the grassroots. How the people view the euro relative to the national currencies and how have their views been affected by recent crises? Well, as you could expect, now comes a little commercial for the OeNB Euro Survey, which offers valuable insights into this topic. Since 2007, we have been surveying individuals in CESEE countries that are currently have not adopted the euro. The surveys show that on average, trust in the euro is higher than the trust in national currencies. In several countries, including some within the European Union, the gap of the trust is surprisingly wide, with the trust of euro sometimes double that of the national currency. Trust in the euro tends to be strengthened even further compared to national currency during the crisis, and particularly after the energy crisis led to a high inflation. In recent survey rounds, respondents were also asked whether they believed that the euro had a positive or negative impact on the euro in economies 25 years after US introduction. Only in Bosnia-Herzegovina, Romania, and Hungary, a majority of respondents think the euro had a positive effect. In contrast, in Czechia, less than 40% of the interviewed people share the view, while around 1/3 of them believe that the euro has had a negative impact. The micro-data evidence clearly shows that the euro remains a hotly debated topic, capable of dividing opinions not only among experts, but also among the public. Ultimately, however, in economic terms at least, the question of and when to adopt the euro boils down to the critical issue of convergence. This is something which is one of the key objectives of the European Union, to bring the nations of Europe together in a way which reduces their different levels of income. And the question is, should countries first achieve a high level of convergence before they're joining Europe, or is the joining Europe a measure in order to achieve higher convergence? And as it always with economics and empirics, in some countries you have the one impression, and the other one you have the other one. So this is a topic I'm sure we'll also discuss during this conference in some of the panels. Now, let me move to my final part, is the question of completing the single market, the next chapter. Because these considerations of what to do and when are perfectly valid from individual countries. However, from a euro standpoint, achieving and maintaining a high level of economic convergence among members is essentially for, how to say, an optimal currency area. So it's not something only we do because it makes sense from a social point of view, but also from an economic point of view. Although the euro has shown remarkable resilience and strength over the past quarter of century, we cannot rest on our laurels. And as we know, the euro area is still far away from an optimal currency area, a topic which was my first thesis topic, so I'm particularly interested in that. As we look ahead, one of the key challenges facing the euro area is the need to complete the single market, particularly in banking and capital markets, but far beyond. Despite the progress that has been made over the past decades, significant gaps remain into the integration of European financial markets. These gaps do not only limit resilience of the euro area, but also hinder economic convergence across the broader European Union. The latter report of earlier of 2024 is a timely reminder of the benefits that can be achieved if and as the single market is achieved by eliminating many barriers for traders' investment, and which is often not really appreciated, more single market is also means higher productivity in the sense of Ricardo, and here the effects could be still very, very large. At the same time, of course, a more integrated banking and capital market union would also help to mitigate the risk of future financial crises by enhancing the stability of the European financial system. Similarly, we have the Draghi report refers to the importance of fiscal capacity there. There, of course, the proposals he put on the table are not universally shared, particularly when it concerns to expectations of having a joint financing there. However, whatever it is, we need to do our homework in the area of a better integrated financial market with or without sharing, because it's our own interest. To finish with a positive note, even as we acknowledge the work that remains to be done, it is also important to recognize how much we have achieved over the last 25 years. We should remember that the process of building a fully integrated economy and monetary union is not a quick one. And for this, we have also some kind of benchmark. As we know, it took the US over 100 years to come forward with the Federal Reserve and to create a unified monetary system. So compared to this, we already did a quite good job. The next 25 years will also be important for the euro and for the broader European project. We must continue to work towards a European economic and monetary union. We must complete the banking union and build the capital markets union. A recent paper on that by me you will find on the web. At the same time, we must remain flexible and open to new ideas, recognizing that the pathway towards deeper European integration will require ongoing reforms and adaptations. Well, after I have shared with you a few thoughts which will come up in the various discussions and panels there, it's now my special privilege to thank the speakers, panelists, and participants at the conference having joined us. Of course, particularly my staffer that has always done an outstanding job to make our conference as agreeable as possible. But now, and I see I have 3 minutes left, I could have spoken a bit more slowly. It's now an opportunity to invite the speaker there. She's over there, thank you. I thought you would go in the first row, which is Catherine Schenk from the University of Oxford. Allow me to introduce you briefly. Catherine is Professor of Economics and Social History at the University of Oxford and Fellow of the St. Hilda's College, Oxford. Her academic career lists several renowned academic institutions in Europe, Asia, and New Zealand. She is a visiting academic to the Bank of England and currently works on a EU-funded research project that looks at the evolution of the payment system from 1870 to 2000. Looking forward also to this research there, as we know, whether we want it or not, all economists dealing with monetary policy had to become also specialists in payment systems. So we are looking forward to what you have to say on this at the later stage there. So, Catherine, thanks for coming. Thanks for joining the conference. We are all looking forward to your presentation. After your presentation, I will join you on the stage for a few questions before we go on time to our break there. Again, welcome, and I wish us all a great conference. Thank you very much.
Thank you very much, Governor, and thank you all for being here today. I'm going to lower this a little bit. There we go. I'm really very pleased to be speaking at this event. It's extraordinarily timely. I think it's a very important topic to be discussing at this point. And I'm particularly pleased to be invited to reflect on the sort of longer-term trajectory that got us to 25 years ago, and also suggest some suggestions about what this longer-term history raises for the future. So I'm going to talk about a little bit, retreat back into the economics a little bit, and the rationale for the cross-border currency to remind us what it is we're trying to achieve and the very different and sometimes disparate motivations for common currencies. Looking at the evolution, the key debates in the 1980s and 1990s. I will then move on to just some stylized ideas of what's happened in the last 20 years or so, and suggest some rather speculative thoughts about how this history might influence our thinking about the future. So first of all, thinking about why the rationale for the cross-border currency, and the governor spoke very eloquently about the pros and cons, if you like, of joining the euro, of having a common currency across different national boundaries. Fundamentally, we think of it as reducing transactions costs, and indeed within the European Union and the European Economic Community, as it was, the high level of transactions amongst the members heightens the cost of transactions costs in terms of cross-border trade and payments. So the European integration process that began in the 1950s really amplified the transactions costs as the world moved forward. A second aspect is network externalities, and that is that the more a country uses more countries use a currency, so it becomes more useful. And I think this is a really important concept to keep in mind, that a common currency or a national currency or a transnational currency needs to be useful in order to survive. And this is another kind of lesson from history, if you like. There's the politics of it, but there's also the underlying economics. And I think it's interesting, the public perception of the euro and its usefulness that has been expressed in the surveys that we were just hearing about. I come to you as a Canadian, so the Mundell-Fleming trilemma looms large in my catechism. And one of the things that is sort of underlying our economic thinking about common currency is the Mundell-Fleming trilemma, or the impossible trinity, if you like, which is the trade-off between monetary sovereignty, open capital markets, and exchange rate stability. And this was really an idea that emerged in the 1960s at a time of European integration, of course, at a time when people were thinking about moving towards economic and monetary union even then, and thinking about what those trade-offs really mean. If you're going to have very open capital markets to each other, is it possible to have policy sovereignty, monetary policy sovereignty, if you have open capital markets? And this bleeds into a political trilemma, because if your monetary policy sovereignty, of course, is one of the key fundamental tasks of a government, if you wanted to think about it that way. The final aspect I wanted to highlight was the importance of a common currency as a commitment mechanism. And I think we see this in the last 25 years, and I'll highlight some of the issues around there. One of the reasons why any state might want to give up its monetary policy sovereignty and go into a common currency with another state or with a central bank outside its own borders is that it constrains the operations of a national monetary policy. So in times, I'm not thinking about Europe here, but in times some populations have wished to take some of those powers away from their national authorities and track very closely an external authority in order to have a commitment to the monetary policy of that hub country, that anchor country. Okay, but as the governor said, he said that it was sort of 200 years in the making or 100 years in the making. I'm just going to go back to the period after the Second World War and remind us again about the sort of long road towards the euro. It was not an inevitable outcome of European economic integration, but you see the pressure and the importance of monetary convergence, I suppose, particularly in payments, across the period of the European economic communities. I'm starting here with the European Payments Union, launched in 1950. And this is to overcome the persistence of exchange controls, the inability to have convertible currencies within Europe because of the dollar shortage and the inability to support pegged exchange rates in open foreign exchange markets. So the European Payments Union, I think, is an underappreciated institution that essentially set up a whole clearing union for European economic community and other countries, including Turkey, for example, that cleared the system by having a European currency unit, having a different and neutral unit of account. So in a sense, it grew out of Keynes's Bancor, if you're familiar with the debates about Bretton Woods. And this is a system that allowed, because it allowed clearing, it allowed cross-border settlements without abandoning foreign exchange controls. It allowed that real upsurgence in international trade in Western Europe between 1950 and 58 that drove that dramatic recovery after the end of the war, and pulled the European states together through that those trade links, and the lowering of trade barriers was only really possible because of the European Payments Union and the denomination of a sort of common European currency unit of account through which the system cleared. When European currencies became convertible at the end of 1958, that was the end of the European Payments Union. We then saw the disintegration of the pegged exchange rate regime, the Bretton Woods system, between 1960 and 1973. It was always faltering. It was always having to be propped up with various interim, I call them kind of band-aids to try to kind of keep them going through the gold pool and swaps and a whole bunch of other things. So there's a lot of failed reforms on a global level. At this point, it became clear that the integration, the trade integration of the European Union or European community countries made it really costly to have fluctuations in their exchange rates. And so they tied themselves ever closer together at a time when the rest of the world was moving toward greater flexibility. So here we have the snake in the tunnel, first of all, because the snake was in the tunnel against the US dollar. And then from 1973, the snake slips out of the tunnel in order to wiggle freely while together against the US dollar and other currencies. So as I said, there's a really kind of strong momentum through trade relations to reduce the transactions costs in that trade, to make it more efficient, and avoid exchange fluctuations. And so this seems as sort of a momentum towards economic and monetary union that is claimed in the Hague Summit, and the roadmap to economic and monetary union was written in the Werner Report in 1970. Unfortunately, this is a really bad time to decide to change your monetary regime. It's a very difficult time in the global economy. And one of the important themes I wanted to emphasize here is to look outward from what's going on in Europe to how Europe was affected by what's going on in the rest of the world. So of course, in the 1970s, you have the oil crisis, you have an inflationary crisis, you have the end of the pegged exchange rate regime, you have a lot of uncertainty. This is not a time where economic and monetary union was able to gain any traction. Nevertheless, the economic rationale and commercial rationale for having a common unit of account did maintain its momentum. In 1978, you have the European currency unit, and then it kind of generates legs of its own. You get assets denominated in ECU. There's a mutual ECU settlement account among major commercial banks. So again, it's a sort of a private sector driven momentum as well as public. By 1986, over 10 billion ECU worth of ECU denominated bonds have been launched. So there's a commercial, there's an economic, there's that kind of pressure and momentum towards overcoming the problem of having national currencies in a highly integrated trade and payments environment. And this leads ultimately to the exchange rate mechanism, and I'll talk a little bit about the 1992 crisis. As I said, I'm Canadian, I'm also British, so I'm a double outsider here today. And this marked the end of British engagement with the Economic and Monetary Union. Just at the bottom there, I wanted to emphasize again the very important role that the Bank for International Settlements played in supporting these initiatives throughout the 1950s, 60s, and 70s. They were the accounting place, or the place where the clearing happened for the European Payments Union. They were very involved in designing and helping to support ECU clearing and designing the principles for cross-border settlement that were used by banks in Europe and elsewhere. Okay, well, I did say that the end was nigh for 1992 when the pound dropped out of the European exchange rate mechanism. These are nasty images, and I'm sorry to share them with you again or to remind you of them. But this kind of politics of the euro, I think, is easily remembered and should not kind of be forgotten in this context either. This is a dramatically horrible and horrifying but very famous cover of the Sun newspaper in 1992. And it's about Delors, 1989, and it's about Delors and the Economic and Monetary Union report. You can see, though, that he's still talking about the ECU. So the ECU was still, people were, in Britain were kind of surprised when it turned out to be the euro rather than the ECU, indeed. But it shows that kind of visceral idea about the national currency as being part of your national identity. And here we have Nigel Farage in his first iteration with UKIP, the UK Independence Party. And you can see the very logo of UKIP in the 1990s is the pound sign. So that really speaks to the huge identity issues of a national currency that I think still echoes through some parts of Europe and elsewhere. He has gone on, of course, to head the Reform Party, and he'll be more familiar, perhaps, for his presence in the European Parliament, but now in the British Parliament. As the governor suggested, there were a lot of key historical debates, and I'm an economic and financial historian, so I wanted to emphasize the importance of these. When the planning was going ahead and you're sort of gazing into the distance of what this might look like, what the impact of having a common currency while still having separate nation states might look like, looking back to historical examples became very popular, and there was a whole kind of industry in the 1980s and 1990s looking at the United States, as the governor spoke about, the Austro-Hungarian Empire. Again, it has to do with this pacing that he mentioned also. Is having a single currency a mechanism to force convergence, or should you all have converged before adopting a common currency? And this was a huge debate, particularly between France and Germany and amongst others, about the progress towards economic and monetary union in the 1980s. Remembering, of course, that while we're talking about these monetary developments, as we know, the banking union was also suggested in the 1970s, and plans were afoot to achieve that. And this is an incomplete part of the single market, so that the capital market banking systems are not harmonized in the same sort of way. And this kind of tension, I think, between national and transnational systems, I think, is a really important one. As I said, I'm coming from the outside. I'm coming from Canada and from Britain. And so I want to emphasize again the importance of thinking about the global context in which all of these developments proceeded. There's a lot of innovation going on in the 1980s and 1990s in cross-border payments in particular. It's a time of ICT innovation, the application of computer technology to very complex systems, and one of the most complex systems in the world is the global payment system. So the rise of electronic payments, a different way that people thought about their money as on a retail basis. You have the Clearinghouse for Interbank Payment Systems from 1970 in the United States, which clears 90% of cross-border US dollar transactions. You have central banks in Europe and elsewhere developing real-time gross settlement, again on the back of the ability to have computerized technology that can deal with that. Not, however, outside their own borders, but within their own borders and their national mandates of their national central banks. In 1974, a kind of mid-sized German bank based in Cologne collapsed. The German authorities closed it while the New York markets were still open. And so this woke everybody up in this early days of 1974 to settlement risk, cross-border settlement risk, and indeed cross-time zone settlement risk. So everybody was aware of this from 1974, and central bankers and the Bank for International Settlements, the International Monetary Fund, all worked very hard to overcome this settlement risk, which could be catastrophic to the global payment system, but took more than 25 years to resolve. So there's a lot of attention on clearing and netting payments, on cross-border payments during this period. And a lot of this, again, was focused through the Bank for International Settlements, amongst which the European central banks were kind of major members of the board of the G10. And so they developed more kind of committees on this basis. And so it's within this context of kind of a revolution of the incipient globalization, but also the dramatic changes in information technology, the different ideas about what does this mean about what money is now, as well as the innovations in cross-border settlement and transactions, that the debates about the single currency in the European Union are taking place. Okay, moving quickly to achievements and challenges. It was a kind of we spoke. I think the governor spoke a little bit about the challenges that have happened over the last 25 years. But I'd argue that it's also a period of globalization beyond Europe, but of which Europe was a major part. Globalization of trade, of payments, of China emerging into the global economy, of a surge in cross-border investment, and the reintegration of Eastern Europe, but also China, as I say, into the global economy. It's also a period of what was called the Great Moderation. So it's a time where there was a huge optimism about the ability of economics and monetary policy to deliver low inflation and high growth, because it seemed to be happening and spreading around the world. And there's quite a lot of convergence amongst industrialized countries, not just within Europe, but beyond, towards this kind of low inflation, relatively high growth type of experience. So I love this quote from Richard Cooper, and it was a quote from 1982. So he's talking about a very different period. He's talking about the 1970s, which was a period of great turmoil. But it's that the smoothness of the ride depends on the size of the bumps in the road, as well as the quality of the shock absorbers. And he's talking about foreign exchange rates and whether they should be fixed or flexible. And for him, he's also pointing to, well, you need to look at the underlying challenges that exchange rate system is facing. So if we think about the Great Moderation, this is just inflation rates for the United States, for the EU, and for the UK from 1985 to 2021. And you can see they all kind of follow a similar sort of path, and in the 1990s, from 1992 or so onward, you have this kind of period of lower inflation. Now, in a period of lower inflation, that compresses inflation rates, makes convergence easier to achieve. So I don't want to say it's an accident or that it was lucky, but 1999 was probably a pretty good time to go for a single currency. You're just on the cusp. China is just about to join the WTO. You're in the midst of this optimism about the ability of monetary policy to be kind of neutral and to be inflation targeting. And inflation targeting, if everybody inflation targets, then the whole world will converge to this happy Great Moderation. So theoretically, conceptually, and economically, it's a very opportune moment. And although there were a lot of skeptics in the ability to make this transition, between 1999 and 2002, when the currency, paper currency was introduced, it was a very successful transition. There was a bit of a bump at the start, and then it just seemed to go very unexpectedly smoothly, and the population accepted it. The markets were prepared, well prepared, and the transition was extraordinarily successful. So successful, in fact, that about 3 years later, there was a big debate, well, when is the euro going to overtake the US dollar as the major European or major global currency? This is a time when there's a bit more skepticism about the future of the American economy, and maybe there'll be a decline in the American economy relatively in American economic power, and maybe the euro will overtake the dollar as the great international currency. So it's hard to think ourselves back into that moment, perhaps, but there was a lot of discussion about this on the eve of the great financial crisis. I'd say that quite a lot of the modeling that it would overtake required Britain to join the euro and add that weight of GDP. It's a time also of EU enlargement and divergence. So you get the extension into Eastern Europe and very successfully integrated, but it also increases the divergence of the nature of the members of the European Union. There's then the great financial crisis, and initial resilience seemed very strong, but in the end there's quite a lot of centripetal effects that emerge as a result, and we're all familiar with the euro area debt crisis in the mid-2000s. I wanted to emphasize a little bit the development of Target, which comes in 1999, again grows a little bit out of the euro ECU clearing systems, but again has gone through a series of iterations, but very successfully. So just to finish with a few charts, just to kind of put things into a little bit more perspective. So this is the share of different national currencies in foreign exchange reserves, according to the International Monetary Fund surveys, from 1999 to 2004 in percentage terms. So you can see that at the start of the euro era, in 1999, the share of US dollars in foreign exchange reserves was about 70%, and it's drifted down somewhat, but it's hovered around 60% really since about 2005 onward. So there's a little bit of a drift there, but it's relatively stable. The share of euro increased initially, and I think this is what was driving some of the optimism that maybe the euro will become a global currency if its markets could be, financial markets could become deep and liquid enough before that turned after the global financial crisis, and there's a resurgence in the US dollar. What's interesting, of course, is the increase in other currencies, and partly this is a reporting problem. So in the early years, you're not getting the reserves of all the large economies reported to the International Monetary Fund, particularly China. And then you're getting more currencies reported. So in a sense, there's a bit of an artificial change that's going on here. But I think there's also a significant real change, underlying change happening with the diversification of foreign exchange reserves and a different kind of strategy particularly for emerging market economies coming into the global system. This is data from SWIFT. Now, SWIFT doesn't do all the transactions in the world, but it's a messaging system, as you know, that's used by a large proportion of cross-border payments. And this is the number of transactions on a quarterly basis, or a monthly basis, actually, by currency. And it's indexed to, so it's compared to January 2011, which is when the data starts. And the blue line is the euro. So you can see that the euro, in terms of number of transactions, really hasn't changed at all. Whereas you do see an increase for the British pound and for the US dollar and for transactions in other currencies. So this is sort of showing you a little bit about the dynamics of what's happening in terms of the transactions, the means of exchange use of different international currencies. And this is the proportion of those messages. So you can see, as we would expect, that the US dollar is the largest, has the largest share of the denomination of messages, SWIFT transactions. So again, these are transactions, messages reported to in order to effect cross-border payments and national payments. So you can see that it's increased from about 40 to 50% are in US dollar, the share of euro, as we might expect for the previous slide, has declined. And others has increased, and I put the British pound in there because it's still hovering around 5 or 6%. The BIS does a survey of over-the-counter foreign exchange transactions, and their data sums up to 200%, just to kind of make this clear. And this is showing you the turnover by currency in terms of percentage of overall turnover from 2001 to 2022, again, covering the period of the euro. And you can see that in the first half of that period, you have a slight decline in the share for the US dollar, a slight increase for the share of the euro, quite a dramatic decline for the Japanese yen, and a mixed picture for the British pound. But in the second half of those decades, you do see a retreat of the euro, a resurgence, well, resurgence is maybe too strong, a recovery for the US dollar, and very little change elsewhere, the Japanese yen not recovering. So I think this is something to keep in mind as we go through today. I've been trying to emphasize the history of the euro from the outside, if you like, and thinking about its global position, as well as the importance that we'll be talking about much more thoroughly in its internal position in the European Union. Okay, so here's the most speculative part that I can say. Again, maybe because I'm coming from Britain, I'm a bit preoccupied with Brexit for the past many years. But one of the lessons of Brexit might be, well, it's a lot easier to get out of the European Union if you don't have a single currency. And so that's an interesting sort of question to think about, as there are some centripetal kind of forces. They avoided the commitment mechanism, which I introduced at the start as being one of the motivations of having a single currency. I would say that I lived in Scotland during the 2014 referendum on whether Scotland should separate from the rest of the United Kingdom, and that referendum narrowly lost. And the uncertainty about, well, what currency are we going to use if we're not part of Britain and we can't use the British pound, was a really important element also in that voting behavior and the decision to remain with the United Kingdom. I would argue that strategic ties within the EU are probably more important than they've ever been since 2022 in particular, and what's going on in Ukraine and Russia. And so that's a kind of a pulling together sort of force. I'd point to a lot of fintech payments innovation. And again, rethinking and reimagining what money means. How can we separate the means of exchange, store of value, and unit of account into different parts that serve our purposes that are more useful to us? And again, remember I emphasized at the start that a currency needs to be useful. And this has been a challenge to central bank money in cross-border payments. You don't even have to go to Bitcoin or something like that. You can think about the stable coins like Tether and others, which are used in cross-border transactions. So it could be a challenge to central bank money, or it could be an opportunity. And a lot of central banks are experimenting with central bank digital currencies and the opportunities that this might provide. So we think about stable coins. I'm not a crypto fan, I have to say. So thinking about stable coins, distributed ledger technology, and how that's going to change how we think about and operate our cross-border transactions. And what role would a euro or a national currency play in that? That might change. If you have tokens and a tokenized digital currency, then it really speeds up and makes cheaper, possibly, the cross-border transactions, because the contract can be finalized very, very quickly, which at the moment is very difficult to do. There's a lot of European payments innovation that we've been hearing about. I point to, again, back to the Bank for International Settlements, try to combine these tokenized central bank digital currencies with private sector partners. So they've got 41 banks and central banks working on sort of a global marketplace proof of concept, essentially, for cross-border transactions. there is a lot of talk about, well, we don't need these national currencies. We don't really even need the euro anymore. We can kind of move on to using Tether or some other kind of stable coin. We can move to distributed ledger technologies. We can move out of the regulatory and supervisory space of central banks altogether into this kind of fintech world. I'd argue and warn that we're not there yet. Certainly, the prospects and challenges for the ECB and for other central banks are large, but there's still time to think about how to engage in those processes. At the moment, distributed ledger technology is quite clunky, it's very slow, and it's very expensive. So it's not ready to be the kind of swift, I don't mean swift, but the kind of quick and easy solution that we might think about it. This is just my final slide. Maybe I won't leave it up there very long. Just that there's a lot of scaling issues in some of these technologies. This is showing you the increase in congestion cost as the volume of transactions increases across Ethereum, which is one of the big platforms. So it's kind of slow and a bit clunky still. It's useful at the margins maybe, but maybe not yet feasible as a kind of a central payments mechanism. But it's something, again, I'm trying to encourage us to think today from the outside in as well as the inside out, to be thinking about what's happening outside Europe that may influence the future of the euro as we discuss it today. Thank you very much.
Thank you, Catherine. Very well done. And it was really kind of a memory road. You were walking, going all these topics there. Some of them I forgot yesterday it happened. So, Michael, for you. So I'm sure there will be a few questions which we can still have before we head off for coffee. As nobody puts up their hand, I'll take the right of first question. It's a long history you take, and if you only take the last century and the issues there with regards to one currency, which is the question compared to having various currency, in your view as historian, what was the kind of change which has taken place? I know the discussions we had at this time, they're different from nowadays. What has been added, what has been dropped as the one? And related question, of course, then is really, how to say, the crystal ball. If you look now towards the future and think of a world of fragmentation, what do you expect to see from a historical perspective, what may emerge, because we had fragmentation in the past? So.
Thank you very much. I think the emphasis on international trade was really so paramount at the start. If you think back to the 1950s and 1960s, it's trade that is driving the growth. And people often think about the Bretton Woods system as being all about the International Monetary Fund. The International Monetary Fund was kind of just there to facilitate cross-border trade through stable exchange rates. And now I think the complexity and the globalization of financial markets means that the debate has kind of moved on. So in a sense, you're moving from an era which is not really globalized in terms of the financial services sector into a kind of a very different world. So we often say that we're going through this second globalization, and the first globalization was in the 19th century, when you had an unprecedented flow of goods, of people, of money around the world. And then there's the big retreat and reversal of that process during the Great Depression in the 1930s and the wars of those decades. But this globalization began kind of similarly with flows of trade, flows of money, and flows of people. But it was quickly overtaken by flows of money. So the kind of financial flows are so much larger now compared to trade and people. So in terms of the difference in the discussion, I think the economics of it have changed somewhat because we're not talking in the same sort of way about the same transactions.
Thanks. And so what we see now is a kind of déjà vu we go back again for my transactions, the issue of trade, tariffs, and what can be done in order to keep some trade offers. So we are a little bit of a déjà vu in a different format.
Well, I think we hope we're not entering another great reversal, as it was called in the interwar period. There is a lot of fragmentation globally, and we may see that continue given the election results in the United States. So we are in a period of great uncertainty, I think, about the future shape of the global system. There is a threat, I think, that we see a kind of a retreat and a reversal. It used to be thought that, well, once you've let the genie out of the bottle, if you like, once you have globalization, you can never, it's just sort of inevitable that it continues. And I think the lessons of the 1930s are really salient in that respect. What may happen, or may be more likely to happen with the sort of disintegration and geopolitical conflict is more kind of workarounds. Trade will become less efficient, payments will become less efficient, and welfare will drop.
Thank you. I see a hands up for Nisna. Yes. Micro, please.
Professor Schenk, we touched upon this yesterday evening, but I would like to repeat this question. Is Europe better at taking steps of integration, like adopting the euro, when there is a crisis or when there are tranquil times so that policymakers can implement visions? So is the euro a child of former crises, or is it really a reform project where there was no sense of urgency, you have to avoid the next catastrophe?
I think that's a difficult one to answer, as we sort of debated it a little bit last night. I think urgency is good, and developing a sort of an idea of urgency can galvanize populations to make changes and to change their minds. I don't think times of crisis are time to make big decisions, however, and we see that maybe with the Werner report in 1970 and the kind of momentum that was already built very strongly in the 1960s towards economic and monetary union. If you have a lot of volatility, that's not a time where you're going to have a successful outcome. You would like to have a transition like 1999, where you're moving into taking these experimental moments at a time when you've got the best possibility for it to be successful.
Thanks. I see a hands up there too. Yes. First, the lady on the left hand. Yes, Birvushka. And then I can't see your face, but I saw the hand up. Okay,
I pass it on. Thank you so much for this tour de force historically. Small comment or question on the fragmentation and the impact. We see fragmentation, some. It's not very visible yet in the data, right? So there's a lot of rhetoric, there's a lot of fear for the future. But in the data, we see a leveling of globalization in terms of trade and services, goods and services. But at the same time, we see certain regionalization, right? So from the perspective of the euro, that actually, as you probably implied in your conference, it may give a certain boost to this sort of regionalized currency as the euro. But my real question would be concerning the core of this conference. So based on this historic experience, based on the importance of trade, financial linkages, how you see the prospects of euro adoption in Central Eastern Europe, given their deep integration already with the rest of Europe?
Thanks for the very Hungarian question. Yes, thank you.
In terms of fragmentation, I wasn't speaking about fragmentation within Europe. I'm really thinking about China and Russia, and the importance of China in the global economy is well recognized. It was a major force behind the Great Moderation and the successful rise in standards of living around the world in the 2000s. And so the faltering nature of its economic growth and the potential for greater trade barriers is problematic, I think. so even kind of getting beyond, if we go into a kind of a broader sort of global geopolitical conflict. I'm not going to speculate about the prospect for other countries joining the euro. I think it depends really on the national political will, the will of the people in that country. As I said, a currency has to be useful. Above all, it has to be useful. It's not just a political symbol. It won't survive just as a political symbol. It has to be something that's useful, and if it requires a kind of a sacrifice in terms of national autonomy over monetary policy choices or something, even if those are kind of chimeric choices, there has to be the usefulness and the value that is coming out of it. And maybe part of that is, well, that commitment mechanism. It's an economic as well as political commitment mechanism.
Thank you. Governor, please.
Thank you. Natia Turnava, Acting Governor of National Bank of Georgia. First of all, thank you both for very insightful, very interesting presentations and really topical presentations. I would like to ask probably more country-specific question, but it might be interesting for other colleagues as well. So, as you know, Georgia has been granted the status of candidate country, and we set the goal to become a member of EU by 2030, and it means consecutive policy and steps towards more integration in terms of monetary policy and banking policy, all aspects, including supervision, monetary policy, and at the end of the day, adoption of euro, probably not immediately, but when time comes. At the same time, right now, we, as a small country with an open economy, very much exposed to the currency exchange risk, to the interest rate risk. We're advised by IMF, by credit rating agencies to decrease, we call it de-dollarization process, to decrease dollarization and to increase the share of national currencies in, let's say, the commercial banks' balance sheets, in the savings, in the loans, and that's what we are doing consecutively. And the share of dollar and euro as well is decreasing, and we think that it's a good performance. Do you see any contradiction or like any balance could be found? Probably it's just the consecutive steps, and our priorities will change and fine-tune then, but this is the situation right now, which is also the case with some other small countries that are also trying to be closer to Eurozone. Thank you.
Okay, you're asking me to challenge the advice you're getting from the International Monetary Fund. I know you're not, but I'd say maybe, I mean, so much of international trade is denominated in the US dollar or in the euro, and that makes sense for invoicing. It avoids the exchange risk for the corporations that are involved in that trade. So there is a kind of a network externality, I suppose, associated with that. Nevertheless, the ability to have and manage your own domestic currency, I think, is important. To keep the credibility of that currency is important. I think central bank independence and central bank credibility, I'll say it 3 times, is absolutely crucial, particularly for price stability and inflationary expectations. So some countries not in Europe have kind of gone for dollarization. It has not been a good outcome for them in the end. I'm thinking about Latin American countries in particular. And so having a robust domestic monetary system, I think, is important. Thinking in terms of international invoicing, though, of your trade and this sort of thing is maybe a slightly different category.
Thanks. Last quick question, last quick answer.
Thank you very much. My name is Martin Wagner. Thank you for your presentation. My question is, in the end, relating to the relationship between fiscal and monetary policy. When you've started out over the last 150 years with some interesting experiences, both in Austro-Hungarian Empire and Germany, Then there was the hope of the beginning of the 2000s that the euro would be becoming a second reserve currency. And then at the end you speculated about why it is not yet the case, in addition to technical problems, that all these sorts of so-called cryptocurrencies are not being used as reserve currencies or whatever. So I guess in the end, what's the role that we see, or that you see, for the fiscal backing of a currency, or as the American colleagues put it so nicely, especially people that adhere a little bit to the fiscal theory of the price level, you need dollars to pay your taxes, which is the one-sentence version of it. How important will that be, in your perspective, for the future evolution of the euro as a global reserve currency in addition to the dollar?
Thanks a lot, Martin. Yes, please.
I think the idea that the euro was sort of a currency without a country, in the sense that it didn't have a fiscal policy, is an important element in the barrier to becoming an international currency. I'm not sure you want necessarily the euro to become an international currency so much, or to take over these kinds of roles, however. I think the issue of fiscal is very live to me as a Canadian. I come from a currency union of a very large and very diverse economy that requires a lot of transfer payments in order to support that monetary union. So it's a very complex issue. I talked about the trilemma, the sort of exchange rate trilemma. There's also the policy trilemma. And once you bring fiscal policy into it, this is seen so much more firmly as within the mandate of your national government and your elected democracies, that it's a very obvious and important challenge.
Thanks a lot. Thank you for a great presentation, great answers. We have now 30 minutes for coffee. Thank you.
So, welcome to the first panel of today's conference. The last person is asked to close the door. And I welcome you to this panel. We will now take you from this wonderful historical overview of Professor Schenk to the region which we want to discuss with you. You have heard a lot about the history of the Economic and Monetary Union, and you're asking yourself now, what does it mean for Central, Eastern, and Southeastern Europe? You know that the region is converging. How fast we will discuss. And you have heard about the Maastricht criteria, but what we will try to do for you is to fit those mosaic stones together to get clear messages for the region. I'm the Director of Economics at the Austrian Central Bank. My name is Birgit Niesner. I left the region already for 40 years, I must say. I'll just give you an impression from my first business trip to Bulgaria in '96. It was really the wild, wild east in the 90s. And in Sofia, you could buy toothpaste by small amounts. And I'm telling this short impression of poverty to show how big the shock was in the 90s, how deep the countries went down, and what kind of transformation challenge they then undertook, so that today, and we will have a short input on Bulgaria today as a surprise for you, we can discuss about Bulgaria as being the next country in the pipeline for the euro adoption. So we really have history in our room, we have economic success stories in our room. At the same time, we know that the European Union is confronted with many challenges, and we should really ask ourselves whether talking about euro adoption is not putting another layer of challenge on the currently difficult situation in Europe. So is it something, do we see the euro as a risk if we take on more countries? Or do we see it as a success story because it allows better integration of our neighborhood? And it is also very important what we want to do to discuss today with you is the pros and cons of euro adoption and how they have shifted in the recent years. Because if we had had this conference 5 years ago, the assessment would have been different, I can already say. We have 1 hour together and we'll go in rounds. In the first round, we will discuss convergence and its link to euro adoption. You know, the governor mentioned it, that 6 countries out of the 8 which entered the European Union from the region have already entered the euro. In the second round, we discussed the Maastricht criteria. This is especially relevant for 2 countries which envisage to enter the euro. And in the third round, we'll discuss the link between euro area membership and further economic integration. And here, then, we will discuss also a little bit the 3 countries which are in the European Union, but who are not trying to get the euro. And for these challenging questions, to the core of the region and to the core of the European Union, I have wonderful panelists with me. And maybe you think, why are there so few? Yes, we had unfortunately 1 cancellation. Our ECB guest fell sick, but I must say that now with the 2 on my panel, and you will find who is who, we have 1 rather skeptical person and 1 rather pro-euro person, but they're both affiliated to universities. Piroshka Noc-Mohaji, affiliated to London School of Economics and a very distinguished international career at the World Bank and other institutions. And Michal Brzezina from the Warsaw School of Economics and also affiliated to the Central Bank of Poland, as I learned yesterday. What I can already tease a little bit, and then maybe you will find out, what is their central message? Piroshka says, the euro is the ultimate European integration tool, but the project is not complete. A handful of EU countries, most in Central Europe, have not yet adopted the common currency. And she says it would benefit these countries and the European single market and the whole European projects if we have more euro adoption. Michal will take the challenge. Okay, now I did a spoiler myself. He's more skeptical, and he will put forward a very interesting economics argument, because he thinks that the convergence and divergence of countries depends on the natural rate of interest with the euro area. And this is a criterion which is not among the official Maastricht criterion, but he thinks it should move to the foreground, and the safest option is to avoid an accession if this criterion is not properly fulfilled. Michal will go and deep dive with us on this issue. So, thank you for being here. We now start with the first question and the first round. Again, having in mind a little bit the 6 countries who already entered. It's the Baltic states, it's Slovakia, it's Slovenia, and it's Croatia. And the question, I'll start here with Piroshka, how much convergence is necessary before adopting the euro? And talking about these 6 countries, was it rather early or late in the process of convergence that they adopted the euro?
Okay. Thank you very much, Brigitte, and it's a real pleasure. Thank you for the governor and yourself and the whole Austrian Central Bank for this wonderful conference and for the invitation. So I'm going to start with a very simple statement, which is part of my mission statement that Birgit really insisted us sending beforehand, and you heard mine already. And that is that the euro has always been as much as an economic as a political project. That we all know, right? So let's not forget that. And I think at this juncture, we are at a very interesting historical point. As we already heard with this excellent economic history presentation, from 2022 we have a new situation in which Europe faces very stark choices. Either it pulls it together and becomes truly unified, and it's, politically, it defends itself, economically, it really creates and deepens the single market to get all the productivity gains and all the innovation gains and everything else that comes with it to be able to compete on the global market, or it will just continue a slow decline into slow obliviation. I think the choice is very stark, even now that in the country where actually I now live, the US, you have the Trump 2 era, which also puts certain pressure on Europe, both on the defense side, but also on trade side. So both from the East and the West, you have a very strong pressure to wake up and unify. So this is why I think that the political aspect is very, very important. But we are economists here, I realize. So let's focus on the economies and on the specific question of convergence. As most of you who are here are very familiar with, there has been what now the literature calls an EU miracle following the accession of the 8 and then 2 additional countries, sort of the 10 countries in the middle and second half of the 2010s, 2004 and 2007. In terms of convergence, growth convergence per capita income, we have seen a convergence which is unprecedented historically. You don't see it anywhere else. It was very nicely supported, of course, transition funds, cohesion funds from the EU. But that was, I don't think that was the only reason, because cohesion funds hit Portugal, and Portugal actually deconverged after joining the EU. So that's not the only thing, and they got a lot of money too. So I think it was this dual conversion from the top through the whole legal acquis, adopting the whole European framework, and from the bottom up, and that's what I want to stress here, the bottom up integration, very deep integration, trade links, cross-border ownership links, finance links, which really makes this region very unique. Central Eastern Europe is more integrated with part of Western Europe than Western Europe within itself. You look at the banking sector ownership, for example, still half, in some countries more than half, of the banks are owned by parent banks based in the Eurozone, including, of course, and leading actually Austria. Austrian commercial banks are having subsidiaries everywhere in the region. And then you see this haggle between, UniCredit trying to buy, part of a, German bank treasure and having a difficulty in acquiring that. So we are much more integrated in terms of banking, telecommunication, manufacturing sectors, in terms of ownership, and what comes with it, the finance, the trade linkages. It's very, very integrated. So I think the convergence that is measured by per capita is really underpinned not only by the legal framework, but also by this very deep convergence that you don't measure in the convergence criteria, you don't measure in the Maastricht criteria, you don't measure, but is there, and I think underpinned the very unique catch-up convergence of these countries. In terms of numbers, there are very good studies. I think we will also hear about this from Professor Eisman later this afternoon. But it's called the EU miracle, the EU accession bonus that created something like, the estimate range, but relative to EU average or relative to Germany's per capita income, an additional increase of between 20-25% of growth. It's fantastic. But I think what is important is, again, the convergence in the financial and real sectors that really underpins the relationships, in addition then, and on which the trade and the finance and everything else came with. And the euro is very much used. The governor was very clear, this is basically, even if you don't adopt the euro, even the Czech Republic, where the classic Eurosceptic country in our region, they use it as a measure of account. Everywhere you use it. In accounting, in pricing, real estate you price in euro. I'm sure that it's priced also in zloty and in Hungarian forints, etc. But if you want to be serious, you price it in euro. part of the bank deposits are in euro. When there is a stress, as we have seen in my own mother country, Hungary, at some times, people shift into euro deposits of foreign bank subsidiaries. That's also prevalent. Of course, we had some stresses because we had the Eurozone crisis after 2008, 2009, and adjustments to excesses that happened to the hyper-globalization and maybe regionalization as well. But today, when we are more stabilized, very clearly, the euro is there, is being used, and as the governor said, Southeastern Europe is basically already euroized, either unilaterally, therefore officially 2 countries, and Madam Governor is here to speak about that, for Montenegro, or people just use it and then they will not develop really local currency markets. So euro exists, and euro in Southern Europe actually is existing before the EU adoption. So in essence, the sequence has been reversed, and the euro as a store of value, as a payment, and the whole mechanism as a commitment device in the end is working. So I think we have had enough convergence. That shouldn't be the issue. I think that, you don't want more than a miracle to be delivered. Let's not ask for double miracle here. And let's look at all the benefits. And then let me just,
We'll come to the benefit. But thank you for so your answer is we have had enough convergence and seen enough convergence in the region and go for the political project.
It's never enough.
Yeah.
But, you don't want more than a
euro
miracle.
adoption. Yeah. Michael, as I have said before, you have an interesting, enriched version of what should be convergence in the countries. Can you explain this to us?
I'll try to do my best. Let me start with thanks a lot for the invitation. Thanks for the introduction to Birgit. Since Birgit mentioned that I'm affiliated with the central bank, let me mention whatever I say today has nothing to do with the official views of the National Bank of Poland. Today I'm a professor from SGH Warsaw School of Economics here. And let me also explain, I'm not a super Euro-skeptical guy. I'm super enthusiastic about European integration. I'm very enthusiastic about the euro. I'll just try to convince you, or maybe even answer the question that many people ask me actually, why doesn't Poland want to join the euro? Are there economic reasons for that, or are we just Euro-skeptical by nature, proud of our currency, and so on? I will try to convince you that there are good economic reasons not to do it, at least at the current moment. And that has to do with convergence, but not with convergence or incomplete convergence, real economic convergence per se, but with a very specific aspect of non-full convergence, which is related to what Birgit already introduced, the concept of the nature rate of interest. And Birgit told me yesterday, Michał, you should be careful because some people in the audience might not know what is the nature rate of interest. That was like a shock for me. I wrote my PhD thesis about the nature rate of interest, and I can't imagine some people might not know what it is, but I take it at face value, and I start with trying to explain what this is. And I think the easiest way to think about this nature rate of interest, by the way, it's a pretty old concept, so that was introduced in the late 19th century by the Swedish economist Knut Wicksell. The easiest way I see as explaining what is this, think of a central bank doing monetary policy, and I think that's something that everybody in this room knows how it is going. Think of a central bank trying to prevent inflation or prevent overheating of the economy. Then the central bank usually raises interest rates to a relatively high level, whatever that means. In the opposite case, if the economy is, say, facing a recession or a deflation, central bank does the opposite. It places interest rates as low as possible. And now, between these two extremes, one that is supposed to cool down the economy and the other one which is supposed to heat up the economy and bring inflation up, there is a point, unobservable to make sure, which we call natural equilibrium interest rate, which is just neutral in the sense that when the central bank sets the interest rates at this level, it's neither leading to an overheating economy nor leading to a slowdown or recession. Okay, so that's a kind of holy grail of central banking. As I said, unobservable. It's not something the statistical office tells you how much it is, but that's why central banks hire smart economists for them to calculate this thing. And now, the point is that you know, why don't we think about readiness for joining a monetary union in the terms of this divergence of natural rates of interest? It's because when Mandel and all these other great economists, even in the 1960s, wrote about optimum currency areas, they've probably thought about countries which are relatively similar level of development. If countries are at a relatively similar level of development, they usually have similar equilibrium on natural interest rates. Something different happens when they are not. And for instance, our estimates of the nature rate in Poland are approximately, it's measured with uncertainty, but approximately 2 to 3 percentage points above the nature rate of the euro area. You might ask, so what? What's the problem? Why is it a reason not to join the euro, at least not at the moment? And the answer is very simple. I'll try to bring it to you. Because when a small economy like Poland joins the euro area, then of course it's not the euro area that will adjust its average level of interest rates to the Polish one, but it's Poland where the average level of interest rates will be adjusted to the euro area level, which means that the interest rates will drop by a substantial amount. I said 2 to 3 percentage points might not sound a lot, but if interest rates drop, you know, by these 2 to 3 percentage points for a month, quarter, or even half a year, nothing bad happens. But if it's like something permanent, then things can go nasty. Initially, they go great, actually. People see these very low interest rates that are now below the equilibrium level for Poland, and they start borrowing. Okay, let's buy a new car, let's buy a new TV set, maybe let's buy a new house. The economy starts to be booming, people consume more, everybody's happy. That's a bit like an analogy to a nice evening with a lot of wine. But in the morning, you usually wake up with a hangover. And what's the hangover? At some point, the economy is overheating. At some point, the economy is not able to provide all the goods that are demanded, so you start to import them from abroad. You start running trade deficits, you start running current account deficits. This means that you are starting actually to consume by borrowing from abroad. You might ask, is this a kind of theoretical concept or has this happened? Of course this has happened. This has happened in many countries of the euro area. This has happened, for instance, in my favorite example, Latvia, where at the peak of this boom phase, they were borrowing, their current account deficit was like 20% of annual GDP. So they borrowed from abroad the equivalent of 20% of their national income every year. Until, can you borrow forever? No, you can't borrow forever. At some point, these nice guys from abroad who have been lending money to you, they notice, oh, you probably borrowed too much. Mm-hmm. Economists call this a borrowing constraint. You hit the borrowing constraint, you have to cut consumption very sharply, and that's exactly what happened in Latvia, in Estonia, in Spain.
Let me come in here. I mean, right. that was really, I'm glad I advised you yesterday to think about this. You did a wonderful job in explaining this. And it means that if you disregard this hidden, by the way, it's also a concept very valued by our governor, and there is a paper now recently published, but if you disregard this secret equilibrium interest rate behind the nominal one, which is part of the Maastricht criteria, you may run into boom and bust cycles in the countries, and that's a very valid argument. Before asking the next question to Piroshka, who already, do you want to really comment exactly on this?
Intervene. I just would like to ask sort of, Michael, that's was a very, very, very interesting explanation. So in your studies, what explains that this higher natural interest rate for Poland? What drives this?
That was supposed to come in the second round, actually. But
otherwise, it's difficult to understand, you know, the argument.
Of course.
So,
So
Go ahead.
yeah, perfect. So there might be two reasons actually, and they lead to very different conclusions about the future and readiness to join the euro area. My favorite explanation, and that's a positive one, which means that anyway, positive later. My favorite explanation is about productivity growth. So theory tells us this, that countries with higher productivity growth, read catching up countries, for instance, like Poland, should have a higher equilibrium interest rate. So that's one explanation. Another explanation, which is not so nice, is that there might be some features of the society that make people, for instance, less patient. People willing to borrow more because, I don't know, because of historical reasons, for instance. I think that also might play a role in Poland, although I believe that technology growth, higher technology growth in Poland than in the euro area is the main driver.
Mm-hmm. Mm-hmm. Okay. Thank you very much. I would now like to call upon the team to show the first slide, because we have now mentioned a lot of countries, and already the governor started in his speech, but this gives you the overview again, where we stand in terms of EU entry on the left side and euro entry on the right side. And here again you can see, on the right side you can see in purple 6 countries who have entered the euro, then 2 unilateral adoptions of the euro in the Balkans, Bulgaria in the pipeline, and yeah, this is roughly the status quo, and it shows that there is actually quite some heterogeneity on the way. It's a work in progress. And I think the country which is mostly on our mind, because there have been constantly news on, do they meet the Maastricht criteria, can they enter or not? And I can already say they had I think they also had bad luck with the timing. We will now get a short input from Mrs. Christine Gartner. She is from ECB, and she is the lady responsible for ECB part of the convergence report, which is issued every 2 years. And please, Christina, give us an insight on the euro accession of Bulgaria. And you get a microphone, otherwise our external listeners are discriminated.
You hear me now? Or? Yes. My name is Christine Gartner. I'm working at the ECB, and I'm coordinating the convergence report of the ECB since 2016. And next to me, there is my colleague, Adriana Reut from the European Commission, who has been coordinating several convergence reports for the European Commission. So we are what I'm going to in liaison. So what I'm going to offer is some personal remarks, because I can of course not speak on behalf of the ECB at very short notice.
Yeah, and
what I wanted to say is that the recent adoption by euro adoption by Croatia confirms that the euro area is fit for further enlargement, and all EU members that joined the EU since the signature of the ratification of the Maastricht Treaty are expected to join the euro area at some point, unless they have an opt-out, which is only the case for Denmark for this time, for the time being. So the timing depends on 2 factors. First of all, the country's willingness to enter the euro area, which is reflected in the national euro adoption strategy. And it is also, and the other factor is its readiness to adopt the euro, which is based on the fulfillment of the criteria for euro adoption as laid down in the Treaty on the Functioning of the European Union and the Protocol on the convergence criteria. In their convergence reports, which, as Birgit Niesner has just said, we assess, which we do every other year, we assess the progress made by the non-euro area member states towards fulfilling the treaty-based criteria required for euro adoption. For Bulgaria, the last report that was relevant for Bulgaria, it was published on 26 June this year. Both institutions, both the Commission and the ECB, concluded that they did not fulfill the price stability criterion. It was that Bulgaria had an average 12 months average inflation rate of 5.1%, which was well above both reference values, the one by the ECB of 3.3% and the one by the Commission 4.1%. In our assessment, we regularly also emphasize the importance of achieving convergence that is sustainable, not just in one specific point when we do the report. And at this point, we encouraged Bulgaria to take further efforts as recommended by the Commission. And specifically, we also encouraged Bulgarian authorities to strengthen its AML framework and fulfill all the elements of the action plan that was adopted by the Financial Action Task Force. So thank you. That would, if there are further questions, I stand ready. Thank you.
Thank you very much, Christina. It's wonderful to have the two experts on the convergence report sitting in the audience. Please feel free to involve them in further discussion over lunchtime. Thank you. Now, Christina has given us this view on Bulgaria and the fulfillment of Maastricht criteria. It is clear that most of the countries on the list in the convergence report have problems with the stability of price criterion. Maybe now I start with Michael. Michael, I mean, you have already shown us one indicator which you would put on the list of criteria, but overall this assessment, this grid with the Maastricht criteria, is it still appropriate?
Yes, or have they ever been appropriate?
Have they ever been appropriate?
Have they ever been appropriate? I think they might be useful. I have this analogy for Maastricht criteria, you know, think of I know, 40-year-old single guy who thinks it's time to find a spouse, and the colleagues ask him, so what should she be? And he said, okay, I'm dark-haired, so maybe she should be dark-haired as well. Any other criteria? No, I think that should be enough to make a good couple, no? So it's like the Maastricht criteria are the same. They are useful, but that's just a very small part of the story, even if you look at the old literature that I already mentioned from the 1960s about optimum currency area criteria, convergence, not real convergence, but convergence of business cycles, for instance, elasticity of labor markets, flexibility of fiscal policy, and so on. It's almost not there. One thing comes to my mind when speaking about Bulgaria. Bulgaria is today the main topic, probably the main country of interest here. Many years ago, like about 25 years ago, Bulgaria in the 1990s had big problems with monetary policy, with providing price stability. So it was running inflation rates of about 1,000%, if I remember correctly. And by the end of the day, they decided, okay, we can't do it on our own. We introduce a currency board system. Currency board to the non-economist is probably the closest you can have to being in a currency union without being in a currency union. So they made a currency board toward the Deutschmark. It was 1997. There was no euro yet there. And inflation dropped from about 1,000% to single-digit numbers within 1 year. So actually, even the main criterion that we're talking about here, Bulgaria not fulfilling or not fulfilling the inflation criterion by 2-3 percentage points, is not probably so important from the economic perspective. You can join the euro area successfully, probably with very high inflation rate, and if it's credible, it's going to decline. Now, the second part of the question, when is the best timing for the euro adoption? And let me come back to what I talked about before, because that was a final part and maybe the less Eurosceptical part of my talk. coming back to what I was asked before, what's the reason for equilibrium interest rates being much higher, say, in Poland, also in other countries, like Romania is another example, in my view, than in the euro area. If the reason is high technology growth, and I believe this is the main reason, then this is relatively optimistic because Poland has been converging fast. The convergence gap is still there, but relatively small. And in the perspective of, say, 10, 15 years, our forecast for the equilibrium interest rate in Poland is for it to more or less to converge with the euro area. So that would be some horizon for Poland. If the reason is different, if Poles are inherently less patient, and if you just allow them to borrow, they will borrow. Then of course this is less optimistic. But
which timeline did you give us now for Poland?
10, 15.
10, 15 years?
Yes.
Okay, good. Yeah. No, just writing this down for the next conference when we will invite you to assess it. No, okay, but you put it in a different perspective. Yeah? Bulgaria is obviously a country which is eager and pressed to join. Of course, they have a different background with the currency board. Yeah, that also makes a big difference. Piroshka, may I ask you, the Maastricht criteria, a good tool? Appropriate? They have.
Look, the Maastricht criteria, and we all know, right? Everybody knows what.
If you want to shortly go into it, we have time.
Not my. I don't want to spend too much time. But we know price stability, fiscal stability indicators, interest rate stability long term, the ERM2 mechanisms, so the fixed exchange rates for 2 years, etc., etc. So these are not. And Michael is absolutely right. These are not really criteria behind or to build up or measure progress toward the optimal currency area. These are not, right? These were designed, I think, and one reads anecdotes, but these were essentially designed to measure certain policy commitment. Personal policy commitment before joining, sort of harmonization of to look also at certain commitment at fiscal sustainability with the deficit target and the debt target, the price stability with a very specific peculiar measurement, but whatever. You pick a target and the like. So I agree with Michael on that, and your measure of this natural interest rate is more toward an optimal currency area type of argument. Of course, optimal currency area doesn't really exist. It definitely didn't exist when the US introduced its currency, and it took, as the governor said, a good 100 years to get it done. And even today in the US, you can see studies, research that argues that the US itself is not an optimal currency area, that Florida and the southern states are so different from the East Coast states or California. So in a sense, the US shouldn't really be using the dollar. So we cannot really look at perfection in that regard, in my view, and there are many other important driving forces. Now, in terms of the targets themselves, just on institutional economics terms, there are no perfect targets. So if you measure you want to measure certain commitments, you can then, of course, argue that whether it's a 3% of GDP deficit target, a 60% of public debt, very arbitrary. As arbitrary is also the 2%, central bank inflation target for most of the inflation targeting countries. You pick, if you want to have a commitment measurement, then you pick something that is easily measurable in institutional economics, monitorable, and the public and decision makers understand it. So in that sense, the fiscal 3% deficit target, I think, passes that sense. You can argue a lot about the ERM2. That's the very tough one because you require keeping the exchanges fixed within a predetermined rate. But I would say that lost a little bit of its tooth, luckily, with the ECB, as the governor mentioned, the ECB really now providing in a good framework currency swap and repo operations, facilities to not only countries in the EU which don't yet have the euro, but countries outside the EU using the euro, very rightly. So very responsibly, and basically thinking as an enlightened monetary zone central bank, and using it very, very effectively and superbly. And I understand that the Austrian Central Bank has really helped the ECB to do this facility in the right manner and timely manner. So when you have this type of backup facility, and as the governor alluded to, maybe a standing liquidity facility, it's not that will not be that difficult to fix that. So overall, my reading is that the Maastricht criteria, and I'm with Michael on that, never wanted to measure, never aimed to measure readiness or the degree progress toward an optimal currency area. That was not the purpose. So that's, that's a historic fact. It picked a certain criteria which actually quite measurable. We know in certain areas, that wasn't observed not only by, those who are outside, but those who are within the growth and track, but actually quite monitorable. So if you want to look at commitment, and in that sense, it fulfills its purpose.
Thank you. So the beauty of the toolboxes or of the Maastricht criteria is that it's easy to see whether they are fulfilled or not, and it allows policy and political commitment. What I find interesting is really that you have, among the countries who try or not to try to get into the euro, you have quite a diversity that, and I now take Romania. I absolutely wanted not only to focus on Bulgaria, but also on Romania and the Czech Republic. Romania is the second country in the pipeline, if I may say so. What do I mean with this? It has an envisaged entry date. So it wants to be part of ERM2 in 26, and it wants to join the euro in 29. And that's a very bold announcement, because in the last convergence report, and Mrs. Gattner will immediately correct me if I'm wrong, they've fulfilled 1 out of 5 criteria, whereas with the Czech Republic, there is no political will, and I'll show you something from inside Czech Republic in a second, but towards the end of this year, they might fulfill 4 out of 5 Maastricht criteria. Yeah? So there is, each country really has to be looked at case by case. Can we shortly have the second slide, and I'll show you something about the public discourse or the funny side of public discourse in Czech Republic before we go to our last round. I would need the second slide now. Yeah, exactly. Yeah. I don't speak Czech either, and I'll help you with the cartoons, but it shows a little bit the sentiment. Yeah? So on the upper left side, this person answers to the reporter, constantly we discuss the adoption or non-adoption of the euro, but most people in Czech Republic would rather wish for the Russian ruble. This is the first cartoon.
They can get it.
Yeah.
If they don't.
The second cartoon with the nice guy with the victory sign, yeah, he says, I'm very confident that we will fulfill the criteria for euro introduction next year. I have complete confidence in our football team. And on the lower left side, this poor husband is taken by his wife to the doctor, and she complains he is a euro optimist. So this shows, like Professor Schenk allowed us an insight into the British debate from some time ago. If this is representative, and thank you, Thomas Lacik, for providing these cartoons, if this is representative of the Czech sentiment, it will take some time, I think. Also, they fulfill 4 out of 5 criteria. This takes me to my last question to my panelists. And Czech Republic is not the only country who is not trying. We have heard some skepticism from Poland, but also Hungary does not have the euro adoption on its political agenda, and it's a political decision, of course, underpinned by economic criteria. But my question now to Piroška is, does euro area membership act as an accelerator for economic integration, or could it also hamper economic integration?
I can't see the case for hamper in any meaningful way, so I'm very much in favor. It's a commitment device, as we heard from the excellent lecture. It's a very important commitment device. The Brits decided not to have that commitment device back in 1992 after that terrible fiasco, the falling out from what was that, the snake or the ERM or whatever that was at the time. And never looked back. So whether you choose that or not, that's I think the question. But let me, I feel too much, abandoned, in the minority in my optimism. So let me just quote what the governor quoted, which is maybe a little bit better barometer of the public sentiment than this skeptic cartoons from the Czech Republic. And that is the Eurobarometer indication. And particularly Hungary, you singled out, but also Romania, that two-thirds of the population, more than two-thirds, 76% of the population in Hungary, for example, same in Romania, favor the adoption of the euro. Now, of course, it comes on the back of a very difficult inflationary episode. Hungary had the highest inflation rate in the post-COVID inflation surge in Europe. In 2023, it was it was more than 25% annually, 25% CPI growth, very high. Now it has come down, so kudos to the central bank, but very high. And of course, people have more confidence in the euro if this type of weaknesses and credibility of domestic institutions is there. As a footnote, just for the record, it was, in my view, it was less the central bank's problem. It was more the policy mix, the incoherent approach to inflation fighting by the government, fiscal policy and monetary policy. When the central bank increased the interest rates, there were a lot of measures that the government willingly or just by default put in place to safeguard the population, safeguard certain sectors, which counteracted with the monetary transmission mechanism, and it didn't allow the central bank policies to work in full. So when you have this type of thing, the euro is popular. And it's more popular than the domestic institutions. And in fact, my understanding is that the euro is more popular than many domestic currencies, as we heard. There are, of course, issues, and I'm not going to counteract that. So there are concerns about euro adoption. One is what a colleague of mine, a very good researcher from the National Bank of Slovakia, Reina Martin, recently called like the urban myth that when you introduce the euro, there will be an inflation surge. This is just not true. But it kind of is in a popular belief, and it's my understanding in Bulgaria, for example, there is a fear of this sort when it comes to views on euro adoption. There are fears about governance issues. You're a small country, you sit at the Governor Council table, and you are one but the much bigger players. But the fact of the matter is that that you are a small player, but you still have one vote, just as Germany has one vote. Now, of course, that doesn't obviously a lot the power distribution is different and size matters. But if Central European countries join together, they will be a very important bloc within the decision-making bodies as well. And finally, you left outside what's happening in Europe. Again, today, we have 27 EU members. 20 already has the euro, and they run Europe. So the decision-making is happening in the euro area, decision-making circles. And the left is periphery, right? So you left out of a lot of important things with regards to sustainability, climate change tackling, and all that. So everything is Euroized in the policy decision-making circles as well.
Thank you. So you strongly argue for the case to have a seat at the table.
Well, you have a seat at the table, but actually you have, it's like the US Senate. I don't know, given that the American elections just took place, that people may be more familiar. So in the US, there's a House, which is a Congress, according to, it's like 400, whatever, maybe 600 representatives, I should know. But then you have the Senate, where each state, each US state has 2 senators. And even though you are, tiny little Nebraska, you have as many votes as the most populous and biggest, strongest economy, California. Mm-hmm. So that would be, I think, the situation in a sense for these small countries. Mm-hmm. Sitting.
Thank you. Michael, if I ask this question to you, I'm still digesting the 10 to 15 years, I must say. Yeah? Don't you fear that if of course, Poland is, again, each country is a different case. Poland would be really an asset to have in the euro area. But don't you feel that you might lose time in the economic integration if you take the euro adoption so late?
Well, in a sense, we joined the European Union 20 years ago. So it's been already 20 years. So from this perspective, another 10 years doesn't look like that long, maybe. Second, it's just just a forecast from a model. Things may turn out much faster, for instance. So I'm not fearing that much. I mean, Poland has managed actually very well without the euro. So I fear actually much more. Coming back to the initial question of this round, that a premature entry to the euro area could actually, and that's where I don't agree with Piroshka, could actually hamper economic integration. That there's this saying that success has many fathers, and I don't know why fathers, maybe mothers should be mentioned as well, while failure is an orphan. Yeah, and I think that's a very wise one, because it shows that ultimately the assessment comes from what happened. If Poland joined the euro area too early, and in my view that would be the case today, and face this nasty boom and then bust cycle, then nobody knows what would happen actually. We have seen so many non-linear developments, including the Brexit, for instance, in the past, that it's very easy to imagine that the society blames it on European integration, and things become really nasty then.
Yeah. I think we can make it as a very empirical question, right? Because we do have, for now, quite a few, except for Croatia, quite a few years passed when, several Central European countries already, have been member of the Eurozone. Have we witnessed excessive credit growth due to higher? Have we witnessed? No, I'm sorry, no. Latvia. Dimension. No, Latvia was, no. That was before Latvia actually entered the Eurozone, right? We're talking about the high credit, there was no high credit boom since Latvia joined in the early 2010s, I don't remember exactly, but it was after the global financial crisis, right? And the high credit growth, and all happened actually at the time when Latvia had monetary policy sovereignty, monetary policy independence, but they just messed it up. So you can mess up your economy, and you can have credit growth and a very high with monetary policy sovereignty, and our countries in the region had very high inflation with monetary policy sovereignty outside the Eurozone. Hungary had, as I said, the highest record with monetary policy sovereignty, independent interest rate setting. Poland had very high inflation rates as well, with monetary policy sovereignty. So I don't see the evidence for being, having a better underlying economic monetary policy framework and policy decision making when you enjoy monetary policy sovereignty, on which I'd like to say one sentence. This is becoming a myth. Monetary policy sovereignty for small open economies with free capital flow, they don't have any more monetary policy sovereignty. I mean, the trilemma that we heard about has been reduced since Helen Ray, actually, the literature very clearly, to a dilemma, because you don't have monetary policy sovereignty for small open economies anymore.
Thank you. I think we could go on forever and identifying whether there are more risks inside or outside the euro, but I'll use rather the last 5 minutes to allow one or two, please, short questions from the audience, and I'll ask you not to make long statements. Please, Mrs. Governor. I saw you.
First of all, thank you very much for such an interesting discussions, and it was so interesting for me as a representative of small open economy also to hear about the degree of monetary policy sovereignty as we can have. And I fully agree with Professor Nagy-Mohaski that in these particular circumstances, monetary policy sovereignty is widely restricted, I would say, naturally, when you are the part of global economy and exposed to different global shocks and etc. However, if I may say, it might be like a question also to you. If we see a difference in driving forces of inflation, and this is a recent case, for example, for many European countries, one of the important factor of inflation, which led to longer tightness of the monetary policy and late easing, let's say. That was an increase in energy prices. For example, which was not the case for Georgia. Again, I'm saying from my perspective that that might be the case in other places. Why? Because of different energy mix. It's a very specific issue. We're 75% based on our local renewable resources, and the prices on the imported natural gas are not affecting us. So not a pressure from supply side. And we were able to start easing much earlier. And I think that there might be these important, let's say, discrepancies or differences between different countries. How can we speak about unilateral, plain monetary policy?
Take the
Thank you.
question and
Okay,
then we finish, please. The microphone to the lady.
Yeah, thank you very much for interesting discussion. The topic euro and economic convergence is crucial. We do know that we have two types of convergence, real and nominal. And I do remember 30 years ago, before introduction of euro, the discussions between two economic wings. The first one, represented by northern countries' economists, simply said, first, we do have to achieve a high level of real convergence, and then we may adopt common currency. And the opposite one, and I do believe, and I remember quite well, I hope, that the Austrian economists belonged to the northern part of the economic thinking in those days. And then there was another wing, the southern, represented mostly by French and Italian economists, that said, well, real convergence is not an issue. Well, first adopt common currency and the real convergence will automatically follow. So now we are with the advantage of the hindsight. Do we have clear answer? Who was right?
Thank you very much for this question. I give you the first word and you the last word.
Okay, can I start with responding to what Piroshka said, because I don't agree, as you might.
Okay, you have 20 seconds.
20 seconds. Okay, Latvia was not in the euro area, but Latvia had a currency board against the euro for many years. So it's like being in the euro area, and there are many other examples like Spain, Estonia, and so on. And yes, there is international integration, business cycle move together, but still, as long as you have your own monetary policy, you have the freedom to set your average level of interest rates higher or lower than the average. So that these things are clear to me. Thanks a lot.
Okay, so you will take the two questions, real convergence?
No, I take maybe
sovereignty?
one, yeah, given the time, because it's an excellent question, and we just completed a study comparing the inflation performance of Slovakia, which is in the Eurozone, with that of the other three other Visegrad countries, Hungary, Poland, and the Czech Republic. And it's a kind of a natural experiment because the structures are very similar, right? The reliance on Russian energy and the weight of energy consumption and food, and very similar among these Visegrad countries. So it was a kind of a natural experiment to see how the inflation shock was managed for Slovakia, which of course part of the bigger thing, where of course the energy price increase wasn't that prevalent as for Slovakia, but they were having the ECB decision that is, for the country, for monetary policy, and the other three countries which had this independent monetary policy. And what we see that, of course, Hungary was the outlier, so that you can a little bit extract from that because that was such a high inflation. But inflation performance in Slovakia, despite the same exposure, right, same shocks, and despite the fact that interest rates were actually lower, and there was a delayed decision and all that what you refer to, inflation was lower in Slovakia because inflation expectations were better anchored because of the ECB framework and all that. That's, I think, so it was lower, not that much, but lower than in the other, in Poland and in the Czech Republic. And in a sense, the sacrifice ratio, how much output you sacrificed in order to bring down inflation from where it was higher was lower, and interest rate increases were lower than in other countries. So in a sense, Slovakia didn't suffer from the fact that it has a different structure and higher exposure to these external price shocks than the average Eurozone country and the associated decisions, and in a sense gained because it didn't have to have such an output cost for bringing down inflation.
Thank you. I'll try to answer your question and conclude the panel because we are already eating into our lunch break. And
literally eating it.
Yeah, right. We see this with a minus red figure, so it's not very nice to sit here anymore. Thank you for taking this up from the Austrian perspective. Of course, that makes it difficult for me to answer because, I would say, and this is what this panel really highlighted very nicely, first of all, there's a chicken and egg problem, convergence first and integration promise afterwards, and when do you transit from convergence success to more integration hopes? You would later, I would sooner. And I also think that I would like to conclude with something which was brought up by Piroshka. We have shifting assessment of pros and cons of the euro adoption. Yeah? And with the new geopolitical environment around us, yeah, I do think, don't do it too early, we need real convergence. It's all clear. Yeah? Maastricht criteria are an aid, but they're not everything. They're not showing the depths of economic convergence. But with very advanced countries around us, I would say that the economic assessment is done and the political benefit of entering now would be huge. That was a personal opinion, not the Austrian Central Bank saying this. Okay, I thank you for your attentiveness. I wait for more questions over lunch, and please join us again after lunch. Thank you.
Thank you.
Thank you.
Ladies and gentlemen, welcome to the second panel, where we're going now to look at the international role of the euro, independent of questions of euro membership. My name is Martin Summer. I'm responsible for research here at the Austrian Central Bank, and I'm very honored and happy to moderate this panel now. And we are going, as I said, to look into the international role of the euro. In a relatively short time of its existence, the euro has become the second most important international currency in the international monetary system. It is used slightly less than 20% of global monetary transactions, so quite a substantial amount. And also recently, the importance measured by various indices has gone down marginally due to interest rates still below those outside the euro area, other important jurisdictions. Also, geopolitical risks are expected to increase. And these are all important considerations for official reserve management decisions, obviously. And to discuss this role, I'm very happy to have a brilliant lineup of panelists here, which I would like to introduce to you briefly. I will, of course, not read out all of their brilliant achievements. I have to my left outside, welcome Eduardo Levi-Yeyati. He has pioneered the literature on dollarization, but his research focus extends more generally on emerging markets, finance, and economic development. It would go far beyond our time here to list all his strategic positions in his long-standing career. Welcome very much, Eduardo. I'm very happy that you're here. Then we have Dennis Egan. She looks back at a wide range of influential papers on macro-financial linkages, financial crisis, financial regulation, real estate markets. She has held various positions in the IMF, the BIS, and is also a CPR research fellow. So Dennis is really spanning both fields, policy and academia. I'm very happy that you had the time to join us. Welcome, Dennis. And last and not least, to my right, my dear colleague, Melanie Koch. Melanie is a senior economist at OeNB and has also worked at other international institutions and central banks outside of Austria. She has a research focus on behavioral household finance and is a survey expert and an expert on emerging markets. Great to join us, Melanie. Welcome on the panel. Now, we will have in this panel a similar format than before. We will have 2 rounds of questions, and then I hope we will still have time to interact also a little bit with the audience. So let me start with the panel first. I would like to start with a question that goes to all the panelists. And this is, how important are safe haven currencies globally, and how does the euro fare against the other global currencies? I would like to hear your assessments first before I then address specifically all of you individually. Maybe, Eduardo, could you start?
Okay.
What's your assessment?
Thank you for the invitation. I will be brief here because I want to probably come back later to that point. But something that always fascinates me about the euro is that it is a reserve currency internationally, although some people think it's underwhelmingly so. But it's 20% of official reserves in general. It's relatively stable. But it is not yet a safe haven currency, simply because it fails the crisis test, right? Every time there is a crisis, a risk-off scenario, the euro devalues. So it doesn't work like a safe haven. So some people are outside the euro using it as a safe haven, typically regionally, because of reasons that are more connected with historical ties, trade links, vicinity, remittances, they're denominating remittances, but it's still not quite a safe haven. And safe havens are important for sure because they're essentially the anchor of the financial system. You have a systemic crisis, you don't have a safe haven, where do people go? Outside the system, there would be a crash of the system. So it's essential to have a safe currency. Safe currencies are the yen, the US dollar, of course, to some extent, although less liquid, the Swiss franc, not the euro so far. And there is a question there. Why is it that the euro is still not a safe currency? Maybe because it's so segmented, so diverse domestically. Maybe because there is not a eurozone, a common eurozone government-backed security, but many security from different countries. Whenever there is a crisis in the periphery, things start to stumble. There's an open question. I think so. The short answer would be safe havens are important, it's essential for the financial system, and we have to protect them. The more safe haven currencies there are, the more safe haven assets there are, the better. And the euro, surprisingly, has so far failed to that in systemic crisis.
Yeah, not a safe haven yet.
Not yet.
So what's your assessment on this?
I'll be very short on this one. Eduardo is the expert on why, and I think we can go over on this debate forever. It was mentioned, this debate happened when Catherine was giving us the history of it. This debate has been going on for a long time, right? Why is the euro? It's not out there. Well, currently, the way I would put it is, well, the dollar is still the king, and euro perhaps is the queen. And how things are going to change from here on, we're going to get a chance to discuss as well. But just to add a little bit on what Eduardo said, perhaps, and it came up in the previous panel, the fiscal part of what's going on is also a big part of that puzzle.
Mm-hmm. Melanie, what's your short take on this?
So first of all, thank you also, Martin. I think probably many of you realized that there was a short notice change in the program, so Martin stepped in because unfortunately Julia fell sick, so I'm really thankful to that. Thankful to all the colleagues and organizers of this event. And maybe I should also start with the disclaimer that I'm not, talking from the viewpoint of the Austrian Central Bank, and maybe also more emphasizing that I'm here, talking about the data we have, and that actually I'm sitting here on the shoulder of giants, which actually means that many of the insights I will now share are actually based on work by my OeNB colleagues, especially by Elisabeth Beckmann, Thomas Scheiber, Katharina Allinger, and Helmut Stix. And so the short answer to that, because I think Julia thought that actually Eduardo and I disagree on whether the euro is a safe haven asset, and I'm not going to disagree
we will have time
with Eduardo. I'm agreeing with you that I think it's a regional phenomenon, and I think it is a safe haven asset for people in Southeastern Europe, actually.
Mm-hmm. Okay, so now let's come back to this safe haven issue once again. So Melanie says it is a regional safe haven, but you agreed to this already, Eduardo. But you claim that the euro is not a safe haven currency, and maybe you elaborate still a little bit on your assessment.
Well, it's not fully a safe haven because whenever you have a pandemic or a global financial crisis, people fly to quality, and the euro is not part of that quality. And you've seen that if you see, for instance, measures. I mean, dollarization has many issues, right? But particularly it's financial dollarization that we're talking about. So if you look at the ratio of euro deposits over total deposits in neighboring countries, for instance, which typically use the euro as a hard currency, soft hard currency, during a crisis, those ratios come down. Not so much. It's not the Argentine peso for sure, but they suffer in the sense that they don't move towards as it happens with the yen or the euro. So that's the test. That's it. Yeah, and that the safe haven nature is more of a self-fulfilling issue, like trust, right? because if you see that the euro actually depreciated in the last crisis and you want to find a hedging asset, you won't go to the euro because you will anticipate it will fall in the next crisis. And if you behave like that, it will fall in the next crisis. So it's some circular self-fulfilling prophecy, the idea of having a trusted currency. The same happened with the Shen. The same happened with the dollar. Once the dollar actually fails to deliver on that front, well, people will start thinking about the dollar in a different way. Now, the question is, what happened with the euro? Why the euro can't actually integrate this sort of selected club? What should be done? I mean, this is speculative. At some point, I thought that the whatever it takes, the Draghi's whatever it takes approach to protecting euro assets was enough to actually solidify that the euro behavior. But at the same time, it's actually forcing the ECB to deal with a number of diverse problems within the euro area. It might actually may be counterproductive to some extent. Truly, I don't know what you should do to install the euro as sort of another safe currency. It has the liquidity, it has the economic importance. The euro area is actually growing. So, but it's something there in the track record that seems to behave, that seems to be, at the end of, in the limiting crisis, it looks like the euro typically gives up against the other two currencies. And even the interest rate is typically lower than in other reserve currencies. Not the yen, obviously, but the US. Typically, on average, the interest rate in Europe is lower because it grows more slowly. But even in that case, you don't see the carry trade that you see, for example, with the yen, or it's not a funding currency generally. So, but again, it's like, what makes you the least dirty shirt, what makes you the reserve currency is something that's sort of circular. So it's difficult to find the entrance to that circular logic.
Thank you very much, Edo. Very interesting. Let me turn to Melanie. Melanie, you are a member of the OeNB's Euro survey team. So you have a very in-depth, detailed understanding and about household euroization in these countries. And what does this experience or this knowledge of this data tell you about the current state of household euroization in the region? And what makes you, think that this is a regional safe haven? Yeah. Maybe you can elaborate on this.
Yeah, maybe let me elaborate a little bit on this. Maybe Daniela, you can show the first chart. Thank you so much. So I think probably all of us know that already before the great financial crisis, the foreign currency that was used the most by households in CESEE was the euro, right? So that included having euro deposits, especially in the past. It also included having loans denominated or indexed to the euro. However, at least for some households, it always also included having a substantial amount of euro cash, right? This means if you want to get a complete picture about the extent of euroization within the household sector, you need to somehow get an idea of individual cash holdings, especially on euro cash holdings. That is exactly why the OeNB established in 2007 the OeNB Euro Survey to get these individual cash data, to get data on individual portfolios, right? Because obviously you cannot get these data from official statistics. You need a survey to get this kind of information. And so the euroization index you see here on the chart is actually a combination of official aggregate statistics and the cash data, the euro cash data that we get from that survey, and it shows you the share of euro assets within the overall share, within the overall assets of an individual person in certain countries, right? And what you can see actually, if you look at Central Europe, so namely Czechia, Hungary, and Poland, is that already in 2007, when the survey started, that share was low, and I would say it stayed remarkably stable at that low level. And now, that is maybe the advantage of a survey. We actually ask people at least why they have euro cash, and what you see there, what we have repeatedly seen for these countries, is that the main reason for them to have euro cash is for transactions abroad, meaning they make vacations in euro area countries, or because they do some cross-border shopping, some cross-border trade. This is, I would say, you can see it from the chart, this is different in Southeastern Europe, right? Where in the past, but also nowadays, the euro is also much more often used for domestic payments. So I think it's estimated that half of the cash in circulation is actually euros, for example, in North Macedonia and Serbia. And it's also, that's what people at least tell us, it's used as a safe haven asset. So it's, they save it, they have it as a means of precaution, actually, right? And so you see that in these countries there was substantial progress in de-euroization, right? So there is a substantial decline in most of these countries, but still in all of the countries the share is still at least 30%, the share of euro assets. And if you look at the countries with like historically high euroization rates, so again Serbia, North Macedonia, you see that although like in Serbia we have a steady decline, it's still the country with the highest share of euro assets. And in North Macedonia, after an initial decline in the 2010 years, it actually came to a halt again, right? And then basically, so that is for the overall picture. But now if you basically exploit the advantage of having a survey and looking a little bit more into the details, you see that although the reasons why people actually have euro cash did not change too much across the countries, one reason that indeed became more popular, more important in all the countries is having euros for transactions abroad, right? Within a more connected world, I think that's quite clear, and also with stronger ties to euro area countries. And then there's a change that you actually do not see here, which is a change on the micro level, and that is that actually much more people than 10 years ago hold euro cash. So the spread of euro cash across the populations now is almost universal in all of the countries, right? So I think that's quite remarkable. At the same time, though, within individual portfolios, euro deposits became much more important than euro cash, right? So some people traded cash in favor of euro deposits. That's what you could think. Then again, there are distributional effects. So it's rather the richer part of the population that is having euro at the deposit, and it's rather the less richer part that is holding euro in cash. And that also speaks to a general fact that although the euro is widespread across the population, of course it's not spread to the same extent in all population subgroups. So we see that usually male people, older people, better educated people, those with higher income, those who are self-employed, those who receive remittances from abroad, they are more likely to have euro cash and euro deposits as well. And then maybe something that is maybe becoming even stronger over the years is we find some evidence for network effects. So people who believe that other people in their country have euro cash as well, they are also more likely to have euro cash themselves. And then something that Piroshka already talked about, we still find these clear legacy effects on why actually people in these regions resorted to the euro in the first place. So those who have a vivid memory of past crises, transition crisis, other financial crises, those who have lost money during this crisis, those who distrust their currencies more, they are all more likely to be euroized in that sense. And I will come to an end, but taking all the evidence together, it is quite clear that the use of the euro by households in CESEE is clearly demand-side driven, right? It's people want to use the euro. And so, overall, even after many years of stable currencies, including, currency boards, regulation on foreign currency usage, the use of the euro by households there is a very persistent phenomenon. And for some people, not for all, but for some people, euro cash is still important. And I would again stress again that I think for many people in Southeastern Europe, the euro is still a safe haven asset.
Thank you very much, Melanie, for giving us this in-depth analysis of euroization. And I think from the discussion we see so far that, there is quite some evidence that no matter whether we consider this safe haven question now or not, there's still a substantial degree of euroization. Also, we have a decline. So maybe, Dennis, can I ask you, these levels of euroization, sure enough, they have macroeconomic effects. And how would this, for instance, impact macrofinancial resilience, or what are the implications for monetary policy, and how do geopolitical factors impact on the euroization and policy choices? Maybe you can, from your rich international experience, enlighten us a little bit about this question.
Yeah, and since you mentioned international experience, I should put my disclaimer out there, both for the BIS and IMF. If I was talking here in October, I would say it doesn't reflect BIS views, and now it's November, I'm saying it doesn't reflect IMF views because of my recent job change there. But let me take a step back, and perhaps as a reminder to this audience, particularly, this is nothing that you don't know, but as a reminder, right? When we talk about internationalization of a national currency, we need to think about from the perspective of the issuer and then the ones that are actually ending up using that, the countries that end up using that currency as their own or in their international transactions, right? From the perspective of the issuer, the US, ECB, when you think about it, or UK, maybe we also put, Japan and a few others there. What does a central bank, a country, gain from issuing currency that then gets used a lot as an international thing? We know all about the exorbitant privilege that is going on, but purely from the central bank's perspective, there's exchange rate stability that comes with it. And there's the financial stability aspect because you're basically getting rid of much of the liquidity and solvency risks that may come from currency mismatch, for example, that's getting out of the system. And that's a good thing. It's also a good thing that the central bank that's issuing that currency is basically the conductor of the orchestra and not has to follow, which we can come back in the debate there. Now, from the perspective of the rest of the world, what are you getting into, right? Sometimes this is not a choice. We need to also recognize that. It's just the system, economic forces, political forces, guess the system to be like that, and you're just participating in that. And it's in that context that we know from an international perspective, from the BIS perspective, from the IMF perspective, we know much more, I'm guessing, or we put much more focus on, given the experience and the mandate of these institutions, which is international monetary system stability and giving support to countries that need it at that time, right? And from that, what we know is that dollarized economies, for example, there's a huge literature there. I'm talking next to Eduardo, who has contributed to that. On average, they do see lower inflation. That's the benefit, the commitment device, and the discipline, credibility that we just talked about, we heard about. But at the same time, they also tend to have lower growth, and they tend to have more volatility in their output growth. And this is, of course, this is the average effect. It doesn't mean that all countries experience that, right? But it gives you some sense of what might be going on there. Now, one factor is when there's a domestic shock and you're operating in a dollarized economy, semi-dollarized or whatnot, or as Pruska was saying, you're just simply operating as a small open economy in a dollarized system. When you think about the international monetary system. So what happens is that you lose some of the autonomy, if not all your autonomy as a central bank to react to that domestic shock. And obviously that explains some of what's going on. The other thing is that you get more vulnerabilities, right? And I'm going to link it to what Melanie was saying. It's interesting to see from the asset side, but also we need to look at the liability side. And I'm sure in this audience we have people with very fresh memories of what has happened in Central Eastern Europe when they took out loans, households and small businesses with very little understanding, or depends on the household and small business, but of course, on average, very little understanding of what exchange rate movements could do to their liabilities, right? We had loans in, euro loans in francs being lent to households to buy houses, and then you see the crash, and that was a big issue, not only economically, but also politically, because that's not the kind of default and problem that you can ignore. And many of these countries, Hungary, Czechia, they needed to take action. And that brings in and challenges on its own. Now, having said that, what has the BIS and IMF have been learning from those lessons is pushing more for an integrated policy framework. It's a dangerous world out there when you're not the one issuing the reserve currency. Then you need to complement your policy framework, your monetary policies, with other policies in an integrated way. We can talk about macroprudential policies, of course, that's one thing, foreign exchange interventions, another tool that you have, but also fiscal policy being there and doing the right thing. Now, I want to mention one more thing, maybe geopolitical, we can move on to on the second round. But I want to mention one more thing in terms of the dynamics, the economic dynamics that's going on there. And that's, I think, is important and maybe not as studied as much or realized as much. And that relates to the relationship between commodity markets, commodity prices, and the dollar, right? Traditionally, what we would have seen is that they move in opposite directions. Oil prices would go up, dollar would depreciate, and what it did is actually help commodity exporting countries, in some cases with very dollarized liabilities, it helped them You know, you have the higher oil price shock, but then the dollar depreciates and you don't have to get squeezed from there, right? But what happened in 2021, 2022 is that they moved in tandem. You saw higher commodity prices, at the same time dollar appreciated, right? Why did that happen? We looked at it a little bit with BIS colleagues. Part of it is very unique period, right? 2020 and 2022. We're looking at unusual combination of a risk aversion shock globally hitting, coming from COVID, and then coming from the war, right? Which then happens, the safe haven, everybody rushes to the dollar. But at the same time, it's a very negative, a huge negative commodity price shock. And what has happened is that commodity exporting, EMs in particular, emerging markets in particular, had this compounding effect of, you know, stagflationary effect of this combination, much stronger than would be the case if they were not moving, if the dollar and commodity prices were not moving in the same direction. Now, this is the conjunctural part of it, or the unique part of that episode. Another reason, as we push it, and I would love to hear your views on that, another reason this correlation between commodity prices and the dollar may have switched signs is because the US is no longer a net energy importer. They have become an exporter, and that's important. What that means is that when commodity prices go up, oil prices go up, it used to be a worsening of the terms of trade for the US. That's no longer the case. It improves their terms of trade, it pushes dollar up, and you have this combination of the positive sign that I talked about, and it may be here to stay, and that's something to consider going forward for as a global community, but especially for emerging markets, commodity importing emerging markets that may be on the hook.
Thank you very much, Dennis, for giving us this comprehensive policy overview. I think we have now got a quite comprehensive picture, at least as far as a format like this allows, on the international role, various micro aspects, policy aspects. I would like now come to the second round of questions where we would like to look a little bit more into the futures, and maybe how will Euroization develop in the future as a big question. But maybe I start this round first with you, Melanie. You showed us that household Euroization in Central and Eastern Southern European countries is strongly demand-side driven. And you think it will stay like that in the future? What's your take on how Euroization will continue in these regions?
So the short answer from the micro household perspective would be Euroization will stay quite persistent, so it will stay like it is with the trends we have seen. The longer answer is, I cannot talk about all the evidence that, from the data that led me to this conclusion, but maybe let me emphasize one strand of research we started recently, which is trying to understand how preferences for euro deposits and euro cash are different across different age groups and across different cohorts. So we try to understand if the younger people, are different than the older people, because eventually the younger ones are going to shape the country, and with that maybe also the extent of Euroization. And so we asked people, for example, regularly if they had to deposit a hypothetical amount of money into a bank account, whether they would prefer to deposit this money in foreign or in their local currency. On this chart, thank you, Daniela, you can basically see the share of people who would prefer to deposit this money in foreign currency, separated by certain age cohorts, right? And I think it's quite clear from the picture, I hope you can see it as good as I can, that the younger people, the younger cohorts, are much more likely, are much more willing to actually would much more often prefer to deposit in foreign currency, right? So, I mean, for the sake of clarity, I pooled all the countries we have in the survey together. Of course, there are country-specific differences. Not 50% of the people in Czechia want to, deposit their money in foreign currency, but this kind of age difference, that the younger are more willing to do so, that is actually what we see everywhere. So if you look at that picture, you could even think about that, household Euroization is actually intensifying in the future because the younger seem to be so much more keen on the euro. However, the crucial question is whether this is going to last when the younger become older, right? Because it's one thing that younger people are different than older people. I think we see that in many areas. It's another thing whether they stay like that. And actually, if we look a little bit deeper into this, we rather at the moment see that this is an age effect, actually. So this is not going to stay. So this means if the when the younger people become older, they actually become more similar to the older cohorts, and the preference for foreign currency deposits is actually going down again. There's one, I think, notable exception, to this kind of age pattern, which is the very oldest cohort, which is people that are born in the 1930s, because they are much more likely to prefer foreign currency deposits than you would predict given their age. And like my guess about this would be that these people born in the 1930s, they were close to retirement age or already in retirement when the transition crisis happened, so potentially at least some of them lost quite a substantial amount of retirement savings back then. That could explain an elevated preference for that. So there are not so much differences actually when it comes to deposits. For cash, it's a little bit different. So if we have similar questions for cash, because there we see for all the people before the transition, they are relatively similar. There is this age effect, so younger people prefer deposits, prefer saving in deposits rather than saving in cash, but this is going to change when they're getting older. However, there's already a change that starts with my cohort, actually, so people born shortly before or during the transition, because these people are much more likely than you would predict by their age to prefer to save in cash instead of deposits in the region. Right? So although they are still relatively young, I would consider myself relatively young, their kind of cash preference or their preference for saving in cash is elevated. And if you look a little bit deeper into that, you see that this seems to be related to the fact whether they can also remember periods of high inflation and whether they can remember periods when access to bank accounts was restricted. Many of these people cannot remember such periods because they were quite young when they happened the last time, but apparently for those who can remember, these periods marked such critical events that it might have had a long-lasting impact on their cash preference. Then another shift in generations is then again the generation that was actually born after the transition, so Gen Z people basically, they are less likely, much less likely than predicted by the model to prefer cash over deposits, right? I mean, they're already predicted to like cash less than the older people, but they're even less likely. And there we see this is not so much related to experiences or the lack of experiences. This seems to be maybe more related to the global phenomenon that younger people are not so much into cash anymore. However, given that, it's really hard to tell, for example, how Eurocash is developing in the future, right? Because the two youngest generations, let's say, are drifting apart in opposing directions. So on the aggregate level, it's not so clear what is coming out of that. I think the general gist is still that the cohorts are not so different. People at different ages, they are not so different, although I know this picture suggests something else. It's just that they are at different stages of their life. And I think this is a striking finding in the countries we're looking at, because we would expect a different. We would expect a generational shift, because we know that all the older generations, they experienced much more severe crisis than the younger people. We should expect that they are somehow different, but this again speaks to what I mentioned before, the legacy effects, and also what we have observed in several pieces of research, that this crisis experiences, it even transfers through the generations, right? Maybe to give you another example, again talking about that we ask people whether they can remember periods of hyperinflation or not. And naturally, most of the old people can, but even some of the youngest people can, although it's not even possible because they were born after the last hyperinflation event in their country, right? So it really seems to be the case that younger people inherit the crisis legacy from their parents, from their grandparents, and with that also partially their preferences. And so, I mean, given that, I mean, maybe I don't think it's too bold to say, but my final assessment is from the data we have, from the data we see, we do not have reason, or I do not have reason to believe that the demand for euro from the household sector in the region is going down a lot in the near future. I mean, some patterns might change, but the euro will stay popular.
Okay, very interesting, Melanie, but let's take this conclusion of you for granted and say that we do not expect that the demand side moves very much. Eduardo, do you think this is something that should be addressed by regulation? And if so, what could regulation do about this, if it should be put in place at all?
I think it's interesting to make a difference between different aspects of of dollarization, because sometimes we mix things up. I remember when I started this agenda in the 90s, we used to look at deposits as a function, as a proxy dollarization, but those deposits were about time-bearing deposits and side deposits, and people were relating this with inflation. And only side deposits or real balances were related to inflation. The others were related to the interest rate differential, volatilities, etc. So what we mean by dollarization is different things. If we think of dollarization as an asset substitution phenomenon, we are talking about the store of the use of the foreign currency, store of value. That we already have. We mentioned about the reserve, which is different from safe currency, because safe currency, the safe haven currency is more like a hedge. So people may use the euro or the dollar as a stable currency, as a store of value, but then, when you're in peril, in fear, you move towards the safe haven. So they have slightly different uses. But then there are transactional demands for dollar or euros, and that's where we enter into remittances or trade invoicing, for instance, which is transactional in a sense. And in the case of the euro, it's more regional, because if you look at, for instance, shipments of banknotes, it's typically going to the neighbors, as you mentioned. And if you look at trade invoicing, it's typically trade that's going to Europe, as opposed to the US dollar, which essentially invoicing everywhere in the world. So it depends on what we are looking at. I think that countries have been fearing financial dollarization for good reasons. I think Dennis mentioned a couple of ones, but essentially all emerging currencies or emerging market currencies were currency crises in the 90s. We all know that. At the end of the day, there are mismatches there. If we have dollarization somewhere in the economy, either at the commercial bank, but typically because commercial banks are limited by regulation, at the asset side of the balance sheet of a commercial bank, there is a currency mismatch, and then if there is a real devaluation, bad things happen, right? So meaning countries have been costly de-dollarizing, typically after crisis. Mexico since 95, Brazil in the 2000s, Argentina after the crisis, Peru in the 2000s as well. I'm talking about Latin America, but there are countries, for instance, Georgia. I've been advising Georgia on de-dollarization. They've been trying to de-dollarize for the past almost 10 years. So you have that trend on the one hand. Countries will try to de-dollarize and de-euro-ize. It's funny because last time I was here 20 years ago, I was talking about the same issues. I was mentioning Croatia and Bulgaria. I said Croatia is playing the convergence game. It's probably win. It's a dangerous game, because if you stay halfway, you're in the worst situation, because you are dollarized or euroized, but you don't have the ECB. And that's a complete difference. It's completely different to have a currency war, because in a currency war, you have a foreign currency. If you are within the Eurozone, you have a local currency, particularly if the drag is whatever it takes. So Croatia won, actually played the game and won. Bulgaria is in the worst position ever, because it's essentially dollarized or euroized, but nobody will come to the rescue. Mm-hmm. So countries are trying to avoid that situation. Some countries are playing the convergence games, which is dangerous, and if it's too long, it's increasingly dangerous. And some countries are simply taking the risk and being aware of those risks, trying to de-dollarize. So if you ask me, the dollarization is going to decline in the future, because many countries, including Eastern Europe and in Asia, mostly in Latin America, have been successfully de-dollarizing because of this balance sheet effect, because of this currency mismatch that led to currency crisis. That's only one part. Now, on the transactional side, it's a completely different game. For instance, think of geopolitical problems. If you weaponize the dollar, you will want to transact in the substitute, the European substitute. And Europe actually making good progress to substitute SWIFT, for instance. And as the Eurozone actually improved the payment system, they might gain some participation at the expense of the dollar. It's not that people will be dollarizing and euroizing, but you will be competing for the euroized part with the dollar, against the dollar, right? I mean, countries that de-dollarize in favor of their local currency. Countries that want to get out of the area of, get free of US sanctions will be euroizing at the expense of the dollar. There are different games here. The same with the digital currency. I'm not sure the ECB will ever issue a digital currency, but I'm sure the Fed will never issue a digital currency, so you may compete there for transactional purposes in neighboring countries which are already using a lot of euros for transactional purposes, remittances, trade, border issues, whatever. So there are two countervailing trends here, but they pertain to different uses of the euro. One is transactional, the other one is for financial purposes. I think financially, the countries will start to de-dollarize or de-euraize because of prudential reasons, so I think they're right to do so, even at a cost. In transactional terms, I think the euro has much to gain.
Mm-hmm. This is very interesting, Eduardo, because you made it very clear that we have these countervailing forces at work, which then gives us a somehow ambiguous picture what we should expect in the future. But maybe, Dennis, you could help us and the audience to put this more into context by explaining from your understanding what do these foreign currencies, this euroization, dollarization, play more generally which role do they play for financial stability more generally? Because this helps us a little bit should we think about these trends or expected trends or suggested trends?
I first fully agree with the points that Eduardo made. You can do things on your own, and then who's holding your back, right? And I can get into a whole international financial safety net debate there, but let me not do that. Now, again, it's about what we know in the current environments, right? And we do know some things, we still don't know a lot in terms of how this whole geopolitical currents and the recent developments, the on-the-ground preferences of household businesses, how they are changing the way we think about international currencies, right? Well, I'm saying that because, BIS, IMF, they have together with their partnerships, some of the private corporations, they have the best view into how currencies, what currencies are used in international transactions, in trade, in financial services, reserves, and even they have blind spots. Right? It's about a matter of which countries are reporting on what type of instruments and whatnot. Again, we held a workshop on that in October, and it was just amazing. Even the people who know a lot about this, what questions that they cannot quite answer. Now, with that caveat, what do we know? Just as a regularity, we talk about economics running the show, or that's how, as economists, we like to think. It's economic forces. You cannot just stand in front of them and nothing happens. But obviously, politics also get into the picture. And we do know that between 2009 and 2021, if you look at the investment, on FDI, on portfolio investment, on bank credit, cross-border lending, what you see is that actually the investing countries tend to do much less investment with countries where they have less agreement on political issues. Right? And the typical way this is measured is some kind of UN voting distances that goes on UN votes. Now, what has happened, so I mentioned 2021, that's where we kind of stop with this type of analysis. And since 2022, also considering the delays in some of this data, so take it with a grain of salt, but what seems to have happened after the onset of the war in Ukraine is that between bloc trade and financial flows declined much more than within bloc. So what you see, say, US and US-leaning and China-leaning countries, taking this as a defensive kind of situation, what you do see is that US-leaning bloc continue to trade, continue to invest on each other, and China the same thing, but across them we just see a decline, right? Now, one other thing that we have seen is that emergence of connector countries. So what is declining between blocks is not necessarily going away. It's just finding other ways, right? Why I'm saying all this is that going to the financial stability impact, when you have a full view of bilateral flows, which we, as economists, econometricians, we long for, right, policymakers, if you have full information, who holds what, in what format, and everything, you can assess the risks and be prepared for them. With the connector countries, it was always there. We also know, especially on the financial side, right? Now things are getting more complicated, right? And that poses additional issues on how we think about international financial stability. Now, the currency dimension of this can also get quite murky, and there's a lot of debate. As we said, is this the time dollar's role is going to change, and King Dollar no more? Again, as far as we can tell, there's not much change there. Here and there, we can debate on the data, but even the sanctions, even after the sanctions. And there are reasons for that. Network externalities was mentioned. It's not easy just to, oh, you don't like Facebook anymore, okay, I'm going to shut down an account and I'm going to hang out with people on Instagram. It's not like that, right? You cannot just shut yourself out of the dollar system so quickly. There are big network externalities going on there. Now, having said that, we do see a bit of a rise in the Chinese yuan, right? But again, it's not a true international use, because where we see the yuan being used more in international transactions is happening, again, with the countries and in transactions within countries that are already in China's orbit. So that's another thing to take into account. Now, I want to now move more to the political side of things, if you would. And remember the disclaimer, right? My own views. Now, in 2018, the European Commission, and I know we have representatives here, called for a stronger international role for the euro. And they have been taking steps and issuing, communications and strategies on how to do that. And there are several pillars there. Capital Markets Union is one. Payments infrastructure that was mentioned in the opening is there. Energy invoicing in euro, if possible, that's there. Sanctions regime, making that more clear and more implementable, is there. Now, it's not surprising the Commission is coming up with this proposal and thinking of these questions, given its role in the European system, right? What is perhaps, I'm going to argue, is a bit more unusual is how ECB's stance has changed. Since the inception, and I'm going to cite Willem Duisenberg here, in 1999, he said, the ECB takes a neutral stance with respect to the international role of the euro. And since then, there is a lot of debate, as we said, but the ECB's approach has been purely technical, approaching it with a depolitization view. Euro is not its international role, its international usage is not about politics, it's about economics, right? And their technical analysis would support that, the pros and cons of internationalization of the euro. Now, I'm going to cite a few other speeches that are more recent, and from Christine Lagarde, and there she was saying it's important to assert the euro's international role and calling for not compromising independence, but recognizing interdependence between policies and how each can best achieve our objective if aligned behind a strategic goal. So that's the change. Let's put it that way. From depoliticizing the international role of the euro, it looks like we're shifting to a framework, a thinking, where the international role of the euro is actually geopoliticized, if you would, right? Now, these are not happening in a vacuum, obviously. I mentioned, the debate seems to have shifted in 2018, 2019. Actually, I looked at the speeches, ECB speeches. Between 2006 and 2018, there were 15 speeches mentioning the international role of the euro. So roughly one per year, right? Since 2019, just 5 years or so, there were 33 speeches, and the tone has changed as well, right? Why is this not happening in a vacuum, 2018, 2019, remember what has happened, right? We had the sanctions, and then we had the Chinese push to support the use of renminbi as an international currency, and we had the digital currencies, including from the private sector. So there's competition there, right? And it's understandable that this shift is happening. Now, interesting question. If dollar is dethroned, let's say, and if euro cannot take the first place because of some of the reasons we alluded to, then the interesting question is, well, who's going to be sitting on the throne, right? And I don't have an answer, but it looks like some writers in Hollywood might have. So I'm going to finish with a description of a scene from a recent movie called The Civil War. If you haven't seen, it's not truly entertaining, but still interesting movie. And so what happens that the protagonist, who's a journalist, walks into gas station, and looking to buy gas, right? And she says, I'm going to pay over the odds. And the guy attending the gas station asks, what do you mean? What's over the odds? And she says 300 for a tank, half a tank. And he laughs and says, 300 will get you a sandwich, right? And she responds, 300 Canadian. I'll stop there.
Thank you very much, Denise. We have now got a very fascinating overview from all of three of you. Now it's time to involve the audience, so please take the opportunity to jump in and ask questions. I have a first question here, and one in the background, and one in the front. So lots of questions. Start with the gentleman in the middle. Maybe you briefly introduce yourself before asking the question.
Thank you very much. I'm Kristóf Lehmann from the Magyar Nemzeti Bank, Hungarian Central Bank. I have a question towards Melanie about the regional euroization. You touched upon the story behind as a factor that is related to history. Unfortunately, Boris just left the room, but I'm giving a compliment to the Croatian Central Bank because there is a fantastic paper from 2018 about euroization in Croatia. And that paper suggests that basically it's a very simple relationship. The number of digits of inflation in the 1990s in these countries explaining how strong the euroization is. So whether it was a hyperinflation or only a high level of inflation. I don't know whether you agree on that, on this point, or there are other factors that are extremely important in explaining euroization here in Central Europe. Thank you.
Thank you for that question. So I haven't heard of that paper yet. Sounds super interesting. It's not only past inflation experience, right? So it's also a lot about depreciation experiences, which of course, like sometimes or most of the time, go hand in hand with inflation experiences, and it's something. I mean, like I don't know. Like we just mentioned Bulgaria, which has had like super high inflation rates in the 90s, which is actually now doing like in terms of de-euroization better than many other countries that we have seen on the chart, right? So I'm not so sure whether this correlation is like holding everywhere. It seems to be the case that at least it's not. Yeah, it's history, and it's not maybe only necessarily related to inflation, but the general loss of savings, and with that also the general loss in certain institutions, and also in your own currency, which is not, I think, only related to inflation. And moreover, we always talk about the transition crisis, but and recently we also started to think more about asking people also specifically about other crises they have experienced, right? Because that was not the only crisis in the last 34 years in these countries. And we see that also other crises are at least triggering maybe, this kind of history again. So it's not only like, maybe the event that happened 30 or 40 years ago, but it's also at least triggered again or maybe revived again by what is happening more recently. And maybe like for younger people, that might also be related to the fact, they never experienced, these periods. We have, it's 2024, so we have many people that never experienced the hyperinflation periods in the 90s, but they still have this euroization tendencies, right? That's what I have shown before.
Okay, we had a question in the back. Thomas.
Thank you very much. I'm Tomasz Salcik from the Central Bank of Austria. I'm the guy behind the cartoons that Birgit showed in the previous panel, but I only was asked to look them up, so don't nail me down on those. I have a question for Eduardo. There are two countries which are not EU members yet, but they are candidates or potential candidates. Two countries that are fully unilaterally Euroized already. That's Kosovo and Montenegro. And I wonder if those countries one day become EU members and also Euro area membership candidates, how should they reconcile the ERM2 Maastricht criterion with the fact that they are Euroized, unilaterally Euroized already? Do you have a view on this?
I'm not an expert on the conversions game, but I can tell you one thing, is that they have all to gain. I mean, they cannot lose, this country, because they have already incurred the losses of unilateral dollarizing, with one benefit, if you want, is that they can't have a currency crisis because they don't have a currency, and that's the same for El Salvador, Ecuador. But they don't have any fiscal stabilization process or integration that can actually smooth out the consequences of not having an exchange rate to smooth out, particularly the down cycles, because exchange rate fluctuations are good, not for the expansion, but typically for the contractions. Right? So, no, I don't know how, I mean, I don't know about the Maastricht Treaty, really, but I think they're ready to go. I mean, for them it would be a win-win situation because they cannot do worse than being unilaterally areaized.
Okay.
So, no, I think, but I don't know whether there is anything else that I'm missing here they have to comply with, but they're already there. And they will win for sure, going from a foreign currency to a local currency, which is exactly what they would do if they adopt the euro. They are adopted by the Eurozone because they already adopted the euro.
Thank you, Eduardo. We have a question in the front row by the gentleman here. Can you please bring the mic to the first row? Sorry, we need the mic because otherwise you cannot be heard in the room.
Thank you very much. Peter Chubanov from Bulgarian National Bank Deputy Governor. So my question is to Eduardo as well. You mentioned that Bulgaria is in the worst position in terms of dollarization, etc. Yeah, okay. But however, we could see from the graph that we have really this de-dollarization, de-euroization process, and it's normal because the story is that Bulgarian Currency Board has a confidence in it. It promotes fiscal discipline, which is maintained now in broad terms, but however, yet maintained. We have first or second best in terms of government debt to GDP. So I couldn't agree that we are in the worst position. I could agree in this that our win-win strategy is to be as soon as possible part of the Eurozone at this point in time because of the fact that we are already part of the banking union. And when you are part of the banking union, not being part of the Eurozone, it is a mess. So it is not a good thing. So I agree that our strategy is this, and unfortunately on previous round when Croatia was accepted, the political situation of the country was the reason why we are not accepted, and we as a central bank now are doing our best not to be the case now. So if you could elaborate some on this, thank you.
Eduardo, before you answer, I would like to take the last question, which is related by Piroshka.
It is related. It's related. I just want to support the Deputy Governor's point through another additional point, and that is that the Eurozone and ECB policy rather has changed because they provide almost like a standing facility, this liquidity support.
So it's like a monetary treaty.
Pardon?
It's like a monetary treaty.
No, it's a currency swap, that they provide. Okay. And in the case of Bulgaria, it's a swap, not a repo. So you don't have to have, you have your own currencies, as a collateral. And Bulgaria has benefited from it, as did Croatia at the time of the global financial crisis. So when you have that type of facility, then the cost associated with this type of risks is done. And on top of it, you're paying a lot of transaction costs because they have to still exchange the currency even though they have fixed the exchange rate forever. So.
Eduardo, you can.
Okay, so I say it was a worse position because you have the balance sheet, the currency mismatch embedded, but you don't have recourse to a, in this case, euro liquidity line, which now I learned that you have, so that makes things better. I'm from Argentina. We have a currency board for 10 years, a mixed currency board. We have 30%. That was nothing, but the rest was essentially real reserves. And we lower inflation more in that region, and we have a more volatile business cycle, like the literature predicts. And at some point, we have a currency crisis, and it was disastrous because we didn't have the money, and we have money for some time from the IMF, but that's not real money; it's short term. And that's what I meant. I meant that if you really want to, I wouldn't abuse of the exchange rate anchor, let alone engage in a currency war, unless I have an end game, a clear end game of conversions. Now, I imagine that Bulgaria has a clear end game of conversions. Croatia did a great thing. Bulgaria is taking longer, but I think the game is there. You're making a bet. If you don't get there, or if you didn't have this liquidity line, or in the case of Argentina, we actually tried to have a monetary treaty with the US, but the US said, we are okay, and the Secretary of Treasury, but then Congress will never approve that. So that was the end of our dollarization attempt. So if you're halfway, that's sort of problematic from the exchange rate perspective. Now, inflation obviously responds, as you predict, but it will give you more volatility and more financial fragility next time you have a systemic crisis. But having the line is important. Having the end game is essential.
Thank you very much, Eduardo. The stage timer tells me that we have already exhausted.
There is someone, I think, on the remote line.
Martin, we have one question in the chat. How does the US fiscal position, that is large deficits, affect the international role of the dollar? And do you think it can maintain this dominant position with the current projected fiscal policies?
Does somebody want to take this question, but only briefly? I cannot allow too much.
So far, it hasn't. Because we all need a safe haven, and the safe haven is always the least dirty shirt. Apparently, still, the US still is.
So, no more questions allowed. We have really exhausted the time. It was a very interesting panel. Thanks so much, Eduardo, Denise, and Melanie, for fantastic contributions. Thanks to the audience for your questions and all the engagement. And now I can invite you for lunch that is served outside, please.
Welcome back, ladies and gentlemen. I have the duty and the honor to substitute for our Vice Governor, Professor Gottfried Haber, who is also one of the victims of sickness, and it is a big honor that I can introduce you to the afternoon session and then to the keynote, the second keynote today, EMU in Times of Crisis, delivered by Joshua Eisenman. We have today already discussed various aspects of the euro, the role the euro has played and still plays today for economic convergence in the euro area, the importance it has gained outside the euro area, and especially in the neighboring Central Eastern and Southeastern European countries, and the prospects for the euro as a global safe asset. Let us now look at the convergence process in Central Eastern and Southeastern Europe and how it is affected by the euro area monetary policy and more generally by monetary policy spillovers. What determines resilience against these global monetary policy shocks? How do the spillover channels work between the euro area and the CESEE countries, as we call them? Do countries with fixed or floating exchange rate regimes fare better in absorbing shocks? And how does the federal funds rate impact on emerging Europe? I could not think of anyone better suited to enlighten us on these questions than Joshua Eisenman. Joshua is professor of international relations and economics at the University of Southern California and a research associate at the OeNB. In his life, he has held various positions at several US universities and the Hebrew University of Jerusalem. He has also worked as a consultant for major international financial institutions. His publication record is impressive, to say the least, and I'm very proud, I've never done this before, to present one of the top 5% of authors in economics globally. In his research, Joshua focuses on international reserves and exchange rates, capital controls, and fiscal and monetary challenges in emerging markets. I think it's fair to say that he has often pioneered research in these areas, and he continues to be highly influential in this field. It is now my great pleasure to give the floor to our second keynote speaker, Joshua Eisenman. The floor is yours.
I would like to thank the organizers for the opportunity to present to you an overview of a research agenda that goes back maybe 15 years on my end. And half of the presentation here is related to a new paper that I wrote with Jamal Sadawi from Paris University 8. But in the process, I'll also go back to a sequence of maybe 5 or 6 related papers that are, I believe, related to the issues at hand. So let me point out that the CESEE countries experienced outstanding average growth during the 2000s. And we heard about this before. However, new obstacles appeared after the global financial crisis and the euro crisis. Many CESEE countries are challenged presently with the quality of institutions. For some countries, measures of quality of the institutions stalled. For some, even got worse. CESEE high average growth during the 2000s does not guarantee future performance, and the headwind associated with the growing geopolitical frictions and challenges and demographic challenges will challenge the growth of CESEE. In the past, it's fair to say that the high growth rates of CESEE countries were held substantially by the generosity of the European Union cohesion policy. This successful convergence of most CESEE countries and the geopolitical headwind affecting the EU and the ECB may reduce the future generosity of these allocations. In addition, the EU countries that have kept their currencies, and most of them manage their monetary and exchange rate policies competently, frequently applying their version of inflation targeting, may face growing headwind, potentially from the EU, to converge down the road towards the euro. And we heard earlier the debate about the virtue of it for Poland and other countries. So let me focus for a moment on this chart, which is focusing on the summary of the quality of CESEE institutions over time. And notice that there is huge volatility and variation. A portion of countries experience an overall stable trajectory, Slovakia, Slovenia, Estonia, and the like, while other countries experience large volatility, Poland, Turkey, Hungary, and the list goes on. Now, an issue that definitely turned out to be part of the convergence is that some of the countries will be challenged in terms of their institutional capacity to deal with the risk of getting old before getting rich, overlooking the coming demographic challenges. So if you're looking at the average live birth per woman in these countries, it dropped substantially. It used to be 2.17, well above replacement in 1980, and it collapsed to about 1.5 in 2017. Now, if you are going back maybe 60 years ago, so among the pioneers dealing with the challenges associated with this trajectory, Gary Becker was among the first that, together with the co-authors, including Murphy and Tamura, and later Galore and Weil, pointed out that in the modern economy with endogenous fertility, the kids' quality-quantity trade-off is, in the future, the key margin that households will be challenged. A sustainable growth equilibrium may be characterized by low fertility and high investment in human capital, something that, according to this classification, is the trade-off towards investing much more in educating the kids and reducing the number of kids. And the growth rates are determined in this configuration by the investment in human capital. And some of these insights may be pertinent for the growth sustainability of these countries. In general, this issue is grappling practically most emerging markets. Not all. We know that Africa is still not subject to this configuration. And here one should know that effective education is preparing the younger generations for the challenges of the modern economy, where more than 70% of the GDP are services. Now, this requires quality, stable institutions and funding affordable education. The role of quality institutions in achieving this goal is highlighted, among others, by Chatty et al., and Chatty wrote more than maybe 5 papers on this, Hanushka and Holzmann, and the like. Failure to deliver a comprehensive quality education results in low and stagnating growth, inducing educated skilled workers to explore better opportunities in other EU countries or sometimes overseas in Canada or Australia, or whatever will be the immigration policy of this, if you wish, safer havens in the future. An alternative mechanism to ease the skill gaps is by encouraging selective immigration of skilled labor. Now, this policy requires quality institutions that welcome skilled labor immigration and also societal support of these goals. The rise of anti-immigration parties, both in the context of the EU and also now in the US, will challenge substantially this option. Now, the collapse of fertility of cheese is really in line with convergence to the situation in Europe. So the Eurostat report pointed out that 1.46 live births per woman were registered in the EU in 2022. So de facto, the cheese countries on average are there. Yet, population aging challenges are much harder to deal with in poorer countries with limited education capabilities and capacities, nationalistic sentiment against immigration, and mobile skilled workers, which the last item is what in the past characterized the EU. The inability to adapt institutions to the challenges of getting old before getting rich may reflect the well-known biases in behavioral economy. The first presumption is that most systems follow a linear path. But the collapse of net fertility implies an exponential decline in population. And among others, Benarzi and Thaler and others worked a lot on these linear biases. So let me now turn to issues that are more related to business cycle frequency, because the depopulation of emerging markets is something that is more related to the intermediate long run. So in the paper that I mentioned with Jamal, we focused first on the attempt to verify how CESEE countries manage to deal with the externalities propagated from the ECB in the context of the events from 2005 to 2023. So let me focus your attention to this chart, and let me explain what is there. The top curve that is the reddish is registering the euro area shadow rate. And this takes into account all the extra policies of quantitative easing and other policies. The blue curve is the ECB deposit facility rate for the euro area. And what you see in the green curve is the US dollar per euro. And maybe it's not clearly enough, the shaded area there are representing a regime. So if you are looking at, for example, the first shading area, so this is the tightening regime that took place from 2005 to 2008. So there are about 4 or 5, depending on the scheme that we are using, cycles during that period. So our attempt is to identify what type of policies of these countries helped them to buffer themselves against this, what we are referring to as externalities, in the sense that they practically don't influence the policy of the ECB. On the other hand, they are exposed to the outcome of these cycles. So we find that limiting inflation, active management of precautionary buffers of reserves, current account surpluses being characterized by lower deficit, better financial development, and institutional quality during a given cycle are important predictors of resilience in the next cycle. So the main idea is to look at the end of each cycle and to condition on the characteristics at the end of each cycle, and then to verify how this explains the resilience of growth in the next cycle. And here we have not more than 4 to 5 cycles of that type. And we identify the, among other aspects, some institutional variables that enhance resilience, including efficient management of buffers, current accounts, financial institutions, and other structural factors affecting the ability to deal with the spillover effects. And in the process, we identified also the need to buffer against not only the ECB, but also against the Fed policies. We also validated that the US Federal funds rate strongly influenced the CESEE's performance and resilience during the ECB monetary cycles. Financial development and central bank independence have asymmetrical effects between easing and tightening cycle. Greater central bank independence significantly limits depreciation during the tightening cycle. And higher financial development is associated with lower coefficient of variation of growth and helps to stabilize growth, especially when growth is highly dispersed during some of these events. Now, greater political tensions may reduce CESEE countries' opportunities to join the global value chain, and this is touching the coming dominance of the geopolitical risks. So time will tell how long we will live in the new regime, yet some of the CESEE countries may instead play the role of connector countries between different opposing geopolitical blocs, as may be the case of Turkey's alleged ghost trade with Russia, a trade that has strained Turkey's tie with NATO allies. So let me point out, oops, I think that, let me double check, yeah. So the mid-low income countries, CESEE countries, will face growing challenges associated with, let me double check. I'm afraid that you loaded not the last version that I emailed, so let me only double check it. Yes, okay. So too late now. I was asked to add material to the first version I emailed, and I don't see it here. So let me maybe tell you what I added following the request of the organizers, which is not here. We attempted, after covering the CESEE, to replicate and to discuss other previous studies that we did dealing with it. So let me maybe flip to my notes, and my apology for this mishap. So the point that I would like to make is that we did with Jamal and other team members an earlier study with the same design, focusing on monetary cycles in the US from June 2004 until September 2023. And the design there focused on the way that the 5 cycles that happened in the US during that period, tightening, easing, and the like, impacted emerging markets. And we integrated the 5 cycles such that we did the same exercise that I described before, controlling for the conditions, key variables at the end of a cycle, and then explaining what is the association between these conditions and the actual performance of emerging markets in the next cycle. And in that paper, we investigated determinants of emerging markets performance subject to 3 measures of resilience. So one measure of resilience was focusing on the growth rate. The second was focusing on the bilateral exchange rate against the US dollar, exchange market pressure, and then country-specific Morgan Stanley Capital International Index. So among the results, we identified that similar characteristics to the one that I mentioned in the previous discussion for CESEE. We found that macroeconomic and institutional variables associated with emerging market performance, determining the determinants of resilience differ during tightening versus easing cycles. Institutional quality matters more during difficult times, and we find that current account trajectory, international reserves, inflation, all are important determinants of emerging market resilience. Now, let me also discuss another case study, and this goes back to the first paper that we did in the sequence focusing on case studies that dealt with the first tightening cycle that came during 2021 when the US monetary tightening cycle started. And this paper was conveniently discussed favorably by the economist shortly after publication. So the main point of that paper was to illustrate the fact that countries that managed effectively their international reserves properly managed during the tightening cycle to protect themselves against the coming depreciation of their currencies. And this, of course, implied that they follow policies that were quite similar to the policies that, say, Russia adopted under the latest management of the central bank, that in good times, one is hoarding reserves in a proper way to prevent overheating the economy. And in a bad time, this is the time to reverse and then to do what it takes to prevent massive depreciation of your currency. And it turned out that these type of policies were adopted as a protective measure by most emerging markets following the sequence of the sudden stop crisis that were the topic of the imported agenda. And my recollection is that Guillermo Calvo started that agenda. So for a lot of these emerging markets, this was déjà vu. They knew how to do it, not because the IMF told them. In fact, the IMF, if you recall the time of Stan Fischer, was against this policy. But conveniently, when Stan Fischer moved to become the governor of the Bank of Israel, he conveniently reversed it, rightly so. And my interpretation of his reversal was that he listened to Raghub Rajan providing the famous speech warning of the coming crisis. And then apparently he was among the two that believed that Raghub nailed it down, and then Stan Fischer, that was against managing reserves, did the opposite after returning to Israel, and definitely helped all the countries that are doing it benefited. Now, in this case study, we found definitely that the effect of proper management of the reserves is economically significant, though there is no free lunch, but definitely countries that didn't follow this were hammered. And in this case study, we also showed several examples of countries that were hammered, and one of them, the obvious one, is Egypt, that didn't follow the policy of Stan Fischer when he was a governor. But of course, Egypt is characterized by challenges, and at that time they were hammered, and partially this was related to the fact that they rely very heavily on capital inflows, and these reliances included also heavy exposure to Chinese presence in building the new Cairo. Let me skip the details. So the bottom line, in this paper, we definitely convince ourselves that management of reserves and other buffers is very important. Now, let me put it maybe in the context. Yeah, I have the time. So let me put it in the context of Ray's famous 2013 dilemma, not trilemma argument that was also introduced in Jackson Hole. So if you recall, and we heard this before in the morning today, she concluded that the original trilemma of Mondale Fleming is practically dead. So her interpretation was that considering the global importance of the US and more specifically the policy stance of the Fed, indirectly the US Treasury, the only way that countries can protect themselves against the global business cycle that is dictated by these policies is by imposing a wall that prevents capital mobility. Now, I belong to the camp that was skeptical about the strength of her argument. And in a paper with Chin and Ito in 2016, we pointed out that unlike the prediction of Professor Ray, the exchange rate regime definitely matters econometrically, as well as the ability and willingness to manage, say, inflation targeting in a way that is sensitive to buffers. So let me not bore you with this, but at the end of the modified PowerPoint, you can find all the resources. So what we found is that an economy that is insisting on pegging themselves to, say, the dollar is mostly exposed to the dollar cycle. And other countries that are choosing more selectively their policies are gaining a degree of freedom. And one advantage of managing reserves properly is that if you are using inflation targeting, this allows you to spend more attention on dealing with your internal challenges related to the patterns of inflation and growth in the economy. So for us, the case that Helen Ray did is problematic, and let me point out one issue. The only country big country, that imposed the wall is China, okay? Now, if you are a Chinese billionaire, as long as China is still trading globally, it's well known that there are ways of trade misinvoicing, allowing a Chinese billionaire to move the money to Canada or to Los Angeles. And let me skip the details, but during the financial crisis, chances are that we know from the data that Chinese investors bought a fair share of the real estate in poor places like Santa Monica and the like. So the bottom line, for a Helen argument to be correct, we need really a system that will block trade misinvoicing and will block the hobby of multinationals to play their game of misinvoicing. Of course, they are not the same, but we have, I'm referring now to the voice of Chin and Ito and other of my co-authors. I think that Hélène is definitely correct that the US is generating exposure to its business cycle as an externality. But in another paper with Chin and Ito, we pointed out that to a degree the same applies to the ECB, although the dollar is much more important. So we are still not convinced about the veracity of raise points. Now, ironically, when we heard this, so we looked at our research, and I'm referring to Chin and Ito that I'm collaborating for maybe 20 years. So in a paper in 2019, I summarized this in economic modeling in the following simple, I think, intuitive way. If you recall, the Mondale trilemma was done at a time that capital mobility was practically absent. And if there is no capital mobility, so then there is no substantial exposure to sudden stop crisis and to instability that occasionally is byproduct of inflows in and out depending on risk-taking appetite and the like. So once that we moved towards financial integration, and most of us were surprised that Mexico and other emerging markets, after the massive sudden stops, chose to open up themselves to capital mobility, and over time, they gravitated to inflation targeting. So once that this is the case, central banks and treasuries should worry about financial stability. Now, in the trilemma, in order to deal now with financial stability, it would be nice to have new instruments, because at any rate, there's scarcity of instruments. So we concluded that new policy instruments were added to deal with financial stability. The added instruments included macroprudentials, managing buffers, and swap lines for whoever that has access to swap lines. And we know that at a later stage, the Fed changed the swap line policy, but let me skip this part. Developed and emerging markets countries used a different mixture of policy instruments that as long as the central bank is independent and as long as the quality of the management is high, each country can choose from a menu of these options, and there is no free lunch, but financial stability concerns is precisely the result of opening yourself to capital mobility, but I'm skeptical if there is a way to reverse this without going back to a version of a Bretton Woods system, which is practically dead. Now, these results are, in my view, also in line now with the IMF recent overview. And let me now relate to, again, it's not here because of the mishap. So there is an interesting paper at the IMF summarizing the in-house, and let me state the main results. Evidence, and I'm citing the paper, and the reference is the end of the presentation. Evidence shows that in emerging markets, a proper introduction of macroprudential measures, foreign exchange rate intervention, and monetary policies reinforce each other, and applying these policies simultaneously can have a large impact on credit mitigation exposure to the global financial cycles. So it's fair to say that the IMF, after a lot of research, as far as I am reading this, converged to this presumption that Mondale Mondel's trilemma is still alive, but one should adjust it methodically to the degree to which we can control all the illicit or legal capital flows that are generated by trade invoicing, by all the accounting tricks of Google, showing the path to others, how to minimize taxes, and the like. So let me now jump to the concluding remarks, which is stated here. So the mid-low income cheese countries will face growing challenges associated with getting old before getting rich. Investment in quality institutions, human capital, and upgrading their macro policies is essential to prepare them for the rocky trajectory awaiting them. Now, these challenges are universals, but they are greater for the poorer countries. A clear case study of the future challenges, ironically, is the present adjustment of the most affluent hermit kingdom in history, which is Japan. So let me conclude by showing you the future awaiting the US and most of Europe if the trajectory of the depopulation will continue. So here I'm referring first to Nippon.com reports. Japan's total fertility hit a new low of 1.2 in 2023, with the rate for Tokyo falling for the first time below 1. So this is interesting. Now, a follow-up Bloomberg report has interesting facts. A record of 2 million foreign workers are changing the face of Japan. As the labor shortage worsens, companies are opening up to the need and they convince the authorities to provide visas to workers. And then the previous prime minister bravely said, because of its low birth rate, Japan will need about 7 million foreign workers in 2040 to meet its growth trajectory. And Japan is entering into the era of foreign immigration. Now, it turned out that, ironically, the first prefecture that exposed the future is Hiroshima, where in 1 year, foreign workers rose by 14%, and the region has suffered the highest decline in population. In response, the authorities opened up the gates for foreign workers, and they are really contributing in industry, in taking care of the aging Japanese, and in oyster harvesting. And this is the most important area for oyster harvesting. If you visited Japan, you should know that this is a mega change of the configuration of Japan. And the projection now is that each year, 0.5% of the Japanese native population will disappear without replacement. So we are talking about the future that is happening already in Japan. Now, the way that I'm thinking about this is that if you are looking at the situation of Japan, this is a very affluent country. They were running current account surpluses for maybe 30 years. I don't recall exactly the number, but they accumulated huge assets in the form of something which is almost equivalent to sovereign wealth fund that is well diversified. But importantly, they invested a lot in manufacturing and also in residential cities that are attractive enough such that if now the Japanese population seem to be collectively the owners of the stock of capital of Japan, they, as owners, don't have enough manpower to deal with this productivity. So this is the future. So the choice is that if you are affluent and you are willing to change the social contract with all the complexity, then if you are affluent and you are tolerating newcomers, you can finance the depopulation of a country in a way that is conducive to a more efficient operation, which is a win-win for both parties. Of course, time will tell to what degree this process will continue, but you should be aware that there are several major cities in Japan, including, of course, Tokyo, that plenty of foreigners are happy to spend a year or two or more. 30 years ago, it was an impossible mission, not anymore. So the aging challenges facing mid-income cities would be harder than Japan. And this applies to all countries that are in this situation of reaching depopulation before reaching affluence. The earlier these countries, and I'm referring to all the emerging markets that are there, South Korea is there, and South Korea is also exposed to the same. The earlier these countries would wake up and upgrade their institutions and invest more in skilled labor, the less rocky will be their adjustment to the future challenges of the population trend. Failure to do this will imply that these countries are and will be growing sources of workers for the more supplying workers for the more affluent and better managed countries, either in the EU or in Canada, Australia, Japan, whatever. Now, of course, this applies also to the US, because it's not a secret that even in the US, the depopulation of the local population is the future. So time will tell how my dear new president will deal with this. I am sure that it will be rocky, but it will be rocky independently even of dealing with depopulation, which is, again, subject to this linear bias and not on the map of my dear new president. So let me stop here. I'm sorry that I was unable to use the longer PowerPoint. The full PowerPoint that I emailed has 18 pages, so here you can see 12, but hopefully you managed to get the gist of the material that is missing. Thank you.
Have a seat with me, please.
Yeah.
Thank you very much, Professor Eisenman. We will correct this with the presentation and include it in our conference package, but I know what you wanted to say, and you were presenting all the points I had in my synapses. Yeah? I would like to start with one question and then open up to the audience. Since you're invited by a policymaking institute and since the Austrian Central Bank belongs to the Euro system, what is now the message for us? You have shown that the spillovers by not only US monetary policy, but by Euro area monetary policy is relevant for CESEE countries. You have also shown us which measures of protections you can take and how you can build up resilience. But with the power of distance, if you now put yourself in the Euro system, should we care about those spillovers? Can we do something to reduce the sensitivity? What is the recommendation for us in the Euro system?
So had I been, say, a Polish economist, so I will support the position of Poland that maybe this is not an optimal time to give up the central bank, but one should condition it. The independence of the central bank is very important de jure. De facto, it's equally important to have governors like Stan Fischer that are willing to educate a prime minister that apparently was against his policy due to some shady, maybe side benefits. So you need, in all countries, to have quality governors. And in this context, I was amused to hear from the governor of the Central Bank of Peru that nobody can fire him. And this is the only reason why Peru is not collapsing. And he's also a first-rate as governor, as far as I'm concerned. So going back to the policy that a country like Poland may implement, it's exactly the blueprint of the IMF in the whatever that I cited, which is consistent with, I think, with the point that Professor Ray is correct that the ECB and the Fed are generating huge externalities on behalf of all emerging markets. Now, the problem is that if a country is entering the euro, they are losing the ability to exit without a mega crisis. So if in doubt, especially in this climate of geopolitical instability from all sides, I will be cautious. Now, now suppose that a country would like to buffer itself, and the country is already integrated with the Eurozone. So then I would say that one advantage of having your independent currency is that in certain times, if the fiscal side requires, you have the degree of freedom of doing what it takes to prevent a fiscal crisis. And there is a significant literature that focuses on the fact that in emergency, financial repression can be implemented along the line that, say, happened in the US, if you are looking at the history, from 1946, where there was de facto financial repression, before there was financial repression because of the war effort, and after there was financial repression, and this implied that at the end of the Second War, the public debt of the US outside the government system to GDP was about 106, and it declined partially because of these tricks and due to growth and others, to something like, I believe, 27% in early 70s. So the point is that I'm not objective, but I think that when we're looking at countries like France versus the US, France and Germany have the most stake in terms of voting, effective voting power, at least, as one can say. I would say that it's very important to stick to proper management of the public debt. Mm-hmm. And if you are not doing it properly, being a member of the Eurozone implies that the challenges facing France, that has by now, I think, public debt to GDP comparable to the US, will be much higher. And I mentioned it before in several conversations that the US is in a much better shape in the sense that we don't believe in taxes. Yeah. So we are undertaxed. So if there is a crisis that is hitting us, so we need a crisis really to change policies, and I expect that crisis will keep hitting us because we, are learning slowly over time after a deep crisis, but our memory is not more than 10 years because the deregulation of the regulations of that came immediately after the end of the global financial crisis happened 10 years after, and nobody was shocked, I believe, where 2 years later, the Silicon Valley Bank collapsed. Mm-hmm. Yeah. So going back to the challenges facing countries that are already in the euro, I think that it's better to try to deal with the public debt overhang in better times instead of worse time. The worst time is really the time that the IMF type of institutions are poaching you. So
of course, Professor. So we better get our act together in the euro area. I think we have 8 minutes left, and I would like to take short questions from the audience. I start with this gentleman and then with the second gentleman.
Well, thank you.
Yeah, okay, wrong order, but no problem.
Yeah. If I look around the world, I could make 2 observations. The first one is young countries are poor. The second observation is the European Union is the mostly globalized economy in the economic area in the world. And that brings me to a question to you. What do you understand under a quality institution? And what is wrong with the institutions in the European Union? What should we do that we can change the institutions to increase the fertility rate? I don't see here any relation.
Thank you for this poignant question. We take the second question, then you can answer, Professor?
Sure.
Yeah?
Okay, so I'm following up on your call about monetary policy. So you have 3 cases. One, you lose your monetary policy because you access to the euro. The other one is you use monetary policy to avoid the dilemma, Helen's dilemma, or do whatever you can. The third one is the countries close to the euro that are actually pegging to the euro, using the euro as anchor currency. It doesn't have monetary policy, you don't have lenders or resort. They're probably the worst case scenario. If you agree with the last part, which way would you advise those countries to move, out or in?
Thank you, Eduardo. Yeah. So please,
okay.
Yeah, let's go for the 2 questions.
So I'm not in a position of giving effective advice because it's up to the system that governs countries to listen to various views. Now, regarding the first question, it's quite shocking to note that in the past we believed that it will take 50 or 70 years for a poor country to become more affluent. Look at the history of South Korea. Within 1 generation, a generation and a half, they managed, maybe 2, depending on how you define the generations, by now their GDP per capita is higher than Japan. So we know, and the literature pointed out, that the take-off time increased, take-off to multiply your income increased substantially in the past 200 years. Okay? So the point is, if you can increase the GDP double or triple within 1 generation, so this is a horizon that a policymaker can exploit. Now, you should know that there is not too much love lost between Korea, South Korea, even in the north, and Japan, but at least South Korea replicated their own version of the takeoff of Japan, and they, by now, are doing very well. So my point is, the fact that you are poor is not a reason why not to invest in human capital. Now, if you are looking why the fertility, this is my subjective interpretation, as somebody that was born in Poland, the era of the Communist Party, the fertility was high because practically the party took care of all the expenses of raising kids. Okay? And my reading is that the quality of scientific education was very high in Poland, partially because of the vision of the Communist Party. So the bottom line, there are some policies that are mitigating the collapse of fertility. But you need for this the social will to do it, and also you need enough taxes, and you need to do it. So I'm living in a country where the Republicans believe in family values, but the cost of finding, say, decent care for kids from age 0 to age 12 is comparable to the cost of Ivy League university in some places. So of course the fertility collapses. Now, Gary Becker is also right. There is no reason for fertility not to collapse in a universe that the population was tripled in maybe global population, but the process is challenging. So there are a lot of tricks if there is fiscal space. The problem is that in the US we have plenty of fiscal space, but we are not interested in dealing with these challenges. So as in the past, time will tell how long it will take to educate, if at all, that public education has a role. I'm living now in California. California used to have the best, I would say, public university system, which was very cheap. And also the schooling system was quite cheap. The Reagan Revolution destroyed it. And by now, the tuition cost for residents of California is maybe 3 times or 4 the cost at the early 70s. So each society is subject to its own political mechanism. And fiscal space remain the key margin. But I'm not sure if we are better off by keeping the population at the present level. After all, endogenously, if Gary Becker is correct, there is nothing wrong if the average family will have a kid and a half. But the transition is painful. And here, each country will choose its path, and countries that are poor will be challenged more. And these are the countries that will supply the labor to places like Japan or South Korea.
Thank you.
There are no easy solutions because nobody is pricing, as far as I'm concerned, the global warming in the coming debt overhang that will happen once that we will be exposed to the darker side of it. Because global warming, my understanding from some of my friends that are working on this, is practically exponential process. It started maybe 200 years ago, and initially the rate was such that everybody ignored, and the population was maybe a quarter of the population today. So if we are suffering from linear bias, so we will sleep until we will be educated. And if you are looking at the climate challenges of California and also the state of Washington, we are already exposed to this. And California, to the credit of the governors there, was among the first that started improving the standards of gasoline and the like in an attempt to get clearer air, though we still send the pollution generated by using coal to New England because of the pattern of the jet stream. So the bottom line, there are ways to deal with this better. There is no way to deal with this without a painful adjustment.
Thank you very much. I mean, those were very clear warnings. Yeah? I'm afraid we have to clear the stage for the next panel. I thank you very much, Professor. Thank you very much to the audience. Yeah, I'm sorry, but we can't keep the schedule, and I have my
I'll be happy to answer one-to-one.
We are under the scrutiny of the captain, yeah? Thank you very much.
Thank you. Thank you.
Okay, dear ladies and gentlemen, welcome to our panel discussion on how to reform or how to complete the European Economic and Monetary Union. My name is Philipp Heimberger. I'm an economist at the Vienna Institute for International Economic Studies, and I'm happy to chair this session. So we are confronted with some big and important questions on European economic integration. And some questions that we will discuss today are what's needed and with what priority to reform the European economic and monetary union. Will a common monetary policy in the long run be compatible with coordinated but mostly national fiscal policy, or do we need more sizable, more permanent European fiscal capacity? Also, what are the key political challenges for reform? Does Donald Trump's election in the US make decisive European moves towards economic integration more likely or less likely? What role will a change in government in Germany or political developments in France or the situation in CEE countries have in all of this? So to discuss these questions and various other aspects, we have three excellent speakers for the panel. So let me introduce the speakers in alphabetical order. So to my right, we have Bogdan Capraru. He's a professor of finance and banking at the University of Iași in Romania. He's also a member of the Romanian Fiscal Council and deputy chair of the network of EU independent fiscal institutions. Let me further introduce Dorothée Rousset, who's sitting on my left outside. She's currently the chief economist in the French Ministry for the Economy and Finance. In previous roles, she worked as a senior economist at the OECD, but also as a macroeconomic advisor to Bruno Le Maire, the Minister for the Economy and Finance in France, and she was previously also chief economist at Citigroup for France. And last but not least, let me introduce Tu Nguyen. She's the deputy director of the Jacques Delors Center, and she leads the work of the Jacques Delors Center on institutional questions of EU policy. And in her work, she focuses, among other things, also on EU institutional reform and EU economic governance. And she has also given evidence in various committee hearings in the German Bundestag and the European Parliament on this. And also relevant in our context, you were also appointed in January 2023 by the German government to this Franco-German expert group on EU institutional reforms. So let me give you some brief notes on the structure of our discussion. So I will first ask each of the panelists for an opening statement of about 5 minutes each. Bogdan Capraru will first talk about the new EU fiscal rules, because we had a major reform which became effective this year, and he will talk about this and also about the consequences for fiscal policy and macroeconomic developments and challenges for implementing this new framework. Dorothée Rousset will then give us her views from a French perspective on fiscal policy in France, but also important topics of EU economic governance and European economic integration. And Tu Nguyen will then talk about political challenges for reforms, as well as the role of Germany, France, and the CEE countries in all of this. Okay, well, without further ado, let me give the word to you, Bogdan.
Thank you very much for the invitation. First, I would like to mention something. Today, I will talk from my first institutional affiliation as a university professor. But of course, my statement will be backed by my experience from the other two institutions, the network and the Romanian Fiscal Council. In April this year, a new economic and government framework at EU level has been adopted. The reason of the reform was to eliminate some weak points of the previous one, such as too much complexity, pro-cyclicality, difficulties in enforcement, hampered national ownership. The new EGF is meant to be opposite to the previous one, considering the shortfalls mentioned. It is also forward-looking, could be considered a benchmark on the matter of economic and social policy at EU level, making incentive to increase investment, especially in innovation, disruptive innovation, technology, carbon-neutral investment. And the medium-term fiscal structural plan is the cornerstone of the new framework, and it can be considered as multi-purpose component of the framework. And we can state this starting from its characteristics and role. I will be mentioned, we can consider at least 5 points of view. To reduce the public debts to sustainable levels, to act as a preventive arm for the CGP, to encourage the national public investment and structural reform, and to anchor them to EU common priorities like green and digital transition, social and economic resilience, energy security, the build-up of the defense capability, and also to provide greater member state ownership of the plan, being tailored upon country-specific needs and the particular situation. Alongside the medium-term structural plans, the role of independent fiscal institution in this framework is very important as well. And here I will bring into the discussion the theory promoted by this year Nobel Prize winners, Acemoglu, Johnson, and Robinson, who emphasizes the role of institution in an economy, in a society in general. And they build up a concept of inclusive institution, which create long-term benefits, a positive impact of economic growth, country's prosperity, and population well-being. We can extrapolate these characteristics for at the EU level, and we can assimilate IFIs, independent fiscal institutions, as this kind of institutions from their function as watchdog, promoting fiscal transparency, accountability, credibility, and in advisory and advocacy position, offering normative recommendation on fiscal policy. They reduce information asymmetry between the public and the politician, make incentives to sound policy decision, and provide technical contribution to the budgetary process. So, as the Draghi report as well underlined, we should, and also today was mentioned, we as EU, we should catch up with the US and China economies in terms of technological and economic competitiveness, but in the same time, we have to accelerate convergence inside the EU, especially from the Central and East European countries. IFIs, I think IFIs in some exchange can contribute to this phenomenon through their position and role as a guardian of fiscal sustainability. But in order to accomplish this role, they need to be equipped with some minimum standards in terms of independence, in terms of funding, in terms of human resources, adequate and timely access to information, and also to have a minimum task, a core task, and of course the new EGR bring into the discussion in its provision these two minimum standards regarding the resources, independence, etc., and of course the minimum task. But yes, the problem is we are now living, history is in the making, because we are in the period of transition and also the transposition. The final transposition should be in the end of 2025.
Thank you very much. So to briefly summarize, So in this period of transition, we now have this important reform of EU fiscal rules, and you emphasized also the role of these national medium-term fiscal structural plans and the role of IFIs in all of this. If I understand you correctly, although one of the goals was to reduce the complexity of the new framework, the framework still remains quite complex. So given that, let me give the word to Dorothee. Can you give us your views about fiscal policy in France, also against the background of this reform of EU fiscal rules, and maybe also about important aspects of European economic integration from your perspective?
Yeah, sure. I'll probably start with the end about economic integration and where I think we should be going. And I will start maybe by saying, this is a panel on completing EMU, and I think we have to be aware that, in the geopolitical context that we are in, I mean, this is really a time when we should have a wake-up call for Europe to build resilience to cope with shocks, which are probably coming in more numerous waves than before, and also to strengthen competitiveness. And of course, the Draghi report was very clear on that. And we face increased economic competition from the US, from China. We probably face a new wave of protectionism coming at the same time as the global rules-based order has weakened and is probably not getting any stronger. And with that, we really need to focus on thinking at the EU level I would say, on two big dimensions. One is leveraging the single market, both to drive future growth, to drive more domestically generated growth in a way and be less dependent on others, and also to increase our bargaining power in potential future deals, because our single market is a huge asset. I mean, access to the single market is also a huge asset in negotiations. And the second axis is more strengthening the coordination of our economic policies. Fiscal rules are part of it. I think it's only part of it in order to mitigate the shocks that we face. On the single market, as I say, I think it is key, and we have to acknowledge it. It has been key in the past, and it will remain key in terms of building prosperity and cohesion, and also in terms of coping with competition from abroad. It has brought enormous benefits in terms of productivity, in terms of innovation, in terms of growth by removing barriers and building scale, but we have not fully exploited this potential. And there are several dimensions of that. One, even on the internal trade side, I mean, we've done very well on trade in goods. We trade much more in goods within the single market than with extra EU partners. So about 26% of the European Union's GDP is in trade in goods with outside within the EU, and 17% within the EU. But in services, the numbers are the same. We don't trade more within the EU than outside of the EU in services. So there remains barriers there that I think we should focus on. Perhaps being pragmatic, not trying to reach a grand deal on all services, because this touches on domestic regulations. It's hard to do, but maybe focusing on a few areas where we can have significant productivity gains, also services that are important for the green transition, and maybe focus on a few areas and try to make significant progress there. Other aspect, of course, is the financial sector, is deepening our financial sector, our capital markets, to build more sources of funding for our firms. And here, I think, again, the Draghi report is very clear on that, but we've known it. I mean, we knew it before, and he says it in a very striking way. We have a funding gap, especially for risky investment, especially for innovation. Our equity markets are not developed enough, and when we go to like the early stage finance, like venture capital or private equity, we're even further. And that is really the meaning of the capital markets union, or savings and investment union, and also of building more integrated banking markets in order to have the benefits of scale there too. I mean, incidentally, the first capital market infrastructure that we had was Target. That was introduced in 1999 at the same time as the single currency, and that is no coincidence. So I think the next steps on the capital markets union are quite important there. So that's one leg, and I'll be quick. But the other leg is how do we coordinate better to mitigate shocks? And how do we coordinate better our economic and fiscal policies? Now, of course, the new economic governance framework, the new fiscal rules are a very important step. We think that's very significant progress because, Bogdan already said, what are the principles and what are the differences with the previous set of rules that we have. We think it's important because we have, the differences make it, or the evolutions make it more pragmatic, more realistic, and therefore more credible. Because the trajectories are differentiated between member states depending on their characteristic, depending or on where they stand, and that is more realistic, and that brings the reduction in debt levels that are foreseen to more credible paths. Because we have more national ownership built into the rules. Every member state has to propose their own trajectory, and there is more ownership in that, in sort of building the trajectory and endorsing it and proposing it to the Commission, which is a process that we've been in, and we can say in domestic politics it's not neutral. And also the integration of investment and reforms and building it incentives to undertake investment and reforms that contribute to long-term growth, that contribute to sustainability, both on the environmental front and on the public finance front. But that's addressing the goal of debt sustainability and fiscal consolidation in, I would say, normal times. What is still missing is how to have a fine-tuned coordination in the face of adverse shocks, when we rather may need, in the face of a new crisis, to coordinate fiscal expansion and also coordination of more structural policies in favor of investment and competitiveness. And here I think, we should be pragmatic. We should not necessarily try to have big new instruments on which, given different member state sensitivities, we may not get anywhere. But I would say there are two things that are worth looking into. One is to have a central stabilization capacity. So this is really about dealing with adverse shocks and mitigate cyclical effects, not permanent expansion, but just stabilization. Because we have asymmetric shocks, we have a common monetary policy, and therefore we need a way to deal with these heterogeneous shocks. And here, I think the experience of SURE during the pandemic is an interesting one. It was providing EU loans to member states in order to fund their expenditures to protect jobs and workers, and it has worked very well. So this could be an experience to draw on. And the last point is, it's a question of should we have a central investment capacity? Here too, I think we should be pragmatic, and we should reflect on what will come next after the Recovery and Resilience Facility. We have large investment needs, but we have to think about what are the common goals that we can find sort of consensus to, and where it makes economic sense to fund them at the EU level. And then be open about the instrument, not necessarily jumping to joint borrowing, but to sort of being very open and thinking about it in the context of the next multi-annual financial framework, in the next EU budget, and how do we think about common investment in this context. Let me stop there, but I think for me these are the priorities.
Thank you, Dorothee. So this was basically also a wake-up call for European policymakers or on European economic integration, these uncertain times, to basically move forward with the next steps, although you were then also in favor of quite pragmatic solutions in many areas. Well, given this wake-up call, can you maybe talk a bit about the political challenges of reforms, or how things could get done on completing the European Monetary and Economic Union?
Thank you very much for having me. As I'm not an economist, I in fact would like to focus on the institutional and political dimensions. I think the term wake-up call has maybe been a bit overused in the past decades. I think there have been quite a few wake-up calls. I am not sure whether we have responded to the calls as well as we should have. We also talked about the question of crises in one of the previous panels. Does the EU move forward in a crisis? Of course, there's this whole theory of the EU failing forward whenever there's a crisis. But even in crises, or in managing crises, what we need is leadership, right? So what we still need is a leader, a member state, someone who takes action, takes leadership, and also recognizes that challenges must be solved at the European level, and that can sort of overcome the confines of national politics. I am not sure that that we're looking at a very optimistic scenario at this particular moment when it comes to this factor for reforming the EU for deeper political or economic integration. Historically, there is, of course, the notion that the Franco-German engine is not a sufficient condition, but a necessary one, right? If we want to have deeper integration, if we want to move forward in European integration, the Franco-German engine is what most observers, most commentators look at. That one is not functioning at the moment, neither domestically, individually, nor really as a duo engine, as a combination. Both countries are riddled with domestic conflicts. So we've had snap elections in France. In summer, the German government collapsed on the day on which President Trump was elected in the US. And a lot of reactions were, really, Germany right now. But I think what might be even worse was that there was also a lot of reactions that said, thank God, because we can no longer actually deal with such a dysfunctional government in Germany when there's so many challenges to be dealt with at the European level. So now in Germany, we are in this in-between moment. Elections will be in February. And of course, the hope is that once the coalition talks are over in Germany, we'll have a better functioning coalition than we had in the past year or years with the traffic light coalition. So this sort of leaves the gap in the Franco-German engine, the two biggest member states. There were a lot of discussions who can fill this gap. And I'm not sure. Poland was mentioned often, also because there's the Polish presidency in the next term, so beginning of 2025. So that's, of course, a good window for Poland to sort of take the lead in urgent issues. But even Poland is still occupied with domestic politics. So we've had a change in government, but there's, of course, still the presidential elections coming up in May 2025. And in many member states where we look at, there is either more Eurosceptic governments in place or governments that are struggling to stay in office. So overall, we do not have ideal conditions on the member state level for big reforms or big steps in European integration. It is good that we have experienced European Commission president now. Last night, very late, I don't know if you followed it, there was an agreement on the commissioners. So it looks like we will have a functioning commission by 1st of December. But of course, the commission by itself and alone cannot actually achieve things. So they can start things, and it's good that they're there, and it's good that the commission president has a lot of experience, but by herself, she will not be able to achieve a lot. And I think what we also should not underestimate is the new composition of the European Parliament. We have more MEPs that are Eurosceptic and more MEPs that are opposed to European integration than I think ever before. And they do not have a majority at the moment, but we've already seen dynamics where there is also for the center parties, in some areas, quite a shift to the right. So we no longer have a progressive majority. And yes, in many areas or many topics, especially economic governance, the European Parliament may not have a lot of decision-making, but it is an actor that in the debate and that sort of in the push for more integration will now be a lot weaker than what we've been used to in the other legislative terms. Right, so I think that overall the circumstances are unfortunately somewhat difficult. I do hope that maybe the geopolitical situation might bring forward a push nonetheless. And I think what will be interesting to see is also in what form this push or this move might come about. So what we've seen really since 2019, when the new Commission President, or when von der Leyen was the new Commission President, was the shift towards an EU-wide agenda. So remember when I did my PhD in 2013, there was the Eurozone Parliament, was all the rage, everyone was talking about Eurogroup, accountability of Eurogroup, so really a more Eurozone-focused agenda. And in 2019, when the focus shifted towards climate and digital, it became a Euro-wide agenda. And this we also then saw replicated in the Next Generation EU Fund. It was really a dedicatedly a pan-27 member state initiative. But of course, the more difficult reforms become political, the more it begs the question of whether the EU will fall back from this pan-27 member state approach, and whether we will see again more of a differentiated integration approach and smaller groups of member states that move forward, especially once the RRF runs out. And I think at least when it comes to the difficulties that we've seen with Hungary and the Ukraine aid, we've already seen a willingness of the member states to at least very openly discuss to move forward with 26. So I think this will be, I don't have an answer, will be more of an interesting question to see what are the factors that might lead to the EU, maybe not fragmenting, but making actions or taking actions less on a 27 member state basis and maybe on a more smaller groups basis.
Well, thanks a lot, although that was quite kind of a sobering view when it comes to the current situation. I mean, you made the case that we need leadership also in times of crisis to solve the problems at the European level, and the question is where can that come from? Maybe to follow up on that a bit, also given current election outcomes, maybe you can say a bit more on what the US elections, but also the upcoming elections in Germany may imply for potential, for the outlook of institutional reforms at the European level. I mean, I guess Trump will try to play EU members against each other. And one of the questions is how can member states prevent this, or how can this be prevented at the EU level? And then given that you made the case that Germany is still one of the most important players in all of this, how could potential outcomes of the early elections in Germany come into play here?
Yes, I think you're very right. I think in terms of what effect will the election of Trump have on Europe, we really have two ways to go. Either we really see a bilateralization of member states with the new Trump administration and less European common action, or the Europeans respond to the wake-up call this time and manage to find common path to react to whatever may come from the Trump administration. In terms of the German elections, I think what is important to emphasize, and this is a good thing, is whatever government, whatever coalition is going to come in Germany, we have broad assumptions what is likely, but whatever the coalition looks like, it will be a pro-European government. Right? So very different than in other member states and other elections we've seen, that there's no danger that a truly Eurosceptic government will come into office in Germany, and I think this is very good, and I think this should also not be forgotten in the debate. We hope that the government that will come into office will work better together than the previous government. That also means that hopefully it will be a two-party government coalition again, like we've had in the past, and no longer a three-party coalition. At the moment, it looks quite likely. And of course, we hope that the government will also be one that really takes Europe on as a responsibility. It needs to feature in the government's DNA as something that Germany needs to consider in its action, because this is also something that the previous government was actually not very good. Europe was never at the core of their thinking. It was always a second or third thought. Olaf Scholz was not very good at fostering partnerships with other member states. So I think this is something that needs to become better in the next government. And then for Germany specifically, and it has quite some repercussions for Europe, is of course always the question of can we reform the debt brake, or what will happen to the debt brake. I think the biggest danger here would be if there was a blocking minority by the far right and the populist left that would not allow mainstream parties to do anything about the debt brake, which will of course put any government that then comes in after the elections into the same problems that made this government fall apart in essence.
Well, thanks a lot. So at least we have the silver lining that most likely we will not have a Eurosceptical next German government. Maybe let me ask you, Dorothee, a bit also about the situation in France, because there's also a lot of discussion in particular about fiscal policy in France now with the new prime minister. And what you also mentioned in your remarks although you were for a pragmatic solution, but you mentioned that a lot of investment needs to happen in the European Union to tackle challenges of climate change, but also defense and other things. And you mentioned European fiscal capacity. Can you maybe talk a bit about how policymakers could address that in a constructive way?
I mean, I won't talk about politics in France, but of course, I mean, it is, you know, contrary to other countries in France, there is no tradition of coalition government. So, I mean, there was a snap election this summer. It resulted in a parliament with broadly 3 big blocs, none of which wants to forge an alliance with others. And therefore the current government does not have a majority in parliament and is trying to muddle through that way. But it is a more unstable situation than we've known in decades. And this comes at a time when our fiscal challenges are high. So the government has put forward a budget bill which foresees a significant fiscal consolidation for next year, because we submitted our medium-term fiscal structural plan to the Commission under the new rules, which foresees a deficit going from 6.1% this year to get to below 3 in 2029. So that's both, you know, both it takes time because we start from far, but also because we try to walk this fine line between consolidating, making sure we get debt on a sustainable path, and at the same time making sure we don't do that by cutting investments, on the contrary, and that we don't do that in a way that would trigger a recession, which would then be counterproductive on the debt sustainability front too. So that's a fine line, but part of what it requires is to have significant adjustment year after year, but also to front load it, both in terms to contain the increase in debt and because of credibility. I mean, our next presidential elections are in 2027, so in a way it is hard to take commitments beyond the next 3 years. Obviously we can, but the more you front load the effort, the more credible it is. So I mean, the budget is going through Parliament at the moment. There's lots of, you know, agitation and political games around it. We have to try to look through to what is likely to emerge at the end of the game, which is probably as long as the government makes it to the end of the year, which I still think is more likely than not, but I'm not a political commentator, which is probably a budget that would resemble the original copy of the government. So that's, you know, after having morphed several times through the process. But I think on French fiscal policy, that's where we stand. I think that, well, fiscal rules, I mean, you could say France does not have a good record of complying with fiscal rules under the past framework, but France has also been very active in the negotiation of this set of rules to push for, as I said, the idea of differentiation, the idea of ownership. It is very important in our domestic political debate that it does not look like the consolidation is imposed from Brussels, but it is actually something that the government itself, you know, endorses and puts forward, and that is quite important. And to have this balance between investment needs and the pace of fiscal consolidation. So that has also infused in our sort of domestic public finance planning. In terms of saying more about our thoughts on the European fiscal capacity. As I said before, I think there are 2 different goals which probably call for 2 different instruments. One in terms of short-term stabilization, which is probably easier to push through because, again, I mean, we've done this during the pandemic. It's not very expensive because it is, you know, it is a loan instrument. It is for cyclical stabilization. It's not something that is designed to be used permanently, and we could probably do it again or just have the instrument in our in our drawer in case we need it. The harder question is, do we need an investment capacity? In some ways, we think we do, but how and what do we want to do with it? And there, yes, I said let's be pragmatic because, frankly, I can't tell you exactly what is, you know, in my mind, the ideal model. I would say we should not start from how to finance it, but we should start from what actually do we want to achieve together on that front. What are the priorities that we want to finance together? And I think, I mean, which European public goods do we want to finance at the European level? I think the best candidate is probably the green transition, because it is something where, I mean, having action at the European level does give economies of scale. I mean, climate is global, and acting together does have clear positive externalities, as we say as economists. And also because we have overall quite similar preferences across member states in terms of climate. I mean, in terms of at least which ambition we want to have. And maybe for other areas where we think of common financing, this is not necessarily true. I would say the debate on financing, how to finance, should come a bit at a later stage, if only because, I mean, yes, we are going to have the issue when the Next Gen EU, when the Recovery and Resilience Facility runs out, what comes after. But this debate is hard to have when we already don't know how to pay for it. And until we get somewhere with the debate on own resources, on how are we actually going to repay Next Gen EU, it is really hard to think about what comes after and let's do another round. So I think this should come first, and this, as I said a bit earlier, this should not be disconnected from the discussion about the EU multi-annual financial framework, because in a way this all has to be coherent. Right?
So thanks a lot. So to quickly sum up, so you talked about this basically fiscal consolidation outlook in France starting in 2025 to meet EU fiscal rules, but you basically also made the case that there's likely now more ownership, given that France was also a key player in negotiating this new EU fiscal rules framework. And then on the EU fiscal capacity, you basically argued yes, we might need a European permanent fiscal capacity, but the question is, what do we want to achieve with it, and kind of public investment for the green transition or for the climate transition is a major candidate there. But this should also be linked to the discussion on the MFF, on the next MFF. Given that, let me come back to you, Bogdan. I mean, we discussed now the financing issue already a bit. You are also an expert on banking and finance. And this is another, I think, key part of the discussion at the EU level currently around the capital markets union also, that we need kind of a defragmentation of the markets for corporate financing. So kind of comparable financing conditions for comparable firms in different countries. So maybe you can say a bit more about that from your banking perspective.
Okay, but I will make the link from the other side on EGR, because EGR is meant to put incentive to have public investment, but I think public investment should be accompanied and complemented by private investment, and to have why? Because we have encountered in a moment probably crowding out effect and other consequences, and also we should relieve the deficit budget, and also the burden on increasing debt. Regarding the financing private investment, here I think we have to develop banks, to have bigger banks. I know it is a trade-off, considering it's a challenge for supervisions and for regularity, and here we can talk about bringing the discussion the state of play of the banking union. Bigger banks which could finance bigger projects, bigger companies, and also this could be a challenge from the competition point of view, because we know competition, it's, I think, from my point of view, it's the heart of the European Union. It's considered as principal heart of European Union. But this can be also covered and backed by existing medium and small banks, more dynamic oriented for small and medium enterprises, more creative. And regarding how to have bigger banks, I think a solution is to have, at this moment, to have mergers, cross-border mergers and acquisitions, and especially, between in the regional area, and this also will encourage the capital movement from a country to another one, and it's one of the for condition of having optimum currency area, to have fluent capital, we have capital to move freely inside the European Union. This is for the moment some suggestions. Yes, it will be difficult to have it, yes, because I notice a backward process now. Some big groups, bank groups, now are split and sell some subsidiaries and close some branches. But in medium term, I think we should be oriented to this, because as I will bring into the discussion again the Draghi report. I must confess I am a big fan of this report and the idea provided there. We should have to catch up US and China. We have to have bigger banks, and for this we should have bigger capitals, bank capitals, and we know that the exposure it's to a client or to a project is related to the dimension in absolute amount is related to the dimension of the own capital.
Okay, thanks. So basically an argument for bigger banks on efficiency grounds, although you also say that this might bring some challenges for banking supervision. Maybe to follow up on that, Dorothee, one thing we have not talked about yet is banking union. Actually, this year we have an anniversary, right? So we have 10 years banking union, and we have discussed crisis in the Eurozone a lot today, not only in this panel, at least crisis has come up on several occasions. And basically banking union remains incomplete, right? So we have basically this crisis prevention part of the banking union, which was completed in 2014. But when it comes to crisis management and also resolution, there is still something incomplete. So maybe you can say a bit about that from your perspective, also in terms of the importance of banking union.
Yeah, actually, I would also argue that we need to think about banking union without necessarily putting crisis in the same sentence, and we need to have maybe a little bit more of a positive agenda for the banking union. So, I mean, you said it now, the banking union is going to be 10 years old. I mean, it was 2014 for the first achievements. Of course, at the time, what was in everyone's mind was the global financial crisis and making sure that we didn't reproduce some of the issues we had then. And this has been, I mean, what has been a success, I would say, on that front. I mean, we were able at the time to set up some integrated cooperation to preserve a public good, that is financial stability across the European Union. And that was an example of successful integration, incomplete, but still successful. I would say now, I mean, the challenges today are not necessarily the challenges of 10 years ago, and we need to take a bit more of a positive and proactive view of what the banking union is trying to achieve. And in that, I would probably link to what Bogdan just said. I would say now we have to think also in the banking union in the context where we have huge financing needs for the green transition, for the digital transition. Banks will be a part of that. I mean, banks provide 80% of the financing of our firms. I would say, I think that's probably another issue, and capital markets union is another issue to try to provide more equity funding, but that's where we are at the moment. So whatever we need to finance, banks will be a big part of that. And they will be a big part in the competitiveness of our economies. And in that, this issue of competitiveness and of like being able to finance things at a large scale is still somewhere where we are lacking. We have a banking sector, it's been said, that is still very much fragmented along national lines. Most banks are purely national players. They don't really diversify even their risk exposure across the Eurozone. They're very exposed to their national market. And at the same time, we see them losing market shares in their domestic markets to non-European players, especially American banks, which at home have a more integrated domestic market, have deeper capital markets, and that gives them a competitive advantage. So to me, that is also, I mean, that should be the rationale also of moving forward on the banking union. And yes, trying to look into the obstacles to integration, to cross-border integration, trying to tackle that, giving more incentive to manage banking activities at least at the euro area level, and not just national country by national country. And today it's not the case. That could be looking into liquidity and capital waivers for pan-European banks, as long as they're well supervised within the euro area. Like making sure, we push towards having this institution more managing their activity and their businesses at a European level, not so much in fragmented national markets. On the financial stability side, one other point I would say is we should also look into, I mean, we've done a lot on very large institutions. Perhaps, we are underestimating a little bit the level of risk that can come from smaller and medium banks. And I mean, this could be also less, I mean, of course, we have very, very different supervision systems than the US, but I mean, the US banking turmoil from last year maybe should give us a bit of a warning, and to make sure that even if we go to more integrated supervision, we still have sufficient monitoring of maybe more mid-sized institutions. So yeah, to me, I mean, I would say my main message is that let's try to have also a positive agenda of banking union and not just think about crisis. And maybe that will, I mean, help to make progress and get more momentum around it, because let's be honest, in the last few years we haven't been able really to move things, and maybe having a more positive agenda will also give it more momentum.
So thanks a lot. So basically you're arguing that banking union is important, but you were arguing for a positive case for the banking union. Maybe let me come back to you. One thing that has also come up at several points is spending priorities, given the challenges that we have in the EU. And maybe you can say a bit about the next MFF, the long-term EU budget. Dorothy also mentioned that other European economic integration issues are partly also linked to the MFF. Maybe also in terms of what we can expect politically on the next MFF. I think the Commission has also come up with some quite radical ideas, actually, or has floated some quite radical ideas. Maybe you can elaborate a little bit on that.
Yes, I think the next MFF negotiations will be quite spannend. I don't know what it is.
Exciting.
Exciting, not quite exciting, but interesting at least. I think I don't remember on detail what the Commission wants to do. I think they want to have more of an RF-style conditionality introduced in the MFF, also for cohesion funds. This is, of course, something that, at least in the German regions, is not going over too well. Overall, there is the big question on what the EU should spend their limited funds on, and I think you're very right that we should think more about what to spend it on, rather than, at least in the moment, than where to get the money. I think one area where the chances for common spending or common financing is the best at the moment is not necessarily green transition, but defense spending. I think there's quite a lot of agreement across the EU that what we need to be able to do, also in the short term, is to spend more on defense and also gear up our defense industry. And I think here the opening for joint spending is perhaps bigger than in other areas. Another question when it comes to the next MFF is also, I think, the question of enlargement. And this is something that is important in two ways. One is, if we take enlargement serious, I think it needs to reflect in the next MFF, so it needs to reflect somehow until 2034, the MFF runs, that this is something we consider to happen within the next decade and not after. I think 2030 was mentioned before today. That might be a bit more optimistic than most political observers are, but I think it should reflect somehow in the MFF. And the second question that then also often comes up is, what is the impact of enlargement on the MFF? Will it be too expensive for us to finance? And I think here we should be careful to not exaggerate the costs of enlargement, because often you hear in the debate that if the EU enlarges, if the Western Balkan countries join, especially if Ukraine joins, then all of the net beneficiaries will become net payers. I don't think that is true. We made the calculations. According to our calculations, it's not true, because the MFF actually has mechanisms to adapt to enlargement, right? It has adaptation mechanisms. It had caps how much member states can receive. It has caps how much a member state can lose in relation to the previous MFF period, and it also has transition mechanisms for new member states when they come in. So I think when we talk about the MFF and we talk about enlargement, we should not be too drastic or too exaggerate too much how much it will cost. That being said, I think there will be quite a few challenges in the negotiations, and I'm not sure how much the Commission ideas will fly at the end of the day. I think the German government seemed to be quite positive, at least partially to the ideas of having a bigger pot and more centralization through this RF conditionality model. The regions, I think, will not be happy, and I think the question that also then comes up is what we have not so much discussed is if we want to replicate the RF model, have we made an assessment of how successful it is? I think we're still ongoing in the assessment of whether or not the RF has worked in a way that we would replicate it or would want to replicate it for the entire EU budget, or for large parts of the EU budget, also in the long term.
So thanks a lot. So we can basically expect tricky negotiations on the next MFF, and you were basically arguing that the next MFF at least has to reflect, first of all, the increased need for defense spending, also in the context of the war in Ukraine, but also
probably that needs to be done before the next MFF already.
So that is a key issue, and also EU enlargement and how that can be incorporated. Okay, so we have touched upon different aspects of institutional reform. Let me now open the floor for your questions, and I think we can collect at least 2 or 3 in the first round. Who has a question? Here's a question. There's also a question here on the right. Maybe you can quickly say your name and where you're from, and then also who you want to address the question.
Sorry? Who was it?
Yeah.
Piroska Nagymohácsi, LSE. Thank you very much. Very informative panel. Just in the name of straight talk, Dorothy, you really discussed some kind of a fiscal component of the EMU, which is missing. It could be linked to crisis facilities, for a new agenda, but that's what in theory we deeply miss, and that is very welcome. And if you need the crisis for that that realization, that's probably worthwhile the cost. My question would be regarding the specific subject matter here at the conference, and put it like not only what you can do for the euro, but what the euro can do for you. I.e., is there anything that you can see the euro's role in deepening the single market? As you made, your second point was that's what is really critical, right? And then we can do the banking union and blah, 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 blah. But we have the euro. And naturally then would be the taking up the enlargement of the euro area, if you wish. Is there a way that you could see that if that is true, because the EU can generate a little bit more trade, maybe not dramatically, but we know that there is trade creation from there, and associated benefits. Do you see that there could be some facilitation of this whole process, which is like really very, very heavy-handed one, and given that there is no government really involved, there is is not changing the rule, but facilitating the whole EU membership process, or not?
Maybe we collect also, I think there was a question also here on the right. Someone had a question, no?
Yeah.
Yeah. The woman here and then also here on the left.
May I have the question? Thank you very much. Very informative presentation and questions. Of course, fiscal and macroeconomic coordination is a key element, and the EMEU and of course development of EMEU is very much linked to the macroeconomic coordination. The major process and institution for macroeconomic coordination is the Economic Policy Committee, EFC, ECOFIN, FIDER, within the European Union. So far, unfortunately, the macroeconomic coordination as such, including the fiscal coordination, did not work very well. Country-specific recommendations were implemented roughly between 10 and 15%, Eurozone and non-Eurozone countries on average. So it's a very low implementation level. Now the fiscal rules are reformed. Of course, we do not know how the pudding will be eaten, but still, it's a learning by doing exercise right now. At the same time, we have a new challenge, the competitiveness challenge. And what I don't see exactly how this new competitive challenge, which was very well identified in the Draghi and Letta report, institutionally, process-wise, how can be horizontally conducted among member states and within the European Union, once this horizontal responsibility at the level of committees is not very well seen. So I think that a procedural and committee level of adaptation will be also needed once we are over the diagnosis and we are going for the therapy as foreseen for the first half of next year. I don't know whether we have certain thoughts and certain ideas on that. Thank you.
Okay, so we will take one more question, and I will give you the chance to respond, to pick what you want to respond to.
Hello, I'm Paulina, Minister of Finance of Poland. So I know that we just are just after the big reform of the fiscal rules, but my question will be already about the future of them and how do you assess their enforceability, so like the political sustainability of them. We know that it was a big problem of their shape before. So my question is, how do you assess their enforceability, especially in the context of rapidly aging population, as issue that was brought up here many times? Because just for the context, this issue wasn't so relevant for the fiscal adjustment before as it is now. Basically, the bigger aging costs are projected, the bigger the required fiscal adjustment. Basically, it pushes the fiscal adjustment to the levels that were not seen for a very long time for selected countries or even ever. So how do you view this from the also political economy perspective? Yeah.
Maybe, Bogdan, you want to take the question on EU fiscal rules, and then you can respond to
on the last questions. Yes, you are right. There are a lot of challenges in the horizon, and I could consider in short time, medium term, and also long term. You said something about the aging. Yes, it could be considered on long term issue, and also I can add here another challenge. It's about the impact of artificial intelligence. It's somehow in line with this, and in general with the disruption in economies, and in long term, the new framework should face these challenges on a long term, these disruptions in the economies. Yes, it is for calculating the net expenditure path, is there something it is extracting the cyclically unemployment expenditure. Probably this could adjust a little bit, as I mentioned about artificial intelligence, but we don't know exactly the impact on long term. Could be permanent, to become permanent, because you know when you have this you have expenditure with social assistance, with job reorientation, etc., etc. It could be related to this, I think, the aging also to this element. Okay. We'll see. Probably, I said that this history is in the making. Probably in time, the EGR will be adjusted with fine-tunes, not like this kind of reform, like, okay, but with fine-tunes and to add these challenges.
Okay, maybe two, or Dorothee, one quick word.
Yeah, no, I can say a word about the euro and the single market. I think there is a sort of a traditional answer. Having a single currency, yes, it helps integrate in terms of trade because it makes trading easier. We've seen this in goods. We've seen this also to an extent in services, as I said, not fully. I think maybe where I would go to more is that having the euro actually forces us to integrate more, and not necessarily the other way around. I think it's been said before, if we had waited until we had the perfect economic conditions for integration for a common currency, we would still have to 20 different currencies instead of having the euro. What you would normally need by the economic textbook for an optimal currency area is you should have synchronized business cycles or at least similar exposure to shocks. We don't. And if not, you really should have risk sharing, either public through fiscal transfers. We don't have fiscal transfers, not on the extent of the US between states. And regardless of where we go on central fiscal capacity, we will never get to that extent. Or then you should have a lot of private risk sharing, and that's also where we go with banking union and capital markets union. It's not just a technocrat's dream of perfect integration. It is something we need economically in order to have less impact of adverse shocks. So I think this is also where we need to move closer to these conditions because we have a common currency, and this takes us together, and this means we need to get a little bit closer to the perfect conditions for a single currency, and that's where it forces us to think about more integration of our financing markets in particular, and about at least some steps in terms of fiscal stabilization. That's where I would.
Okay, thank you very much. So we leave you still with a lot of open questions on institutional reforms in these difficult times, but I think it was a very interesting discussion. Thanks a lot to the panelists and also to you for your attention, and I think we will now have a break, right?
Yeah,
okay. Thank you.
Welcome back to the final session, typically the crowning event of our CESEE conference, when we are able to garner the presence of governors from the region. This time, I have to say, we extended it with even more people in order to governors to have a very good representativeness of it. So thanks to my colleagues before I introduce them, thanks in advance. This final panel deals with the question, how to say, the euro, 25 years, worked well, and we had great discussion presentations about these different aspects there. So it's not time, how to say, to ask those who are running the system inside and outside the ECB about their views. For those who are inside, whether they want to get out, or for the outside, whether to get in, or whatever it is, I think all answers are allowed. And so before I ask the first question, I would like to present here the governors to your left. Peter Casimir, he governor of the National Bank of Slovakia. Slovakia joined the euro already in January 1, 2009, and so he has the longest experience on the panel, and I'm sure we'll have a lot to say. Then to my left, I have Boris Vujicic. He's the governor of the Croatian Central Bank. He entered the euro almost 2 years ago, so he is the youngest from the group in the euro there. Then we have Peter Chobanov. He's the deputy governor of the National Bank of Bulgaria. Bulgaria, as you know, it's not a member yet. It's close by. It missed the inflation target by little, and it's hopeful, how to say it, that the next time it'll work out, with the hope that perhaps already in a year's time, Bulgaria would be also a member of ECB. Then we have Eva Zaranzilova, deputy governor from the Czech National Bank. She sits in for her boss, who is on business trip, but we're happy to have her here. We had great interactions in the past, and it's a country which is quite likely the one which has the greatest distance to the euro, at least historically and from the motivation part. So I'm interested in your views on it. And then to my right, I have Irena Radovic, governor of one, will be after Liechtenstein, not Liechtenstein, Luxembourg, the smallest central bank, the Central Bank of Montenegro. Montenegro is a candidate country, and with the effort, emphasis, and capacity, it may be among the first joining the euro among the group of the Balkan 6 countries there. And we are still missing one person. This is Jasmina Selimovic, governor of the Central Bank of Bosnia and Herzegovina, also a candidate country. Train is late, she's coming in, she will come here. So let's move to the first question, and we have 1.5 hours, but we have many panelists, so please be always very succinct. We have 3 rounds. So the first question I would like to ask the panelists, and of course starting out with the ladies, is a general question about what is your experience with the euro over the last 25 years concerning your primary mandate? So whether you were in, you are out. Whether you're in, how to say, how do you charge the competence and capacity of the euro to provide price stability? And when you're outside, is it that you did better, you did worse, or what has been your relationship with the euro? How much has it hampered or supported your support of your objective? And for this, as I said, let's start out with 2 countries which are still outside. I want to get into it. And starting out, Irena, please.
Thank you for such a privilege. I'm really delighted to be with you today, and particularly because, well, amidst of this conference, I received a very good decision and the news on official integration of Montenegro in the single European payment area as of today. And I'm really... Thank you. And I'm, as a governor who has recently taken the role as of December of last year, I'm really happy that efforts that Montenegro is undertaking are paying off, and that financial, well, integration into European financial ecosystem is already underway. Before replying to or answering Governor Holzmann's question, I would just like to highlight, so that everybody has a bit of clarity, how specific Montenegrin case and how unconventional Montenegrin case is. Essentially, Montenegro was one of the 6 republics of the former Yugoslavia. So during the 90s, when the wars were waged on across the domains of 5 republics of former Yugoslavia and one of the provinces, Montenegro clearly did not have any way to make an impact on monetary policy run by Belgrade, by Slobodan Milosevic. And during the years when United States and Germany were providing extensive bilateral support in preserving peace and stability in Montenegro, we came to a specific situation where, after the hyperinflation, which was among the highest and the longest in the history, where the prices were doubling on a basis of every 34 hours for the period of 92 to 94. We're talking about 324 trillion% of inflation. Montenegro came to a situation where the German mark became the prevalent currency in the system. Over time, in the 90s, through liaising with the IMF and with the Bundesbank at a certain point in time in the late 90s, we exchanged our foreign currency reserves for the German mark, introduced the dual currency system, and essentially from 1999, Montenegro had the Deutschmark as the only legal tender, which, as a repercussion of this, the decision of the government of Montenegro to have the Deutschmark as the only tender for payments, for accounting, and for savings, led to the situation where Montenegro adopted the euro, or when the euro was introduced, the same day when the euro was introduced in Germany to replace the Deutschmark. So essentially, my colleague of the Croatian National Bank is also president, and he had a role because at the time when Deutschmarks and later the euros were shipped to the Montenegrin territory, airplanes from Belgrade were over the Montenegrin territory. We had significant blockages of our borders by the army, so everything was going in, and it was actually helped significantly by Croatia. So why am I talking about this? I'm just saying that we are not a typical case of unilateral euroization, because the European Commission and the European Central Bank reached a decision in 2002, many years after, to prohibit unilateral euroization. Now back to Governor's question, where has the euro led us and where do we stand today? I can say that from the point of view of Montenegro as a small and open economy, adopting the Deutschmark at the time of turbulence in the Western Balkans and subsequently the euro was the best possible decision in terms of prosperity and stability of our economy. Euro acted as a bridge to monetary, economic, and institutional alignment with the European Union. And as a consequence today, starting from 2012, when we started accession negotiations, and 2019, when we opened all accession negotiation chapters, Montenegro finds itself at a very specific point. We have the roadmap to close all accession chapters negotiations by 2026, and the ratification treaty for joining the European Union is already drafted, and the process or beginning of ratification is supposed to start in 2027 to enable full accession in 2028. Where is Montenegro today? It's a country where price stability and lack of exchange rate fluctuation risk led to significant inflow of foreign direct investment, led to sound environment, led to significant economic development, and led to the fact that Montenegro today has reached a significant level of convergence and economic integration with the EU. When it comes to the remit of the central bank, clearly it is financial stability. We don't have price stability as part of our remit, given that we are actually adopting and applying the monetary policy shaped by the European Central Bank. But within our remit, clearly adoption of euro was conducive to a sound and strong banking system dominated by the euro system, systemically important, supervised systemically important banks, and the system which is the most sound segment of the Montenegrin economy. And as a consequence, Montenegro is also economically and in terms of convergence, undisputable front runner, and a country which is developing fast. I can only mention the beginning, or 1999, when Montenegro had GDP per capita, which was at the level of below 20% of EU average, to 53% today. Thank you. I stop here and we continue in the next round.
Sorry, there are so much to say, so many people here on the board, I have to be a bit pushy. Thank you, thanks a lot, and I think a fascinating story, and if I interpret you correctly, it is, given where you came from, being now with the euro, it's the best choice what you had, if I interpret you correctly.
Okay. Exactly.
Good. We come now to a different country, different point of view ever, to say as we know the position of Czech here. So what is your position, not your personally, but of the Czech National Bank now with regard to the euro? Because when we come to, I mentioned today in my speech a few data on the low support, low valuation of euro by the Czech citizens. Is this correct or is this misrepresented? How do you see it with regard to the inflation target? Because you had also inflation, it was higher at times than in euro. So how do you see? You still think it was good with regard to the inflation target to stay outside?
Well, these are both two questions. So the first one is the population and its stance, and second is our monetary policy regime and taming inflation in this inflation wave. So maybe I will start with the first question, which is the population. Population. Unfortunately, almost 3/4 of population is not in favor of euro. I don't think that this is a question of some mistakes or not loving euro as such, but this is a question that goes really very long to the past. To the First Republic, to the 20s and 30s. When after the First World War, Czech Republic, with its stable currency, was an isle in the inflationary Europe. We have our first Prime Minister, Mr. Racine, who really wanted strong currency and low inflation. And his ideas survived him up to 1936. So I think that own currency lies in the minds of Czech people as a symbol of prosperity, price stability, and also fiscal discipline, because it was also these politicians that were very, I would say, in nowadays terms, they have strong financial literacy. Yes, and as for the second question, I don't know whether it's time now or in the next question. We were in the next round where. As a bank board, we were very happy to have our own tools that we could use for taming inflation. Because inflation wave in the Czech Republic was very strong and started sooner than after than as a consequence of the Ukrainian war. It started sooner, and Czech National Bank recognized well the nature of inflation after the COVID period, where sluggish supply side met the strong demand side, because the demand side was saturated by fiscal policy. Yes, so. I am going maybe into the details in the next round, yeah. But I can just now say that we use both tools. That's interest rates and the exchange rate channel, and we were quite happy to tame inflation, to be almost the first in the developed countries to reach inflation target as soon as in February 2024. So we could also start easing monetary policy as soon as early as in December last year. So some more details in the next round. Yeah.
Well, thanks. That was all informative. Because what you said, you had high inflation, that the euro, but you also came down earlier. So we were able, without the euro, how to say, taming your inflation, which came from the outside. So we are successful in your sense.
Pardon?
No, you tamed the inflation outside the euro. The inflation came in earlier, but you also came back to the target level earlier there. So looked from this point of view, and you had high inflation, you were successful. So you could stabilize with your means, with your instruments, inflation very well.
I'm afraid that if our monetary policy rates followed the monetary policy rates of ECB, that the inflation probably would be higher now.
Okay. Thanks a lot, Eva. Now let's move on, how to say, to the newcomer in the euro area, Peter Casimir. You're there for 2 years. You had, how to say, been involved in policy setting for, would claim, decades. You have been around, so you have a very strong experience, quite likely the longest from all us. I think if you all come together, we won't be able to exceed yours. So, as a result of it, you can compare the different waves you had, also a high inflation period in the very beginning, etc. How would you assess, how to say, when you look now at the inflation target, as part of the euro came in at a moment when inflation was high? So, how would you see now? Was it easier anyhow, so no difference, we were able to do it, or say, actually now it's much easier for a governor to sit down, be part of the council, and the inflation is higher? It's not me, it's the others.
Yeah, it's easier, but it's not because of that. Well, when we started, when I started in the bank, we did not, of course, target the inflation. I'm coming from the exchange rate targeting regime, and basically after the stabilization program in Croatia, which was done during the war in '93, we have basically been pegging the currency to the first Deutschmark and then the euro, and the choice was very obvious for us, primarily because of a high level of the currency substitution, something that was discussed on one of the earlier panels. You could have seen there that the extent of the liability euroization in Croatia was 70% at some point, which then resulted also in the asset euroization or Deutschmarkization in the first, of pretty much same order of magnitude, because if banks have on the liability side the foreign currency, be it the Deutschmark or the euro, then they want to hedge their foreign currency position. So on the asset side, they also have the same. Before entering into the Eurozone, just to give you a flavor of it, we had amount of foreign currency debt of all sectors, government, corporate, and household, equal to 115% of GDP, of foreign currency debt, denominated. So from the foreign currency bonds of the government to the corporate and household. That means that depreciation of the currency of 10% would increase the debt of all sectors by 11.5% of the GDP. Or depreciation of 20% would increase debt level of all sectors in a country by almost a quarter of GDP. That means that the depreciation of the currency is clearly pro-recessionary, leads to the recession, rather expansionary, like in the normal textbook cases. And that then, of course, leads you to run a policy of pegging the exchange rate, and that has served us very well. We never fixed the exchange rate. We had a managed float, but relatively tight managed float, plus minus 5% usually, sometimes went up to 7-8%. And the inflation rate in 25 years prior to joining the euro was on average 2.6%, while Eurozone was 2%. So 99 to 2022, our was 2.6, Eurozone was 2%. So you could say that served us very well anyway, our previous regime. However, as long as you have such an exposure to the FX risk, that's reflected in the price of capital. So interest rates were higher in Croatia. So if you look at all kinds of interest rates, but interest rates in the money market, or the interest rates on government bonds, or corporate household loans, depending on the period, I mean, they were higher 100 to 200 basis points over the Eurozone average. The moment we joined, they came down and actually are now in September this year. For example, the mortgage loans were cheaper in Croatia than in Germany. Corporate loans were a bit cheaper in Croatia than in Germany. And this is the difference, you know. Once you eliminate the foreign exchange risk, and the only way to eliminate something which is of the amount of 115% of the GDP is by joining the euro, because then on 31st of December you have 150% of the GDP in foreign currency debt. On the 1st of January you have 0.7%. It's a magic. It's gone, and obviously, for example, the moment that the Council confirmed that Croatia has satisfied Maastricht criteria, all rating agencies increased the rating by 2 notches next day. Wow. Because you see that the foreign currency risk will be gone from the equation, and since then we went to A rating now in less than 2 years, because of the elimination of the foreign currency. So you can say on one hand, okay, we could have controlled inflation with the previous regime, equally well as the Eurozone did, but we could have never eliminated this size of the foreign currency risk without joining the Eurozone, and it has been reflected in the spread of all interest rates against the Eurozone, which is now evaporated.
Great, I think it's a great story, what you're telling there, how to say the different angles coming to it. Actually, I missed this story. How do you change your foreign debt so quickly? It's
and it's gone.
Great trick. Okay, thanks. Now we have also Jasmina Selimovic here with us. Thanks a lot. I will give you the floor then together with Peter, our colleague from Bulgaria. And what we're in now, if you have heard about, the question is dealing with inflation target, easier outside, easier inside the euro. What are the advantages there, the pluses and minuses there? Then we come to Peter Casimir, said governor of the central bank, but before he was also Minister of Finance. So when he took on this position, was there any need to hide some public debt which you have accumulated as Minister of Finance, or any special reasons, how to say, that you say, actually, I took over, it was great, you know, I don't have to deal with this issue? Sorry. This was facetious. Now, how do you see being inside the euro when it comes to inflation setting? It's much more easier nowadays because one can relax, sit back, discuss with colleagues, but what is not, how to say, the point of interest anymore.
Dear Robert, the first lady, thank you very much for having me here. And I would like to start, I would like to stress that the Eva and me, we were born in Czechoslovakia and also in the same country many, many years ago. And you see that, the perception of the euro in Czech Republic and Slovak Republic, and my country, in my home country, is totally different, in that way. And here I must say that the euro in my country is and has been the big success. And maybe I'm biased because my professional career is firmly connected to the euro in my country, but it's really, I'm the euro enthusiast and euro optimist in this point of view. So there's no way to convince me that the keeping the Slovak crown and monetary sovereignty, independence would be a better option for my country in the past, either now during this inflation spike. Because definitely the euro has been the source of stability and shield and shelter in very difficult times. And I remember, the beginning was quite bumpy, because just to be very honest, and just remember as a veteran, the big countries as Germany or France in 2007, 2008, honestly, how to say this politely, they were not very enthusiastic about our membership at that time. The official reason was sustainability of inflation at that time, after the Slovenian case, which was not the most successful from this point of view. And the second issue was convergence rate, so GDP per capita, compared to average in the Eurozone. So at that time, I must say, because there was Stark, for example, in ECB, in the Governing Council, was sitting in the executive board, and he was strictly against, to join the Eurozone earlier, so because their recommendation was to postpone the process, but just realized that was in 2008, yeah? So afterwards, we, thanks to the diplomatic, initiative, and thanks to results, and thanks to the friends from Austria, from Netherlands, from Finland, from much smaller countries, we managed to convince the colleagues in ECB and also in capitals that that's a good idea to join the Eurozone, and it happened. So decision was done, was taken in 2008, just before Lehman Brothers. So we joined the Eurozone on 1st January 2009. So just in the middle of the storm, So, and for that reason, the perception in the country was that we survived, or we overcame, this crisis without any, inflation spike in that area, thanks to the euro. So we were the country where the public support for euro was even bigger after joining the Eurozone than before. I don't know how it is in Croatia, but in other countries that was totally the opposite, because remember, this perception was everything is much more expensive, a lot of problems, a lot of sentiments behind. So that was our story. We were lucky, definitely we were lucky, because afterwards we would be not able to meet all these conditions, because the debt was there and the deficit went up, So that was a really last train for us, this 2009. And since that time, simply with my country, we grew beyond Slovakia, with the seat at the Governing Council. And we as a country, the manufacturing is very important, so we are car makers. Simply for us, that was the membership was really to guarantee to access to the capital flow, and many other so conditions was much more smoother.
Thanks a lot. Another fascinating story, because this part of it just coming at the last moment. Instead, otherwise, we would have to wait perhaps a decade longer. Now we come to a special case, Bulgaria. Thanks, Peter, coming here and joining our discussion there, because you had a link with, how to say, with the D-Mark, and then later on the euro 27 or so years out of it. So you have had this exchange rate mechanism, this board mechanism for a long time. And so you were already restricted, and that's the reason why you had it, because you wanted to have stability. So now, when and if you were to become member soon, what would be the difference then you would expect with regards to price setting there? Is there something which you would have in addition, would say, okay, we are fine now, but finally we want to sit there and we want to vote with the others about monetary policy? So what is, how to say, the objective function when you look now at it? Or I don't know the history about your inflation rate, but I understand more recently they were still larger than what you normally had, and they may risk again. So, Peter, up to you.
Okay. Thank you very much. Thank you for inviting me. I'll try first to focus on the euro and its important role for our monetary regime. And all here we are convinced that we need and we are maintaining the monetary regimes which are based on explicit rules which are followed. So the currency board was introduced after severe banking and financial crisis in our country. 1/3 of the banks were closed, and we have also hyperinflation. And it is clear that Bulgarian currency, Bulgarian leu, is fixed to the euro since the very beginning of the existence of the euro. So the euro and the currency board helps with inflation, providing the anchor for the expectations. Inflation expectations, which was very important to stop the inflation inertia and to be back to reasonable level of inflation. And currency board is based on strict rules, doesn't refinance the banks, does not monetize the government debt directly or indirectly, and the creation of the money is demand-driven, and it is backed by the reserve currency, the euro. So the role of the euro is very important, and currency board arrangement help us to avoid the fiscal dominance as well as the time inconsistency problem of the monetary policy, and preserves the independence of the central bank. And as a fact of this avoidance of fiscal dominance is our developments in government debt. Before the introduction of the currency board, we have 120% of GDP government debt. In 2008, it was only 13%. Now we have 24%, so you can see that this is the case. So what is the main difference? The main difference is the risk premium. So as Boris said, when we have the decision to join the Eurozone by our European partners, we will experience the same. So the credit rating agencies will increase our rating. So now we can say that we are at the ceiling of our rating. It is not dependable on what we are doing. The rating remains the same, and this is the highest we could get being outside the Eurozone. So we know what the risk premium means, and this means that this will boost investments, this will promote competitiveness, of course, if it is accompanied by structural reforms. So this I could say.
Thanks a lot. Now, how to say a very simple answer. You know, joining, you already had it, but now you finally found to have the lower risk premium. Being a member there makes a lot of sense there. Jasmina, thanks again for joining us. Glad that you could make it there. Where also put you last, you could hear a little bit what kind of interventions are taking place. You missed your two colleagues from the West Balkan countries starting out. The idea of this first round is to say you want to join the euro. What are the kind of motivations what you have as regard to euro with regard to interest rates? Are you afraid that you have a story where the inflation rate was too high and you couldn't do it? Do you expect a better inflation performance once you're in the euro scene? What is, how to say, your motivation? Then also perhaps like Peter, is it the risk premium you are paying there? So what is the motivation? But start out with regard to the inflation, since it has been a common theme here. Welcome.
Thank you very much for having me here, and apologies for being late. Plane delay and the traffic jam caused this, so apologies. And actually, it perfectly makes sense to have Bosnia and Herzegovina after one currency board to have another one, because as you know, Central Bank of Bosnia and Herzegovina operates under the strict currency board arrangement. And from 1997, when the central bank was established, actually we had at that time the convertible mark was a currency, national currency linked to German mark at the rate 1-to-1 at that time. So practically when the euro came, the relationship between a convertible mark and the euro was actually the same one as a German mark and the euro. So that was that's the history. Being a central bank with a very young currency at that time, and until 2010, it was allowed to have transactions in the country using both the euro and the national currency, if the both parties agree. So that was actually some sort of our backup. After, and that was, let me remind you, 14 years after the national currency was actually became the legal tender in the country. After that, we established we actually changed the logic a bit, allowing the cash transactions in euro were not allowed anymore. But if both parties agree, then the transaction from one euro account can be transferred to another one, and the transactions were very smooth. So the relationship and actually the exchange rate was not questioned at that time, and actually neither is today. When it comes to the inflation, actually, this is the target that we are for now having under the control in a very nice manner. And actually, since we are very much exposed due to currency which is fixed to euro with a fixed exchange rate, everything that happens in the eurozone in the European Union, that's the way how we import all the influences in Bosnia and Herzegovina. Having a massive geopolitical and economical bloc as the Eurozone is just on our doorstep, and bearing in mind that close to 70% of our trades and goods and services is coming from the Eurozone, is actually something which is putting the very clear path on behalf of the Bosnia and Herzegovina. I believe that actually having just mentioning that the rest of the trade above the 70%, it's mainly with the region, and in the region we have the national currencies which are fluctuating around the euro very closely, or we have the euro as a currencies as in two countries that we have in the region. The banking sector in the country, it is mainly owned by the Eurozone members, by the banking groups in the Eurozone members. The regulation within the banking sector, it's fully harmonized with the EU regulations. So actually, with that, we are taking a very close look to everything what the European Central Bank is doing, because 95% of the central bank asset of the reserves is actually need to be in the asset of the which is in the euro. So I believe that formal commitment of authorities in my country is very clear. We need to proceed on our way to European Union. There is, and the proximity of European Union and the euro by itself, it is only something that can help us a lot in our holding our monetary policy as it is right now, and of course taking care of the inflation.
Thanks. As you said, yeah, also currency board there, so you already have this fixed mechanism there. So being a member there, how to say, allows you to vote, not only take it passively and take over the monetary policy. This would help. We have to step up a bit now, shorten the answers, but it should be relatively easy. The next round, I also tell the third round. The third round afterwards in the same order is then again where the euro will be, what you think in 25 years. So you can only spend one sentence, 1 minute there on this one. The second one may take a little bit more time. The second one is one of the eternal question. I think I alluded to it, others did to it. The question is, should you join a currency union early on as a mechanism of convergence, or should you first grow, have the revaluation and then join? Because you can do it easier outside than inside. And this is an internal question which also science has no answer yet, but I want to get not the answer of science, I want to get your personal answer, what you believe, saying we want to have the euro because we think we can grow faster, or saying, well, we don't expect that, but monetary considerations dominate, and so growth, whatever it is. So your 2 minutes or 3 minutes, please, Irena.
Thank you. I can say only that since the adoption of the German mark and then the euro, Montenegro was growing on average by 6.7%. So this tells enough. If we have a look at the post-pandemic period, we are growing on average at 8.6%. And this is something which positions, gives an answer why I said that euro was a success in Montenegro and that it was the best possible decision that we could have made as a small and open economy. When we have a look at inflation, starting from the period when we introduced the euro, where the inflation was at the level of 129% in the year of the introduction, we have since had only single rates, and again, pretty aligned with the inflation rates in the euro system. Last year, we finished with slightly higher rates due to expansionary fiscal policy of the new government, which was at the level of 3.9% compared to 2.9% in the euro area. Currently, in September, we are at 1%. So essentially, this is proven as a good model and good recipe for convergence when it comes to inflation. And when we're talking about interest rate, I think Boris and also Peter, to a certain degree, have underlined where the challenges lie and why country risk, again, becomes incorporated into a bigger picture and where there is a certain divergence compared to the euro area interest rates. One segment which is very important, and clearly that Montenegro, among Maastricht criteria, cannot fulfill the last one of fixing the exchange rate to the euro because it uses the euro. I'm talking now about fiscal criteria compared to the public debt, which was at the level of 105%. Now we are steadily at the level of 60%, and we are steadily in the domain of budgetary primary surplus compared to the previous years prior to the euro, where in general we were running from 20 to 25% budget deficit. So I believe that the answer again to whether we should adopt and converge or converge and later integrate, I believe that Montenegrin experience is a very positive one and talks in favor of the former. Thank you.
Thanks a lot. Thank you. I think it was a clear message. When you alluded to the 60%, do you think you could give them technical assistance to some of the current countries there?
Well, when you are not part of the euro system formally, but when you're constrained by the Maastricht criteria, you do take very, very strongly into account recommendations from each economic and financial dialogue with the European Union. So I believe that that is the case and will be the case with all the newcomers.
But some apparently don't speak French. Sorry. Forget what I said, okay. Eva, in your case, how to say, you're, the outstander, in the sense you don't want to go to have the euro, and you have had great growth rates, which nowadays are coming down a little bit. So staying outside the euro, as you will, is this something where you expect that you will still be able to outgrow the average? Or do you say now it would be time, to join the club, or saying, no, we want to converge outside. We have been outside, we want to take from the outside, and once we have the highest GDP per capita, then perhaps then we will be able to join. Okay.
Well, I said in the previous round that I think that our own monetary policy helped us to tame inflation.
Okay.
But I don't think that any difference in monetary policy can help convergence. We were converging quite rapidly until 2016-17. Now the convergence has almost stopped. I don't think that that adoption of euro can help this. Yeah, I think just one small notice. Our economic story with Slovakia is very similar, with different monetary policy regimes, and we can speak about Scandinavian countries with 3 different monetary policy regimes: Sweden, Denmark, Finland, and having the similar stories about economic development. So that's not about monetary policy, and help would neither help convergence, but it also would not be any harm for the convergence. Yeah, okay. We just do have our some homework, because our economic model has been exhausted. It's a model with close ties to Germany, to exporting machinery, especially car industry, etc. So this is very painful, and that's our homework to cope with that, and that's the question for whole economic policy, structural policies, and at the same time, we still have to be careful about fiscal imbalance, because now we are still in the territory which is the indebtedness is around 44% of GDP, which seems very low by European standards. But unfortunately, the trajectory of growing indebtedness had been quite rapid, and there is and the demographic pressures and the structural deficit of public finances are not still sufficiently addressed. So this is another part of the homework that's not about growth, but it's about sustainable growth. And I would be a little bit careful about adopting euro in a close future, because I think that this could create some moral hazard for politicians to have the euro umbrella, as for issuing new debt. So first, I think that public finance should be under control.
Okay.
But not just for 2, 3, 5 years, but for 20 years.
Okay, no, thanks a lot. Important point that you're making there. Moving over now to our colleague from Croatia. When you had growth before, now your growth has not been hindered. So was this the growth premium because we have no lower interest rates now? Or what was it, how to say, because more recently the growth league, how to say, in Europe, high up there. What was the reasons? At least participation did not hinder your convergence.
No way. I mean, we are clearly now, for the last few years, one of the 2 fastest growing countries in the EU, so certainly it has not hurt, and it has helped actually the convergence and growth. How much exactly is very difficult to say, but there's no doubt that the entry into the Eurozone has helped. On your original question, I would say if you put your macroeconomic house in order in terms of what we call in Europe macroeconomic imbalances. So if you put macroeconomic imbalances in order, no matter where you are in terms of the convergence, it makes sense to adopt the euro as soon as possible, because it will only help, because it will reduce the risk premium and it would help the convergence rather than the other way around. And of course, you can always revalue your currency after you join the Eurozone. It's just that you're revaluing it through the inflation differential, wage differential, etc. So in real terms, you always can revalue as you converge towards the euro.
Okay, thanks a lot. So Peter, you have been for some time there. So did this conversion happen also in Slovakia? You had high growth rates.
I must say again that the euro has had a profound and positive impact on our economy and supported the price stability. And by becoming the part of the Eurozone, many other risks were reduced. I'm especially talking about, for example, the capital flows. And everything this is helping to the investment, of course. So, and also when we are talking about the euro adoption, we saw the reduction of interest rates and the easy access to European capital. So, and it for both for public, also for private investment. So definitely I think in our case, the euro was very helping us, and also what Eva mentioned, so as you mentioned also that in my previous capacity, for us, for me, for my political comrades, so the membership meant, to be more disciplined, so opposite, more discipline, so we introduced very strict debt break, for example, that time, so I just would like to remind you that in 2012, due to debt crisis, for example, my country was penalized because our sovereign rating was downgraded together with Austria and 9 other countries, so that was the welcome kiss, in the club that I remember in city during the in London City during the first benchmark issuance, they told us, you are in the Eurozone, so you have to pay more now for that, so that was the time in 2012. So it's really, but I must agree that it's totally different club from this time in 2009. After that crisis, after many other issues would happen, so I do hope much better, much more reliable. But to do it, to join before or later, so a little bit it depends on business model of the country. I think, So, but it's, in our case, definitely was very helpful in many areas.
Okay, thanks a lot. Now, we come to a difficult case, at least from my point of view, because Bulgaria had linked to the D-mark and euro for some time. You have had a very stable macroeconomy, but you didn't grow. Compared, how to say, convergence was very low. If you put it compared to other countries. So the question is, joining now, are you expecting now that the risk premium, lower risk premium, is the thing which will help you? Is it that a stronger view at governance will help you? What are the kind of growth drivers you expect now from here on? Because when it regards GDP per capita, it was not as one would have hoped, also from Bulgarian side in the recent years.
So it's a very good question. So if you allow me, we could really look at the figures about the real convergence. And if we took the latest 20 years, because recently I made the research not for the 25, but the 20 years, now we could see that on average, having in mind the GDP per capita in PPS in nominal terms, now we stood at 64%. So for the latest 20 years, we grow by 1.5% a year average, which if you look at the EU 12 countries, including Malta and Cyprus, but that doesn't matter so much in this, only 2 countries converge quicker than us. It is Romania and Lithuania. So in terms of the real convergence, we are the poorest country, we are at the lowest level yet. I think that we will surpass Greece soon or late in the forthcoming years. However, the convergence is not so bad, and the euro helps a lot in terms of the convergence process. One of the most important helpful factors is the wealth effect. When we are fixed for such a long period of time, and when we have the reserve currency which preserve its price for much more stable than our currency, this leads us to this wealth effect, so we could see this. And we have no choice, no other choice in terms of monetary regime because of the fact that we are small and open economy, and there are some research that before the introduction of the currency board and fixing to the euro, 70% of the volatility of inflation is due to the volatility in the exchange rate. And we have very, very fast pass-through effect, so we don't need, and we couldn't use the exchange rate as absorption of shocks or whatever. So now, it is really the time to join the Eurozone Also, it could be seen in the figures because our inflation, the forecast of the European Commission, our own forecast, the forecast of Bulgarian Ministry of Finance shows that our inflation will be within the criteria at the end of the year. And also, according to the latest forecast of the European Commission, we will maintain this throughout the next year. So we will reach this state. So, and then, especially we have this risk premium, but we are also part of the banking union and TRM2. So the best strategy is as soon as possible to join the euro. And we could see from the figures that euro is really helpful to even to our real convergence.
Okay, thanks a lot. Thanks for the addition there, what the expectations are in addition, what you have there. Yasmina, now to you. So what are your convergence boost expectations with regard to participating in the euro? What are the kind of things you think will happen additionally once you are there to your convergence path?
If I refer to your first question at the beginning, you mentioned option 1 and option 2, then option 2. And now let me give the elaboration. The speed of convergence for Bosnia and Herzegovina, if we measure it by GDP per capita in PPP, it's a very slow. It's not only in Bosnia and Herzegovina, it's in some other candidate countries as well. In our particular case, it has nothing to do with the fixed exchange rate to euro. However, it is mainly related to existing structural reforms that are not implemented in a country during our pathway to European Union. The European Commission asked for the very particular structural reforms with the final aim of national governments to be able to maintain under the market environment, let's say, with no needed support from the budget. But unfortunately, this is something that didn't happen. So asking about if it is a prerequisite or not, I believe that membership in the euro area is rather the consequence of the structural reforms on our way to European Union. So before the accession and aligning with the legislation of the European Union when we access to EU. Having all other macroeconomic criteria in balance, just as Boris mentioned, I believe it's very useful to have euro as a currency, but it cannot be defined as a prerequisite or something that can speed up the convergence. So I don't see it as a factor that can contribute to the speed of convergence, actually to enhancing the convergence.
Thank you also for this very clear assessment. Now, we have 30 minutes, which we will split up. At the end, 1 minute is here, so 6 minutes in order to say euro in 25 years, how you see it there, what you expect them to be. So you can think about the answer while we open it to the audience for questions, so some 25 minutes or some 20 minutes. Please take the floor if you have questions to individuals here, or if you want to raise with short interventions, please, your view about convergence. Yes, please, I don't see the person, but I see the hands up.
Yeah, good afternoon. I'm Juraj Pala. I'm a researcher at European University Institute. So I have a question to Ms. Deputy Governor Eva Mrazilova. Well, you mentioned this aspect that you don't think that the monetary policy could be something that drives growth, but I think that euro is not only about policy, but it's also about a symbol and also a means of exchange, and it's something that was very important for investors and foreign investors that ask for this, for example, in Slovakia, that it was something important for them to invest in the country. So in this case, I'm wondering what do you think that the Czechia has to offer to its foreign investors to compete with its other neighboring countries if it doesn't have a euro? Or is it? Do you think that the Czech Republic is less interested in having the foreign investors, for example, from the euro area?
Oh. Did you understand? It was a bit question, essentially saying you need foreign investors, and if they had the euro, they would easier come to them. So not just I want to say that I wanted to give you the time to reflect on it, so in case you haven't fully understood it. Okay.
Yeah, it is. I will be very, very, very quick and simple. The level of FDI is one of the highest, if, not only in Europe, but maybe in the broader region, amounting to 60% of GDP. The outcome is that half of the company sector is owned by foreign owners. 90% of banks is owned by foreign owners. And the outcome is that the outflow of dividends out of the country is some 5–6% every year. So, and why the ratio between reinvestments and dividends is very low in the Czech country, in the 30% of reinvestments and 70% of the dividends. This is another question, and this is probably about the bad infrastructure, business environment, a lot of bureaucracy, etc. That doesn't belong here. But I think that as for the investments, we were very open, and we need to attract some investors, but select them with really special high-tech profile, high value added, etc. So I don't think that the question of currency is important here, because the companies under foreign control are operating completely in euros. That's another story that had complicated our monetary policy during the inflation period. But in our country, the exporters and the company sector is operating with euros. So there would be, I think, any difference. We don't have to compete. We competed in the 90s and we won. And the outcome is not that bright, as I tried to indicate.
And now I would like to help a little bit Eva with that. My experience is that the euro was very helpful, to attract to FDIs, but it was not decisive anymore. So we are competing in the region, just to be very honest, so with, as my country is competing with Czechs and with Hungarians and Poles. But I must say, for example, we lost several investments, not because of the euro, but because of the other government. For example, Hungarians offer more on state aid, because, this is about the money at the end of the day. So this is my experience. So this is business environment, it's really crucial. Many, many other also issues.
Okay, thanks for the addition, Peter. Further questions here? Yes, thank you. Against the light, it's difficult to see. Yes, please.
Thank you.
I was missing you.
Yeah, Franz Nauschnick. My question is, we heard before some Anglo-Saxon professors or Anglo-Saxons which were very critical and saw mostly negatives in joining the euro, whereas those who do it actively were mostly in favor and said the positive things which really happened. Why do you think are the Anglo-Saxons so negative on joining the euro?
The question is directed to whom?
Because most of you were positive, and we had before an American professor saying, no, you shouldn't join, and it's negative. What do you think is the difference between these views?
The main difference for me is that when you are inside and participating in all this, and you know how important is the euro for your economic development, you should be more euro optimistic, and you should try your best to help the euro to be more optimistic. So I think that for myself, this is the main difference.
I would advise whoever said that I was not here to try to run a small open economy bank outside of the euro for 20-something years as I did, and would very quickly learn that it's much easier and better to be inside.
Okay. I agree, but abstain answering the question. I think it's was a relevant question. Yes.
Okay, but what is negative, maybe? And this is, then I will. This
No,
is
no, it's
this is my
a panel here.
Last presence is, and this is connected to the question on 25 years, what we have to see. The problem is that this project is not completed yet. So we do see a lot of gaps, in the architecture, and still and this is chronically known, so this is about the banking union, completion of banking union, completion of CMU, capital market union. This is the major issue, so what we have seen. And then the fiscal union, which is probably taboo nowadays, because there's no political appetite to do it, no political will, because we do see the rise of nationalism and many other trends in Europe, but definitely compared to the other monetary unions in USA, for example, we need these parts of construction, because otherwise we suffer, as we suffered during the debt crisis, as we suffer sometimes with Robert and Boris in the room, when talking about the rates and about about divergence in countries. Would Eva mention this fiscal responsibility, our fiscal discipline, or we miss maybe more market discipline. And there's many issues which can miss.
Okay, thanks. We have another question coming here, but for the others, since it's a final round, and this is the question about euro, so please feel free having a short intervention to air your view about the pluses, minuses, and where changes could happen. Please.
Thank you, Mr. Governor. Until now, the focus of the discussion was on convergence, and more or less each governor defended the way his or her country did it. But the euro area is very different from, for instance, when Slovakia entered, and also because of the new situation in the world. What I find interesting is that on this panel I did not hear once the word geopolitics. So is this not part of the assessment? And I'm sorry, Mrs. Zamrazilova, that everybody is focusing on you, but may this also be an argument for the Czech position to change sooner than in 20 years, that we need the euro as a political unity project? Sorry.
Sorry, no, you can say no comment, it is for the writer,
I'm quite unhappy that there is so much politics in Eurozone today and just a few pieces of economic thinking. I'm very sorry about that, I have to say openly.
Yes, please.
Hi, Rilint Kabashi from the Joint Vienna Institute. Just not to focus all questions on Ms. Zamrazilova and to continue with Birgit's focus on this geopolitics. So Bulgaria is, if I understood well, currently being held up because of some small differences in inflation. But if we talk about geopolitics, isn't like adding one more member and widening the euro area more important than very, very small decimals in deviation, current deviation from Maastricht criteria? And again, sorry, Ms. Zamrazilova, but one question on this independent monetary policies. We also heard earlier, the Polish case. Your economies, Czech, Poland is perfectly almost integrated with German economy and business cycle and so on. So shocks are almost symmetric. So how much sense does it make in these circumstances to have independent, monetary policy? Most cases you have to react in the same manner, like you are hit by the same shocks, and de facto most of the time you follow European monetary policy. Not perfectly, but almost. Thank you.
Maybe first I could address,
yes, please.
because
Yes, please.
Bulgaria was mentioned. Thank you very much for mentioning Bulgaria. Yet, yes, we could also be success story when we joined the Eurozone because of the fact that we really have one of the lowest public debt in the European Union. We have very good fiscal track record, and we will be in favor of fiscal discipline within the Eurozone as well as we were outside the Eurozone. So I think that really you are right. And of course, we want to fulfill the criteria and to follow the rules as they are. So we really think that at the end of the year, we will fulfill the criteria.
We have a request here. The governor from Georgia.
So thank you very much. I'm relatively new to this discussion, so forgive me some probably stupid questions. But I wanted just to continue the question regarding independent monetary policy. As I'm attending numerous international events these days, we hear a lot about faster speed of monetary policy reaction in emerging markets when COVID happened. And some advantages of having this ability to be faster, probably less bureaucracy, less inertia, etc. In comparison to some mature central banks, including ECB. Can anyone comment on that? So do you see any issue there?
I could maybe try it, but it's not only the COVID, it's also post-COVID when the inflation rate started to go up. Yeah, emerging market countries this time around, as opposed to previous cycles, reacted faster and stronger than the developed market central banks, which is basically probably a consequence of the fact that they've learned from the past, that they will be hit by the interest rate differentials and the capital flows in such a way that it's better to act in advance and prevent that, which this time around emerging market countries did very well. But what helped also is that the fundamentals this time around were better than they were previously, for example, during the great financial crisis or Asian crisis or whatever. But on the independent monetary policy, it's really very difficult to run independent monetary policy if you're a small open economy. I did it for 22 years, running that independent monetary policy, and I mean, basically you have to follow what the big guys are doing. When the ECB started to print money, I had to print money. I didn't want to, but I had to, because they were creating so much euros that in order to prevent the appreciation of your currency, you have to buy all those euros. So you're doing a QE, but not by buying the government bonds, but by buying what ECB prints, euros. And what can you do? I mean, there's no way you can run an independent monetary policy in these circumstances. So that argument, keep your own currency in order to run independent monetary policy, that it just doesn't work. I mean, even I'm coming from London, and we had a discussion the other day there, and most people would say that UK is a small open economy. It's these days, yeah, it's the fact. I mean, it's very difficult to run counter the large central banks who provide the. I mean, you have Helen Ray financial cycles, and the large central banks provide financial cycles. Small central banks have to simply adapt to that. I was doing it for better part of my professional career. Okay. Well, in spite of trying to run sometimes against it, but you can do some things. It's not that you cannot, but basically you don't do it through the monetary policy tools. You do it then through the macroprudential tools. But macroprudential you can use even when you join the Eurozone. Now that can help you to some extent to ISO, but never fully.
Can I add something, yes, because it's connected with the answer. Yes, it matters also the independence of the central bank. So in our case, we do not have independent monetary policy. As currency board, we are importing the monetary policy, but we have some flexibility. However, this is not the topic, but this helps us to have more independent central bank. And in our case, fiscal position matters a lot for the monetary conditions in the country. So the governments know that they do this, and they were disciplined for a very long period of time. So this helps to avoid the fiscal dominance and to make the central bank more independent. And after joining the banking union, this gives us additional instruments and additional credibility in order to be independent and to fulfill our mandate. So this is the case.
Okay, thank you. Piroshka, please.
Just so that maybe it's useful to recall Madam Governor's excellent question. The experience, this post-COVID inflation experience in Slovakia, which is EMU member, and thus did the, by ECB design, a later policy reaction to inflation than did the Czech Republic, Hungary, and Poland, the other Visegrad countries. And what we see when you compare is that even though Slovakia reacted later to the same shock, because these countries are very similar in terms of exposure to the energy shock coming from the Russia war. So the inflation performance, Slovakia was a little bit better, actually, than all the others, Hungary outside, because it's an outlier, we know. And rates came down. So, sorry, Slovakia increased later and less, because the ECB increased less, but was able to bring down inflation very fast and back to target level. So it seemed that the sacrifice ratio, how much output loss you had to suffer in order to bring down inflation, was actually smaller for Slovakia being member of the EU. And why that is, one wonders, and I think it's, if I may, it's the credibility of the ECB with a very big balance sheet, it has helped. Let me just add also that in crisis, everybody here, right, had to rely on ECB's swap and repo lines. So adding to the monetary independence in that. So it's very useful to have the ECB, being in the ECB club.
Okay.
It's obvious.
First, it was probably a part of the question is addressed to me. Yes, of course. That's a really legitimate question, how much output was lost. And, but from the point of view that all the export companies had the advantage to be financed by EMU interest rates. So on the part of the exporters, I would say there was no loss of exporters, etc. There are other parts of the economy that we, since half of 2022, tried to address by the exchange rate. There were interventions to the exchange rate since the beginning of the Ukrainian war. And since the second half of 2022, we continued in verbal interventions. It was not that costly, because we as a country, we are in a very specific situation, because as a legacy of previous monetary policy, that was the exchange rate war in 2013 to 2017, we have extremely high FX reserves. Our FX reserves amount to, I think now, 40% to GDP. I think that's some 137 billion euros. So we had this advantage. If we had not this advantage, my responses may be a little bit different. And as for the resemblance with the Slovak inflation story and different monetary policy, yes, this is a topic, and now we started to revise our monetary policy framework, because yes, we do have some problems about the transmission mechanism, about the details of the models of the model used. We are in a big minority. We are in a minority of countries using just one DSGE model, while other central banks targeting inflation use either 2 or more models, or the only one is not DSGE, which is, but I would be too long for this part. But yes, this is a good question, and I understand it well, and we will try to do something about it. Yeah.
Okay. We have a last question which we won't answer because we have to go in the final round, but I'll let you ask the question, okay?
Thank you, Mr. Governor. Just 2 short questions, one regarding Bulgaria, the other one regarding Montenegro. Mr. Chobanov, I'd like to know how much the political turmoil in Sofia, 7 elections in 3 years, hampers your way to the Eurozone. And the other question regarding Ms. Radovic, when do you expect to become a formal instead of an informal member of the Eurozone?
Thank you very much for the question. 2 years ago, it really impacts. Now, the role diminishing, and we as a central bank, we are trying our best in order to help to the process, because we know the importance of the process. But you are right, yes, political uncertainty also influence the process. So that's why we are telling that the rules are very important, and when we meet the criteria, we could think about entering the Eurozone, whatever the political situation is. Because, for example, our caretaker governments prove to be more disciplined than the regular one. So this is the case. Thanks.
Thanks a lot. In your case, you can weave your answer with the large question. You will start anyhow. Last question, we have 6 minutes. We have 6 answers. Your vision about the euro in 25 years, you can say, well, by this time we have been 23 years with the euro, so you can weave the answer to that, so you can answer it. So let's start out, we do the same round again. Your vision, Euro 24, is it something we'll say it will be history, or is it something, we will have, 50 members?
I started my governorship with a vision and a dream of my own to be the governor who will lead Montenegro in the euro system. So what I have been doing over the past year is running fast and delivering more than 15 pieces of legislation to the parliament in time to close chapters which are within the remit of the central bank. And I'm currently undertaking, together with colleagues in the euro system, a very demanding exercise of converting Montenegrin central bank into the euro system compatible bank. So my answer to you is we cannot fulfill we cannot be part of ERM2 in traditional way, but clearly what the governor and the program of this conference today outlined, some of the criteria which are not applicable and which are outdated don't need to be there in terms of possibility of a derogation. So my hope would be very soon after the formal membership. When it comes to the view of the European and Monetary Union, this morning when we were listening to Katarina Schenk, and when we had this sort of historical overview, we saw things that couldn't have been foreseen at the time when the project of creating the dream of European Monetary Union actually started. But now, even shorter term than 25 years, I can see EVA and Central European states in. I can see Western Balkan states in. I can see the governance changing. I can see the objectives, in addition to the price stability, supporting the growth, employment, and something that maybe Governor Holzmann will not agree with me, but sustainability goals. Then clearly the trend of digitalization and digital euro. And I believe that Europe has, despite decay geopolitically and economically, which is very visible and very worrisome, it has shown that it can deliver at times of crisis. So I can see the European Union and the European Monetary Union stronger and with stronger dominance on the global terrain. Thank you.
Thanks a lot. Great intervention, but may I ask now for being a little bit shorter.
Yes, I will
Eva,
do my best. Yeah,
2
I will do my
sentences.
best. Yeah. So I wish. I'm not a visionary, so I say what I wish. More economy, more higher share of European economy in world economy, in global economy, higher share of euro in world FX reserves. Yeah. Balanced growth to every European country, balanced and sustainable economic growth to every European country, and less politics, more economy, more market.
Okay, great. Now, fits perfectly. It's soon to Christmas. This was the Santa Claus wish list. Perfect, I have to say. Okay, who will follow up?
I can also, I don't know what's the R star now, not to mention what the EMU look like in 25 years. But if you want to make wish, you would wish probably that the inflation rate is at 2%, that the potential rate of growth of the Eurozone is at 3%, that the R star is around 3%, that the public debts have converged somewhere between 60 and 85%, and the Council had decided to issue more common debt, that the number of banks is smaller, they're all well capitalized and well liquid, and that, I don't know, Beijing has finally adopted the Basel V rules. something like that. You know?
Okay. Peter, can you top that? You know, it's
no,
Christmas.
I'm just already,
Christmas,
I think I already answered about my wishes, you know. So I would wish, the true monetary union with much better monetary and fiscal policy coordination, and hopefully all friends here together in one family, you know. So
25 years.
25.
I appreciate your wish. Peter.
Let's continue with the common wishes and put them in a framework. We should make the transition from regulation to innovation during these 25 years. The number of participating countries in the Euro system will be much higher.
I fully agree.
Eurozone, EMU should be based on explicit rules with good track record of following them. It should not help the governments to avoid the structural reforms. The institutions, the main institutions should be time consistent, and it could be accompanied by fiscal union.
Okay, so you can finish the wish list, you can add, you can subtract.
Since we don't have much time, I will try to be precise. I support all wishes which were previously mentioned. However, I believe that definitely the number of countries will increase, since we obviously have a lot of candidates in the different stages. The new members will influence the further expanding of the euro importance. How will it be? In which direction? It's very challenging to say, since 25 years is a long period of time. We need to take a closer look on the importance of dollar, on the importance of yen, of the importance of BRICS extension as the alternative to supreme national institutions like the IMF and the World Bank. But I believe if the Eurozone would like to become a more prominent member of the world, some economic shifts will need to be done, as at least the competitiveness of the Eurozone is not increasing. Let's put it like this.
Thanks a lot.
And the ECB is not run by the AI.
One can think of worse examples, okay? Sorry. Did I promise you too much? It was a great panel, wasn't it? Okay, let's give him a hand.